and good morning, everyone. Welcome to day one of the Traders Conference. We are so excited to have you here for our amazing conference. This week, we are going Monday through Saturday. It's our largest conference ever. We have 46 speakers who are going to be bringing you so much education for free this week. We are so excited. I can't say it better. We're so excited. Anyway, we are MetaStock. We are the hosts of this Traders Conference. We're excited to have you here. I'm going to show you a quick video about MetaStock, who we are, what we do, while we get everything lined up. So go ahead and stay tuned for that, and I'll be right back with you.
Hi there, Greg Lewis, MetaStock Software. As the marketing director, I get asked all the time, what is MetaStock? How can I help my trades? Well, stick around for about 3 minutes and I'll tell you. MetaStock is an award-winning software and data package that has been helping traders for over 35 years. Simply put, MetaStock is a tool for traders like you to analyze the markets. MetaStock helps you take the guesswork out of trading by offering a methodical, systematic approach to some key questions all traders come up against. Questions like, how do I decide which securities to trade when there are literally thousands to choose from? Which strategy should I use, and how do I test that strategy before spending my first trading dollar? When should I enter and exit a trade? How can I effectively manage the securities I'm interested in? And of course, how do I know where prices will go next? At the core of MetaStock are the Power Tools. The Power Tools give professional-grade analysis tools to private traders like you and me. You can scan the market with the MetaStock Explorer to filter and sort securities that show buy and sell signals based on your criteria. The MetaStock System Tester lets you test most strategies through a process called backtesting, which allows you to see how your strategy would have performed over time. You can easily manage and monitor the securities you are interested in with Quote Center. Quote Center lets you sort on a variety of criteria to view the data that's important to you. Then just double-click on a security if you want to see its chart. With the MetaStock Forecaster, you can even take advantage of patented technology to view probable future prices. If you're an options trader, you're going to love MetaStock's Option Scope. Option Scope puts all the critical info at your fingertips, displaying sortable, customizable, color-coded options data, including the Greeks. And MetaStock has solutions for traders of all levels and interests. If you're just getting into trading, you will appreciate the education offered by our many built-in systems. In addition to pointing out buy and sell signals, MetaStock explains how they work in an easy-to-follow commentary window. MetaStock has built-in systems based on popular strategies like MACD, Bollinger Bands, turtle trading, candlesticks, and many more. MetaStock even has the very popular and exclusive Rahul Mohindar Oscillator System, or simply known as the RMO. And as you become a more experienced trader, MetaStock grows with you. Advanced analysts will enjoy the comprehensive list of trading systems and indicators, and the ability to build their own systems. And if you're a day trader, you can't do better than Zenith, the real-time news, data, and analysis package offered by Refinitiv, a world leader in market data. Add on the world-class support, and it's not hard to see why MetaStock has won the Stocks and Commodities Reader's Choice Award for 26 consecutive years. To find out more about MetaStock and how it can help your trading, visit metastock.com or contact a product professional via phone, email, or chat.
Okay, well, there is a quick introduction to MetaStock, who we are, what we do. Thank you again for being here for today's Traders Conference. I am so glad you're here to learn. take in everything that all of our presenters have to tell you. So today we're going to be starting with Steve Bigalow here in about 4 minutes. Now, one thing I'd like you to do as you come into the room, say hello, tell us where you're coming in from. We're here in beautiful Salt Lake City. Welcome, Scotty B. We're glad to have you here this morning from Chicago. Also, let me just show you how to see what is going on today with the conference and throughout this whole week. So if you go to metastock.com, metastock.com, and you can click on the homepage banner, it'll actually take you to a page that is the Traders Conference. I also posted a link in chat where you can see the schedule and register for prizes if you haven't registered for prizes. But all you need to do is go to metastock.com/traders-conference if you haven't seen that, and I will show you what the page looks like here. Oh, this. Okay, so this is the page here, and on this page you're going to be able to see all of the presenters and who is going to be speaking. You can see we have the schedule for Monday, Tuesday, Wednesday, Thursday, Friday, and Saturday. So we have quite the lineup this week. But this morning we'll be starting with Steve Bigalow, going on to Vince Vora, two fan favorite presenters. For the first time in the room with AAII is Raymond Rondeau. We're excited to have him here. And then we'll be going on with Alex Cole. Sorry about the bumpiness there. It doesn't always slide very well. Then we have Jeff Gibby, Dr. Alexander Elder talking about current markets, Larry McMillan, Jake Bernstein, and wrapping up the day with Martha Stokes. So we have a great day of learning ahead of us. All of these presenters are great about talking about current markets, what's going on in the markets, and how you should be paying attention in these markets. So stay tuned for that. Let me just go and kind of do some of my final checks, and I'll be right back with you. Okay, we are looking good to get started here in about a minute and a half. Again, what I would encourage you to do is visit metastock.com/traders-conference so you can see today's schedule. Also make sure to register for prizes. We're going to be giving prizes away throughout the conference, so make sure you get registered for that so you can take advantage of winning the prizes. Now also, one of the things I do encourage you to do, because you are here to learn, is I would encourage you to take a few minutes during each presentation, ask questions. We'll send those over to the presenter so that way you can ask the questions you want to know the answers to, because you're here to learn. So make sure you're asking questions, be engaged in chat. There is a lot to learn, so make sure you're taking full advantage and taking advantage of the knowledge of these presenters. So let me go in and do my final checks, and I'll be right back to kick us off. Okay, it looks like we are all set to go on both the YouTube side and the GoToWebinar side. Steve's ready, so let's go ahead and kick off the event. Let's go.
All right, thank you. Good morning, everybody. Jeff Gibby here with MetaStock. It's great to see you. Thanks for coming. We've got a great lineup this whole week, and it's good to see you at the MetaStock Traders Conference. So let's go ahead and kind of kick this off. Let's start with a legal disclaimer, should we? Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock should have no liability for investment decisions based on the use of the software, any trading strategies, or any information provided in connection with the company. So with that being said, I hope you enjoyed it. Welcome to the Traders Conference with MetaStock. If you're joining us on GoToWebinar, I want to say welcome. Thank you. A special note to you if you're joining us from YouTube, make sure to say hi, like, subscribe. All that stuff helps a great deal. Helps us get kind of all these great conferences out to people, and we really appreciate it. So if you'll do that, we do appreciate it. Before we get started, I want to say thank you to a few of the sponsors that we have today. Stocks and Commodities Magazine will be the first. They've been a long-time sponsor of the MetaStock events and the traders conferences and all that kind of stuff. They do a great job. We really appreciate kind of the work that they put into or the partnership they've had with us over the years. And we want to thank you them for their sponsorship today. In addition, CMT Association, you can find out more information about cmtassociation.org. But CMT Association is a really, really well accredited organization that's been doing accreditation of investors for quite some time. We're going to have Tyler come in and talk today and a little bit later in the week. But if you are trading as a professional, a CMT designation could be extremely helpful for you. And if you're interested in finding out about that, you can find out about that at cmtassociation.org. Okay. The last people I want to talk about is a huge one. Brand new sponsors of the Traders Conference, the Traders Summits, AAII. AAII has been as a nonprofit. They've been doing business for decades now. They've helped millions of individual investors, and we want to thank them for coming in, being a sponsor of the MetaStock event. We're very, very glad to be affiliated with them. So thank you for that. In any case, of course, we're MetaStock. MetaStock has been rated #1 in its price category for 30 years straight. You can find out more information at metastock.com. You can sign up for an extended trial at metastock.com/conf-promo. And I think that will be the introductions for today. So, except for this one, Steve Bigalow is a good friend of mine. He's been running, he's been a partner of MetaStock anyway for a number of years, probably more than 10, 15 years. He's created one of the most successful add-ons that we have for MetaStock called the Candle Profit Systems. He does a lot of work in candlesticks. He's very funny, very, very good teacher as well. We're gonna kick off with him. So let's go ahead and bring you on here, Steve. Steve, how are you doing today?
Good morning, Jeff.
Good morning, Steve. It's good to have you.
Yeah, turning on my mic, turning on my cam. All right.
I can see both of those. Yep.
All right. And then share the screen.
Yep. I can see that too.
Okay.
So we're gonna do the part where I get out of the way and let you talk.
All right. Am I started? All right.
Yes.
All right. Good morning, everybody. We always like to have me first on these sessions because you're going to see a lot of good trading techniques over the next few days, but candlestick signals are kind of like the building blocks or the bread and butter of looking at charts. You can apply candlesticks. If you find a trading technique that fits very well for your trading style, if you put candlesticks on top of your charts, meaning use those, it will make you see the price movements a heck of a lot better. So the first question I usually ask before we get started is, so I know how much description to put into each chart, how many people have seen my presentations before? Y for yes, obviously N for no. I think I've got the right screen up to, is it the questions?
Yes, it is.
Okay. All right. Okay, everybody do it real quick, just one click, just so I can see how much time and effort or description to put into each chart. All right, so my name is Steve Bigalow. I started by accident. I came across candlestick analysis well over 3 decades, probably almost 4 decades ago. I've written 3 books on candlestick analysis so people can see how to use it fairly simply or fairly easily. Well, I can see there's quite a few people that haven't seen the presentations before. So what I discovered through the years is out of the 50 or 60 candlestick signals, there's only 12 that you need to learn. And the rest of them don't occur often enough to spend mental time and energy trying to remember them. But these 12 major signals are the ones that occur all the time. And once you learn those, you start getting a very strong grasp of what's going on in price movements. So the first thing that you always want to remember is prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. And that's what the graphics, the candlesticks provide for you, is it tells you exactly what investor sentiment is doing. So the Japanese rice traders have a very simple concept. If you see a candlestick reversal signal in the overbought condition, and my overbought condition is I'm using stochastics of 1233 slow. So the logic is if you're in the overbought area and you're seeing a candlestick reversal signal, the doji being one of the most prolific of all your signals, the probabilities are pretty strong that you're going to be starting in a downtrend. So what we've got based upon the 12 major signals is we've got some that we call the top rank signals and patterns, such as, well, and let me describe this a little bit more. On my chart, you're going to see you have the 50-day simple moving average, and the red line, which is not on this chart, is the 200-day simple moving average. The reason those are on the charts is because every major money manager around the world makes their decisions using the 50 and the 200 simple moving average. We don't have them on our charts to make our decisions. We have them on our charts to see what everybody else's decisions are doing. And here's the important one that we're going to go into a little bit more, the T-line. The T-line is a natural support and resistance level of human nature. So if you take the candlestick signals, such as the kicker signal, which is the most powerful of the individual candlestick signals, it's basically when you see a dark candle, and remember, a dark candle is formed when you see it open and close below where it opened. A bullish candle is where it opens and closes above where it opens. Well, the kicker signal is witnessing a bearish candle, and then the next day they gap it up at or above the previous day's open and goes the opposite direction. This illustrates that there's been a tremendous change of investor sentiment that has kicked the sentiment in a bullish direction. We've also got other, well, there's the kicker signal right here on morph. Now we have a T-line rule that once you see a candlestick buy signal, you can stay long as you don't see a candlestick sell signal and a close below the T-line. Now that was a bad hair day, but notice what it didn't do. It didn't close below the T-line. So the T-line is the 8 exponential moving average. It acts like a natural support and resistance level of human nature. So basically it's got Fibonacci characteristics in it. So here is a very strong or most powerful statement of this whole presentation. If you see a candlestick buy signal and a close above the T-line, you can stay long until you see a candlestick sell signal and a close back below the T-line. Now, the reason this is important is what is the biggest bugaboo of most investors? It's our own emotions. So when I first learned candlesticks, I was the worst investor in the world. I was even a stockbroker for 8 years, and I got out of the business because I realized the brokerage firms had no more idea about what made prices move up or down than anybody else. But then when candlesticks came along, instead of losing money consistently, I started making money consistently. And then when we put the T line on our chart, what it kept us from doing, or kept me from doing, is if I saw a candlestick sell signal, I didn't close it until I saw a candlestick sell signal and a close below the T line. Because what's the biggest fear factor when we have a winning trade? And I'm speaking for myself, and I know other people have that same fear. Boy, would I look stupid if I let this profit turn into a loss. So I'm going to take profits just because I have profits. But now I know that I hold on to that position until I see that sell signal and a close below the T line. So here's one strong truism. If you were long, when it closes below the T line, you have an extremely high probability of, no, I should do it the other way. If you see a candlestick buy signal close above the T line, you have an extremely high probability an uptrend is in progress. If you see a candlestick sell signal and a close below the T line, you have an extremely high probability you're in a downtrend. So if you were in a long position and you saw it close below the T line, take your profits then. Or if you want to go short, you can stay short until you see a buy signal and a close back up above the T line. That whole function keeps you from having your emotions whipsaw you in and out of positions too early. So again, when you see a candlestick sell signal and a close below the T line, the probabilities are extremely strong that you're now in a downtrend. That's if you're long, when you start taking profits, and when you're short, or if you want to go short, that's when you start going short. So what we're looking for is what we call 2+2 analysis. There are candlestick patterns that work time after time. You can see the big fry pan bottom. This is one of the Japanese rice traders' patterns. And a fry pan bottom is nothing more than a rounding bottom that you couldn't trade long or short if you wanted to, except for the fact that when you start seeing this formation setting up, you look to see what happens when this pattern is about ready to break out. Now, here's that trend kicker signal. We call this a trend kicker signal because it's not reversing the bottom of the trend. It's occurring during the trend. And if you see it open here and close here, notice what it didn't do. It didn't close below the T line. The next day when they gap it up and start going the opposite direction, you've got a trend kicker signal that tells you there's going to be more upside, number one. And number two, what do we know about a fry pan bottom? We know that when it breaks out, there's going to be a strong price move. Notice this was as of Friday right here. Notice what it did. It told you it was time to take some profits. And look what it did here at the T line. They couldn't close it below the T line. So you get ready for the next wave to the upside. So everything that you witness on a candlestick chart is merely what investor sentiment has done. And this is not based upon, flimsy statistics. This is based upon the Japanese rice traders producing 400 years of observations of the patterns and signals that tell us exactly what's going on in investor sentiment. So I always remind people, the Japanese rice traders did not become wealthy using candlestick signals. They became legendarily wealthy. They were the powerhouse in Japan for centuries, the financial powerhouse, and they did it with the most boringest commodity in the world, rice. So the kicker signal works just as effectively to the upside as it does to the downside. We're short Crocs right now because you could see the bullish candle the next day. Because of earnings, they took it down and did a bearish kicker signal. Now, what does this tell us? This basically tells us they're trying to get out of this stock with great enthusiasm, and it's usually going to have a strong follow through to the downside. How long would we hold on to this position? until we see a buy signal and the close back up above the T line. However, there is a caveat to that. The caveat is that the further away you move from the T line, the higher the probability it's going to come back and test it. So if this started running wildly up here, when you see all your first sell signal, figure it's time to take profits because you're too far away from the T line. Ben Krent, I hope I said that right. Candlestick signals are the graphic depiction of everybody buying and selling during a specific time frame, which means they work just as well on the 1 minute, 5 minute, 10-minute chart as they do on the daily, weekly, or monthly. I used to trade the E-minis off the 1 minute, 3 minute, 10-minute time frame. I trade commodities right now because I can't trade as active because I got other things going on. But I use the 10-minute chart as my bellwether. If I'm trading stocks, I'm a swing trader. My trades are usually going to last anywhere from 2 to 10 trading days. The T line is the 8 exponential moving average. The red line is the 200 simple moving average. The blue line is the 50-day simple moving average. And I also put on the 34 EMA, which works reasonably well. Steve also uses stochastics 12 through 3. What is it? The stochastics is a indicator that was developed about 50 or 60, maybe 70 years ago now, that tells you whether you're in the overbought or oversold area. You can also use RSI. Now I forgot what I was saying. So the top ranked power trade setups are a combination of candlestick signals and patterns. The candlestick signals work, or we wouldn't be looking at them today after 400 years. The candlestick patterns work. That's because well before Elliott Wave, the Japanese rice traders illustrated that prices move in waves or moves in patterns. The T line is the 8 exponential moving average. So, for example, the doji is one of your strongest reversal signals. And it creates the best friend signal. And the best friend signal is a doji followed by a gap up. And if it does it in the oversold area, it's that much more compelling. Because the Japanese rice traders, again, have a very simple philosophy. If you see a candlestick bullish signal forming in the oversold area, more than likely you're seeing a change of investor sentiment that's going bullish. If you see a candlestick sell signal in the overbought area, the probabilities are pretty strong that you're now starting to see a downtrend. So this is the type of trade that you want to get stuck in. If you see that candlestick buy signal and a close above the T line, your best friend's signal, you just stay long until you see a sell signal and a close below the T line. Again, this keeps you from getting whipsawed in and out of a position. I used to, when I saw a sell signal, would say, time to take profits. And if it goes back up, I can always get back in. Well, usually I took that money and went on to something else. Now I can, if I've got 10 positions on, it takes a matter of 3 seconds to analyze this each day, say, all right, what should I do? What should I do? Well, it's still trading above the T line, so I don't have to do anything. This is what keeps your emotions out of your trading, or at least keeps my emotions out of my trading, which is very relevant for me because being the worst investor in the world, I would do everything wrong. Candlestick signals and patterns now offset that that process. So if I see a sell signal, like an evening star signal, which is basically a big bullish candle, a day of indecision, and the third day closes more than halfway down this candle. Now you can put all the common sense observations into your analysis. Look where this evening star candlestick sell signal occurred. Right smack dab on the 50-day moving average. And why is that relevant? Because nobody has the T-line on their chart, but everybody has the 50-day moving average. So they're all making their decisions here. We can see when it closed back below the T-line in the overbought condition, and it started trading below the T-line, we could stay short, or we could go short at that point. So your best friend signal is essentially a doji followed by a gap down. I had somebody ask me the other day, well, if that gap down is created because of earnings, what does that mean? Well, that means that's exactly what the earnings did. It told you that the bears came into this, or the bulls wanted to get out as fast as possible. So that the force of that doji best friend signal tells you there's still going to be a lot of force to the downside. Same scenario on the upside. If earnings, you see a doji gap up, and what this eliminates is that fear factor. What do most people say? And I did this myself. Boy, I don't want to be chasing this one. I'm going to wait for it to come back to a level that I like, and then I'm going to get in. That's one of the most ridiculous trading strategies in the world. Because if it's moving bullish, what don't you want to see? A lot of selling pressure. If they're selling this off after they've gapped it up, that tells you, well, their bulls aren't there very strong. And it also tells you you've got the syndrome of the immaculate execution. That if this pulled back to a level that you liked, as soon as you decide to buy it, it's going to turn right around and go right back up again. That's wishful thinking. What we're looking for is bullish confirmation. Once we see a buy signal, we want to be buying into strength. So anytime we see that doji gap up, we don't have that fear factor of, boy, we're chasing this one. We're more recognizing there's going to be a long price move after this move. Oops, hold on. Let me. So this was Weight Watchers. They had strong earnings. That became a very good trade. And then where did we take profits? Well, look at your shooting star, one of your 12 major signals. Look where you are. You're in the overbought area. And look how far away you are from the T-line. This just gives you an alert that it's time to start taking profits, because where do you think the first target is after the sell signal? Coming back to test the T-line. So I always remind people, this is not rocket science. This is just common sense evaluation of what investor sentiment normally does, and the Japanese race traders have provided the graphics to tell us what they normally do. Any win? Dimitri, I've been trading using candlesticks for over 30 years. I would say that my win-loss ratio is 70% bullish trades, 30% losses. Now remember, everybody tells you, I imagine everybody has told you through the years to cut your losses short and let your profits run. I've heard that for over 45 years, but I've never heard anybody tell you how you cut your losses short and let your profits run. Candlestick analysis makes that very simple. Now, out of that 70% win ratio, I might have a few that are 0.3% or almost just flat, but I've also got the probabilities of being in trades that are big moves to the upside. Why? Because that is telling me there's a drastic change of investor sentiment. What candle are you buying on? The gap up? Well, not necessarily. I'm probably buying on that candle because when, and Jeff will go through the scanning process of finding these signals. This is the signal. So I might not see it that day. Or fortunately, as we've got a chat room on my website, we've got usually 150 people in the chat room and the main chat room, and another 20, 25 in the options trading chat room. But they're all looking for the same signals and patterns. So I would either have found this on the day that I scanned for it, wouldn't have bought it on this day, but I would have been buying it on this day because of this. Or on the other hand, somebody says, look at Weight Watchers. It's gapping up after earnings, and I look at it and say, oh, it's doing a kicker signal. I could be buying it on that day. And that's the benefit of having a chat room where you've got everybody looking for the same signals and patterns. So right now, Wayfair, this is kind of what we call a scoop pattern. You can see the handle relatively flat, pulls back, and then look at your best friend signal, gap up. And what do we expect coming out of a scoop pattern? A slingshot effect, a very strong price move to the upside. So once we identify the 8 or 10 patterns that the Japanese race traders have illustrated that told us those pattern setups have high probabilities of heading in the right direction, we don't have the fear factor, the what if. The what if is, what if I buy it and it immediately goes down? Well, that's one of those, that 30%. It's not, it's just as important to know that when you get into a trade, it's going to be a good bullish trade as it is getting into a trade that you think is going to be bullish and then it goes the other way, close out because that didn't work. Take a small loss and go on and find something that's going to have a big profit potential. So this best friend signal works just as effectively when you're looking at patterns. This is a bearish J hook pattern. And notice what it did right here when it came down through the T line. There was your bearish best friend signal. What does that imply, especially with your stochastic still heading down? There's probably going to be more downside. So the patterns, I've done this one before, showing the patterns, like the J hooks. I really like that he is using current charts. Yeah, Deborah, there's going to be some charts on here that illustrate something. And the nice thing about candlestick analysis is the patterns and the signals occur every single day. So the first thing, I'm getting off track here a little bit, the first thing you can analyze is which way is the market going? And then logic says if you think the market is heading up, now we're going to scan more heavily for the bullish charts. If the market's heading down, obviously you're scanning more for the bearish charts. If the market's moving sideways, there are 9,500 trading entities out there, and simple scanning techniques using candlestick analysis will, in less than 20 minutes each afternoon, and that's if you don't know what you're doing, in less than 20 minutes, you're going to find 10 good bullish charts and 10 good bearish charts. Maybe if the market's moving sideways, you know those charts are going to work effectively, so you might have both bullish trades on and bearish trades on. So the patterns that set up that produce extremely high probability results, one of them is the J-hook pattern. The J-hook pattern is where you have a strong price move, it pulls back, and then does that J-hook. Usually, and what's beneficial using the T-line is this pullback comes right back to the T-line and acts as a support level. So the benefit of a J-hook pattern is if we see something pull back, we know that wave 1 and wave 3 are usually going to be the same magnitude, which helps us immensely if we're option traders or even stock traders. If we're option traders, we might be buying calls here. As it continues with the expectation it's going to go up here, we start adding some bullish spreads to it. Okay, yes, and yeah, we're going to be working more on. I do a YouTube usually over the weekend. They're only about 4 to 6 minutes, showing what the market's doing, which stocks or which sectors look the best, and then I do the same thing on a Monday and Thursday night. So get a quick feel for what's going on in the overall market. So a lot of people ask, well, can we use this for Forex or for bonds? Candlestick signals are the graphic depiction of everybody buying and selling during a specific period of time. Doesn't matter whether it's stocks, bonds, currencies, commodities, tulip bulbs, anything that has fear and greed in it. So there's your J-hook pattern. Now, why is this just called a J-hook pattern? Because notice where it pulled back to the T line. Now, why is that relevant to us? Because nobody has the T line on their charts. We use it to show where a natural support and resistance level is of human nature. Oh boy, Nicole, I don't know how to even get to my YouTube. I always come in from the back end. Do you mean the current charts are, whoops, I gotta expand that to see what the rest of the question is, are generated in real time? Yes. Yeah, it depends on what service. MetaStock has live charts. Is a J-hook same as a coffee cup? No, but it's close. Now, a cup and handle would be this pattern and then here. J-hook is after it comes out of this pattern, then it does the J-hook. Whoops. I gotta. Are those YouTubes on your website as well? They're on YouTube. I think if you just type in my name or candlesticks, you'll find them on YouTube.
I just shared the link, Steve.
Oh, okay, great.
For your channel.
All right. Is the T line a simple or exponential moving average? It's the 8 exponential moving average. All right, so here's the J-hook. Remember, this one had a strong price move start with the best friend. Notice where it pulled back to, right smack dab to the T line. Now, this is why the T line is relevant. It's not anything that works reasonably well. It works excellently well. And it kind of confirms that it's a natural support and resistance level of human nature. So there's wave 1, there's wave 2. We could be buying here. If we took profits here, we could be buying here because we now know we're in wave 3. And you can see the signals. There's a left-right combo. A left-right combo is a bullish engulfing that follows a doji. That combination is a very strong bullish signal. But if this does a wave 3, this being wave 1, what's it tell us about this level? It tells us they're not going to resist at this level. If they go through, what can we expect? This wave and this wave are going to be the same. And what enhances that analysis? Everybody and their brother is watching to see what's happening right here at this resistance level. We know we could be buying here, knowing that when they've broken through, we've got a lot more upside. So there was that little J-hook pattern that broke through. That's the type of price move you can expect until you see a sell signal and a close back below the T line. Oops. Jeff, Kelly, hold on for 1 second. Sorry about that. Somebody at the door, and Nurse Cratchit is not here. Why 8 and not another number? Use whatever you want. We've discovered through the years that the 8 exponential moving average works extremely well as a natural support and resistance level. Let's see. So the J hook has added benefits to it. We call this the J hook plus, because you could see where the left-right combo occurred, right smack dab on a level that everybody else was watching. And then if you see a candlestick buy signal and they gap it up the next day, not only are they confirming that signal, but they're confirming with great enthusiasm, which basically tells us wave 1, wave 2, wave 3 is probably going to go through the 200 and create that same price move. So anytime we see signals and a pattern at levels that everybody else is watching, it just increases the probabilities that you're going to be in the right place at the right time. Deborah, if you get the High Profit Candlestick Patterns book, that was the second book. The first book I wrote was published by Wiley & Son, and that's more generic or more general. The High Profit Candlestick Patterns book gets more into the meat, the 12 major signals and the patterns. How do you avoid trading in choppy markets? Sean, that's exactly what the candlestick charts will tell you, that you're in a choppy market. So it kind of illustrates that if you can't tell which way it's going, then any trades that you're doing using candlestick scans should be very strong or compelling charts. And that's where the top rank signals and patterns kind of enhance that analysis. I mean, for the 30% of the time. Again, if a candlestick signal tells you when it's time to buy, I'm trying to find something that might illustrate that. For example, if this was a buy signal, a very strong buy signal, and the next day, so if you bought on that day, or let's say you even bought on this day, and then this day closed back down here, what's it telling you? It's telling you you're still below the T-line, close out the trade. So again, the candlestick signals tell you when to get in and when to get out. And that getting out might be immediate, so you're going on to another chart, or telling you to stay in because the pattern is confirming. Oops. I want to make sure I don't run out of time here. Please explain T-line confirmation. Is based upon the 8 exponential moving average. So T-line confirmation is seeing a buy signal and a close above the T-line. And then you can stay long until you see a candlestick sell signal and a close back below the T-line. This is not anything, you don't have to be a sophisticated analyst or a sophisticated technical trader. You don't need to know the Fibonacci numbers. You don't need to know Bollinger Bands. You don't need to know anything. All you have to do is recognize the signals and patterns that the Japanese rice traders started identifying hundreds of years ago that tell you what's going on with investor sentiment. Now, that doesn't mean you ignore the Fibonacci numbers or the anything else. You use those to enhance exactly what's happening at those levels that everybody else is watching. So this is why when I said when we first started that no matter what trading technique you find that fits your trading, if you put candlesticks on your charts, it will enhance what your analysis is. If I'm watching 2 time frames, like a 15-minute and 3-minute on a market, what time frame is better? Well, Todd, you're probably using 1 time frame to use as a bellwether. Now, this could be a 10-minute chart. So if I'm watching this, and I'm going to just say hypothetically, let's say this is soybeans. So I'm buying soybeans here, I'm taking profits here. When do I buy soybeans again? It needs to break out through this level. It hasn't. Well, now I'm watching because I can see that soybeans did a bullish signal. I might be buying again here on the 10-minute chart. Now, if I'm buying on the 10-minute chart and the 10-minute chart looks like it's good, I've flipped down to the 5-minute chart to see if the 5-minute chart is confirming. So you use the time frame that is best for the type of trading that you're doing. Yeah, the blue ice failure. All right, thanks, Silver. Let's see. If you go to our website, www.candlestickforum.com, and go to products and services, the books are in there. Now, you can buy the books on Amazon, but I think they charge $98 for the books, whereas they're about $55 on our website. On the Xerox chart, are you concerned the stochastics are at the top level? There's another facet. Is this the Xerox? There's another facet to candlestick signals. You want to buy the signal, bullish signal, when you're in the oversold area. Your pattern breakouts are usually going to occur when your stochastics are already in the overbought area. So remember, we're not buying stochastics. We're buying the signals and the patterns. So here's a very obvious chart pattern. They come up through a resistance level, the 50. They pull back. And now look what they did right at the 50. They did a morning star signal. So if this is wave 1, this is our little wave 2, where do you think wave 3 is going to be? Right up here to the 200-day moving average. So again, this is not rocket science. Prices move based upon human nature, and human nature works the same way time after time. I don't have a Kindle version. I don't know why. But we do have probably about 30 or 40 different products showing you the 12 major signals, the high profit patterns, your stop losses, your entry and exit strategies, your scanning techniques. But anyways, and that's what Jeff's going to kind of convey here, if I can get done fast enough, to show you what the different scanning techniques help identify those signals and patterns. Oh boy, Robert, it's www.candlestickforum.com. The 50-day is a simple. The 200 is simple, because everybody in the world uses those moving averages, simple moving averages. So the next J-hook pattern is what we call the bobble breakout. If you can see that there's a resistance level like the 50, when it comes up, hits the 50, it's time to take profits. But notice what it didn't do. They couldn't close it below the T line. You can be buying right here, because what's that telling you? Because you have a J-hook pattern, and now everybody that's watching is saying, well, they're not resisting at the 50. That tells you the next portion of your J-hook pattern is working. So there's your bobble breakout, because you can see the doji gap up through the resistance level. And this one we call your J-hook plus, because notice they came up through the 200, did a bullish engulfing, and started your next wave. So we don't have to be sophisticated analysts. You don't have to know what always tell people, you don't listen to what the experts say. You listen to what the charts tell you. So when you can see big trade setups like the fry pan bottom that looks like a fry pan bottom, this becomes a high probability breakout area. When you start seeing buy signals, you can see where the resistance level is. That's where the new investor sentiment is going to come in. So I always add the caveat here is every single price move have big moves like this? Obviously not, but it puts you in situations where the probabilities of being in big price moves are greatly in your favor. So there's your fry pan bottom. Notice what happened right at the resistance level where this fry pan bottom started and the 50. They gapped it up. What do we know about the fry pan bottom? It's going to produce a strong price move. So we could immediately be buying, knowing how long do we stay in this one? Remember our T-line rule? You stay until you see a sell signal and a close below the T-line. Again, that takes all the whipsaw emotions out of your trading. A dumpling top is the opposite. It's a rounding top, and then notice what they started doing here after not being able to get back up through the T-line, gapping it down. That's what produces your strong price moves. So obviously, if we're seeing the markets are heading down and we're seeing something like this, we're more apt to go after the strong bearish signals. Is there a way to scan for a fry pan bottom? You don't have to. Usually a fry pan bottom is going to be setting up to where, let's go back one if I can. Whoops. I might not recognize this fry pan bottom until over here where I'm starting to see some buy signals. Say, wait a minute, there's a fry pan bottom. So you don't have to scan for them. They're going to come up automatically as long as you recognize this is a fry pan bottom based upon the bullish signals. You're getting ready for the breakout situation. Is there a pattern to work for currencies? Yes. Remember, candlestick signals are the graphic depiction of everybody buying and selling any trading entity during any time frame. So it works for anything that has fear and greed in it. So CALX, look at your basic chart here. Here's your best friend signal in the oversold area starting your uptrend. There's your bearish kicker signal telling you should be out or going short. There's your bobble breakout. Notice again, they couldn't close below the T-line. That's always a very strong indicator that if they come up and they're profit taking and they're not closing below the T-line, get ready for the next price move. And when they broke out, if this is wave one, where did you think wave three was going to? Right up here to the 200. So it also works if you're a day trader, and this is the nice thing about having a chat room with everybody looking for the same signals and pattern setups. If you see something break out like this, do you buy here? Do you buy here? Do you buy here? Do you buy here? Well, that's where you flip to your 10-minute chart. You could be buying here. You could be buying here. Well, you might not be buying here. But look what's happening here. There's your buy signals again. You could be buying here. So on these big price moves, what is the alert? Look how far away you are from the T-line. Now, moving that far away from the T-line, which acts like a natural support and resistance level of human nature, if we know we're moving too far away, what's it going to do? It's probably going to come back and test it. So is this going to blow out and make huge profits? We don't know. So all we do is flip to our 10-minute chart. There's the same analysis. You can see the little fry pan bottom. You can see how they started breaking out. And then you can see on the 10-minute chart the same criteria that you use for any other chart. Look how far away you are from the T-line. If they started trading up, what was this telling us? We're a heck of a long ways from the T-line on the 10-minute chart. We're a heck of a long ways away from the T-line on the daily chart. So what are we doing up here? We're getting ready to put our, if this opened here and started trading up, we'd immediately put our stop loss right here. Or if we didn't have time to do that, put your stop loss right here, because if you see a doji in the overbought area that far away from the T-line, where should they not be trading? Back below the low of that doji. If they do, where do you think they're taking it back to the 10-minute chart or the 10-minute T-line? IPI. We're shorting this one today because there's your best friend gap down in a dumpling top. Now, remember, the market had a strong move up on Friday, but it stayed below the T line. I think I've got those charts on here. So this tells us, even though the market might be sideways or heading up, there's strong selling. We'd be shorting this one on weakness today. And if that's your breakout, again, we were long this position, but notice what it was doing up here. Starting to see some selling. So where do you think the logical place would be to put a stop loss? At the low of that sell signal. Because logic says if it comes down through there, where do you think it's heading to? At least back to the T line. So not only do candlestick charts tell you the bullish sentiment is starting to build up, you want to be buying, it also shows you exactly where to be selling. So here's the candlestick logic. There's your kicker signal, starting your uptrend. And the Japanese rice traders always tell us where the most people buy. They buy exuberantly at the top. When they're gapping up in the overbought condition, that's when you start taking profits. There's your piercing signal. There's your wave 1. There's your wave 2, J hook. Notice what it did, a trend kicker on Friday. Well, we'd be buying this one. I think it opened lower today, so we wouldn't be buying until it comes back up through that level. So the benefit of candlestick charts is it's not conjecture. It's anticipating what's happening in investor sentiment because it's telling you what the exact investor sentiment is doing. I said that wrong. It's indicating investor sentiment is what it's actually doing. So if you don't listen to the experts, that I've never seen any of them that are right, if you listen to the charts, they tell you exactly what's going on. So we always provide a 2-week free trial because I tell people if the logic of candlestick analysis doesn't hit you after 2 weeks, there's not going to be anything that makes you convinced. But candlestick charts are telling you exactly what's going on in investor sentiment. And they're usually moving or putting you in situations where the probabilities are greatly in your favor. All right, let me see what questions I've missed here real quick, Jeff. Is there which candlestick signals the best friend signal, the kicker signal, the fry pan bottom breakout? All right. Ed Cotter developed scans for many, including fry pans. All right. Yes, he was with us years ago and did a lot for us. Do you use any alerts for the T line or the 12 major signal? Duval, that's exactly what Jeff and I have put on to the MetaStock. It not only identifies when they happen, but if you're in the learning process, you just click on that and it gives you a description of why that signal is working. Deborah, that was my question years ago. When I first started using candlesticks, I would say, why isn't everybody using candlestick signals? And that was back when the website, or not the websites, but the forums on, you had trading forums on the internet just starting, which were nothing more than kind of high school food fights. But I would ask, why isn't everybody using candlestick signals? And their answers were, there's too many of them and they didn't always work. And I kept coming back to the conclusion that if they didn't work, we wouldn't be looking at them today. And so all you have to do is learn the signals. You don't have to learn formulas. You don't have to learn or know what the earnings per share, anything like that. Just let the charts tell you what investor sentiment is doing. I'm usually, working off the daily chart if I'm a swing trader. If using daily charts, does one trade at the close? If at the end of the day, you see it's not working, yeah, then you close it out. What is the major difference between MetaStock and TradingView? MetaStock has, TradingView is just more of a charting service. It's a good charting service, but MetaStock is a good charting service with tons of other indicators on there that improve your trading. I don't trade the pairs. I'll buy the dollar, or I'll buy the British pound, or sell the Japanese yen. I'll just use it off that chart instead of trying to combine two of them. George, on a J-hook pattern, wave 1 and wave 3 are usually going to be approximately the same. On a fry pan bottom breakout, it's going to be a strong price move. You just hang on to it until you see a candlestick sell signal. But these are the type of things that we teach in our chat room every day. The chat rooms are open all day long. Then I do training sessions for members on Monday night. There's free training on Thursday nights. So if you just come to our site and go to stock chat on a Thursday night, you get a kind of a sample of what we're analyzing, what the market's doing, what commodities are doing well, crude oil, gold, or whatever, and then which sectors are acting the strongest. And then you can even fine tune that by going to the strongest stocks in that sector. So I've used up too much time, haven't I, Jeff?
Well, we are running out of it, but
okay.
You've done such a great job. I was looking for a comment up there a little bit earlier, but there's so many questions that are coming in. But someone's like, this is amazing. And I think you did a really good job, Steve. So thanks for coming in. One of the questions we get a lot of, I'm going to talk about, though, and that is how to run explorations with MetaStock and, how that works. And I really appreciate the question about what makes MetaStock different, because scanning is such a huge thing in MetaStock. I mean, I'm going to show you a little bit of a demo of how we've integrated this with Steve's product. Let me go ahead and make myself the presenter, and I'll just kind of get rolling here. Let's see. All right, go ahead and show my screen. And you should be able to see both me and my screen. So there you go. This is just basically the Dow this morning using the CPS. But before I kind of talk about the chart, what I want to do is actually just talk a little bit about what's included in the add-on and kind of give you a view for that. This is one of our most popular add-ons for MetaStock. And I think if you just spent a little bit of time listening to Steve, you'll understand why. But here's a list of all the patterns that we have coded into MetaStock and created on behalf of Steve. And you can kind of see that it has the fry pan in here, the belt hold, the doji best friend, the doji at the top, the series of dojis. There's a huge amount of patterns here. And in addition to all those multiple day patterns, there's a whole bunch of single day patterns that you can see here is the doji, the bullish engulfing, the bearish engulfing, and all of them have been created into the add-on that we've created for MetaStock. So what that means is basically, let me just show you what it means. I'm going to go ahead and kind of go into MetaStock right here. I've applied his indicators, I've applied the template, I've applied basically the expert advisor as well. You'll notice like right here, we had a bullish engulfing pattern. Here we had a left-right bearish combo. Here we had a bear kicker. Here you had a bear kicker. And all of those patterns are going to be identified for you on the instrument. So for whatever stock, whether it's a currency pair, a Forex, oil, whatever it is that you happen to open up, it's going to look for, and it'll identify these patterns for you automatically. Right here, yesterday, you'll notice that there is a bull kicker. I'm just going to go back one day and just kind of show you what it tells you when that particular pattern happens. So right here, I just moved that. You'll notice there's a commentary arrow right here. This little triangle is pointing down. That means we're looking at May 5th. They're basically saying the bullish kicker presents a consistent trading opportunity for long positions. This signal is made more powerful when it forms at a major support level. The darker the candle at the bottom is, the more powerful the reversal. Your exit strategy should be spiffed upon enemy trading below the open of the previous day. So not only is it identifying the candle for us, it's giving us a bit of a definition in terms of what is going on with that. There's some enhancements. If you're looking at the enhancements, what it's going to basically help you understand is how to do it. Now, one last thing, I just noticed we're completely out of time, but one last thing I wanted to kind of talk about is scanning with MetaStock, because a lot of our partners say that scanning is the most powerful part of MetaStock, and I would agree with that wholeheartedly. I run scans every single day. If I wanted to run a scan for any of those patterns that were on that PowerPoint, I can come into the scanner here in MetaStock. Here's the Doji Dynamite. So this will include, like, I'm just reading them off the screen for you. The Doji at the top, the Doji Best Friend, the left-right bullish bearish combo. I'm going to run that against the S&P 500, as you can see here. I'm going to go ahead and start that as an exploration, and it's just going to chunk through all of the S&P 500 stocks, and it's going very, very quickly. It's just going to identify and bring me a list of the stocks that have any of those particular patterns today. We're going to be talking about scanning and how you can use scanning with any market on earth. But really, I love it. It makes it so easy to find those opportunities. A lot of questions that have been coming through from, like, Richard actually asked a question. Somebody asked a question also in here, is how do you find these opportunities? And just by running that quick little scan, I can tell you that out of the 500 stocks that we scanned, Constellation Energy, Cognizant, Rockwell, and AES, all of those stocks had a bearish left-right pattern. So, and you can see that right there on the chart. We can then open up those stocks and kind of see them. And we just did a chart of the scan of the S&P 500 so that it would run fast. You can scan any markets that you want. So very, very proud of this add-on. We spent a ton of time. I think it was like 18 months getting it ready, but it includes 6 explorations, the expert advisor, the layouts, and then all of those 36 patterns. It includes the commentary, the scanning, all of that kind of stuff. It's such a, it's been one of our most popular add-ons ever since we've released it. It's been reviewed in Stocks and Commodities a couple of times. It's been rated very, very highly by Dennis Peterson, as well as Barbara Starr, as well as loved by so many different customers. So we only charge $399 for it. Well, normally it's $499. I think it's underpriced in terms of the amount of the times I've used this over the last decade or so. We are on the second version. But here at the conference today, we're going to be doing $399. And we even have another special. We actually sat down with Steve. It was this year. We did a boot camp where we did market trend analysis. Actually, no, I was wrong. It was December 6th of last year was when we did when we kicked off all the training. But we did a big series where he did a market trend analysis, the most robust trading entry setups, 6 trade entries, when to close a trade, confirming indicators. And so he did basically a very extensive 10 hours of recorded training that we can kind of get access to as well. Plus a 1-hour video where I just show you how to kind of run the scans and how I like to set everything up. Normally that's $899. It's here at the webinar for $499. And if you're brand new to MetaStock and you want to do both of those, we have the Candlestick Forum Pack. So the Candlestick Forum Pack is going to include the Candle Profit Systems 2.0, that training bootcamp, which is over 10 hours of recorded training that's done by Steve, the bonus recording from me, MetaStock Real Time, which is a free month of our award-winning software program. MetaStock's been rated #1 in its price category for 30 years in a row. You'll get Zenith, which is all the market data that you need to power everything. We will give you a free month of that. Normally, that package is $1398 here at the conference. Today, we're going to do $698. And so you can do that a couple of different ways. If you go to metastock.com/candlestickforumd, you can sign up for it there. You can also go give us a call at 800-882-3040, or you can visit us at metastock.com/saleschat. So there you go. It's a very, very cool product. You should try it out. It's one that I keep using over and over and over again, and with the scanning and that kind of stuff. Very, very helpful. So I know there's questions that I've missed. I'm going to answer them in the chat in just a second. So sorry about that. We're just a little bit behind, and I want to keep us as much on schedule as possible. But before we go to the next feature, who is also really, really good, I do want to say thank you to Stocks and Commodities Magazine. Stocks and Commodities Magazine has been a sponsor of the MetaStock events, like our Traders Conference, our Traders Summits, ever since we started doing them 10 years ago, and we really appreciate their support. We really appreciate kind of everything that they've done with us over the years. You can get as a member or a subscriber, I guess would be the right question. You can get 17,000 trading articles. They've been publishing since 1982. They've got 1.3 million active subscribers. If you do any offer today at MetaStock, you'll get a 5-month subscription. And if you spend $300 or more at MetaStock today, we will actually give you a 2-year subscription. Actually, we don't give it to you. Stocks and Commodities does. So I want to say thanks to Stocks and Commodities for sponsoring all the events. They're a really good sponsor. So, and of course, we're MetaStock. To find out more about us, we'll be talking about us all day. MetaStock.com/conf-promo. So our next guest is Vince Vora. Vince is another really, really good technician. I love Vince. I love the ability that he has to kind of talk about things and simplify things. And when he talks about something, I very, very much understand what he's looking for, what he's trying to say. He's a very, very good teacher. In addition to that, he's a super good technician. We've written some very, very good add-ons with him, and he's a super good technician. So, Vince, let's go ahead and bring you on here.
Good morning, Jeff. Can you hear me?
Good morning. I can hear you.
How are you?
I'm doing great. Let me go ahead and make you the presenter here.
Okay. I'm just going to try to turn on my camera and join you here.
All right.
There we go. How are you? Good to see you. Excellent.
I'm good.
Let me share my screen.
Okay. All right. I'm going to get out of the way. We can see everything. We can hear you.
Excellent.
Thanks for coming in here today, Vince. It's all you.
Great. Thank you again for inviting me. MetaStock, everyone there has been great to me over the years. And I'm happy to join all of you today. Thanks for coming out and spending some time with us this morning. Today, I want to talk to you about our victory method. As Jeff said, I'm Vince Vora, I'm the head trader here at Trading Wins, and I'm not going to spend much time on my bio or any other slides. I've been doing this for a very long time. All I'm going to say is trading can be difficult, but it doesn't have to be, and I'm going to show you how you can simplify today, but please don't trade with real money until you are completely comfortable with the system that you're using. So, let's get to the charts and talk about the markets. And I know most, if not all of you, have come here to learn about technical analysis and the different tools that MetaStock can provide you with. So I'm going to do a bit of both. I'm going to start off with the 4 things that you need to be successful in the markets, or is to be a consistently profitable trader. 2 of those things are taken care of by the market itself, and 2 are your responsibility as the trader. Then I will show you what victory is, what these arrows and circles are doing, and then how exactly I use it to trade the markets on a regular basis. So when it comes to those 4 things that you need, the 2 that come from the markets itself are trend and momentum. Okay, we'll talk about how you identify those in a second. But it's pretty easy when you look at a chart, and as Steve Bigalow just told you, the charts is really all you need. They tell you everything. When it comes to the markets, a lot of people have opinion. You have analysts out there with forecasts, economists with forecasts, etc. It's great to know that stuff or listen to it. But what you're seeing on the charts are not opinions. They're not forecasts. They're actual money, real money transactions. So it's what's actually happening now. Whether you're looking at a particular stock or an index, these are real trades. These are people putting their money behind those opinions. So what you see here is all you need. Now, the market, there are times where it will be trending and trending with momentum, right? Very clear, very obvious buying through this stretch. That is when trading is very easy. And I'll show you how using victory can make it even easier for you. When things do not trend, and I want to show you particularly here on the SPY. This is the SPY, which is the ETF for the S&P 500. The S&P 500 is an index that's used by just about everyone around the world to gauge the overall market trend. if I go back to this bar here, and I'm on a weekly chart, but I want to show you, I'm hovering over it so you can look at the date, right? This is the week of April 29th of 2022. So the first week of April, basically, of last year. So that's one full year. And look at the close price there. You see the close price? 412. Where are we today? 412.50. Okay, pretty much the exact same level. This market has done absolutely nothing for one full year. This is about the toughest trading environment you will ever run into. Most people think it's, downtrends or sell-offs. No, those are easy to make money in. Just about anyone can make money there by shorting just about anything. It's these range-bound markets that are extremely difficult to deal with. They're very volatile, and this is where most traders lose their money. So if you've been having a tough time recently, don't kick yourself. Understand this is one of the toughest markets, and what I'm going to do for you today is try to simplify things so you can navigate your way through this type of market and then absolutely kill it during strong trends. Okay, so trends and momentum. How do we identify those? The trend, easy. Higher highs, higher lows. As you know, the market will move. It will then pull back. Sorry, just trying to draw this out for you. There you go. And then it'll continue moving higher, right? And then pull back a little. So a zigzag motion, and it works the same, during an uptrend, and the exact opposite during a downtrend. But when we talk about pivots, higher highs and higher lows, what we're referring to is this is a pivot high, those turning points, right? Wherever you see a turning point, that's a pivot. So that's a pivot high. This here is a pivot low right here, right? And then you get another pivot high here. And eventually, if we pull back, we'd get another pivot low, or a continuation of this move. We then get a pivot low, right? So when you're comparing one pivot high to another, you can see that during this move, we have higher highs, right? This is one pivot high. This is a higher pivot high. Low, we have this low here. When we compare it to this, we have a higher low. So if you have higher highs and higher lows, that means you have a trend upward. And if you have lower highs and lower lows, that is a trend lower. That is all you need. And so you can look at that on any time frame. I'm on the weekly here. Doesn't matter. You can look at a daily, monthly, 5 minute, 1 minute. It doesn't matter the time frame. Everything that I'm going to show you works exactly the same on all time frames. All right. Now, momentum. How do you judge momentum? Well, very simple tool. All you have to do is put a moving average, a simple period moving average. Now, we use the 20 period simple moving average. You can use exponential. You can use a different period. We like to use the 20. Why? Because it is one of, if not the most heavily traded or mostly used moving averages by both retail traders, such as you and I, and professional traders. So there's a lot of eyes on the 20 period MA, and that's why we use it. When it's sloping, you know that there's momentum behind that move. Okay, now it needs to be sloping in the direction of the trade. So if you're going to trade this to the long side, you want a slope higher. If you're shorting the market, you want a slope lower. Now, the degree of slope obviously means a lot as well. You can have a slight slope like this, more slope, or some very significant slope higher. The higher the degree of slope on that moving average, the better. Why? It's simple math. What this does is it looks at the last 20 bars and it takes the average. So if this line is being plotted candle after candle higher than the prior one, obviously price is moving higher. And the higher the degree of slope, the quicker price is moving higher, which means more buying, right? So, and again, the opposite is true to the downside. So the market will give you the higher highs and higher lows. The market will all the buyers, when they all come together, will create the momentum. All right. What you as the trader are responsible for are patience and discipline. Okay. What do we mean by that? And they're easier said than done. But again, once I'm done with this explanation, I'm going to show you how victory will take care of all four things for you on its own and do everything for you. Patience and discipline. Why do you need patience? Because there are times when you should not be trading, or at least scale back your trading, or even better, wait for the best of the best trade setups. All right. A lot of us get over anxious. We want those profits. We want the action. And, we get sucked into trades that we probably should not be in. We want to be patient and wait for the best of the best setups. This year has really tested our patience, But if you can get through this, once a new trend starts, boy, oh boy, will it pay off in spades. And discipline comes in when you have a set of rules, which you should have. If you don't have a set of rules, you're never going to be successful at this. Before you take any trade, you need to not only know why you're entering, or have a set of rules for your entry, but you also need to know how you're going to manage that trade once you're in it. Okay, where are you going to take some profits? At what point? Where are you going to exit if it doesn't go your way? You need to have all those answers before you ever enter that order in the first place. And so you need to have the discipline to follow a set of rules. And the reason why I'm saying victory does all of this for you is because it makes it so simple. It's so simple. There's nothing here but these arrows and circles and the 20-period MA that we use for momentum. What you see on here is all you're going to be using. No other indicators, no nothing. And with the expert commentary tool that will guide you once you're in the trade and help you trail your stop, all of that done for you. I will show you all of that. The scanner that comes with this that will identify trade opportunities on any time frame you want, as many times a day as you want. It's all there for you. So let's talk about victory and tell you what these arrows and circles mean, etc. here. So obviously an arrow is a new trade setup. So if you see a green arrow, it's indicating that it is time to get long, whatever that underlying instrument is, whether it's an index like the SPY or an individual stock like Apple or Microsoft, etc. And I should say, this is based solely on technical analysis, works on any time frame, any market, any exchange around the world. We have tested this in the US, obviously, Canada, Australia, UK, India, you name it. It works across the board because it's based on simple technical analysis, nothing else. And it works on any time frame. But you can use it on commodities, right? Forex, futures, options, trading, whatever you want. Now, getting back here. So if it's a green arrow, it's a long trade. If it's a red arrow, it's indicating a short trade. The circles are the exact same as the arrows, but the reason why they're printed as circles here, or dots, is because we're already in a trade. So for example, we get in long here and you see the green dot appear. It means that the same criteria that told us to get long here has come together again. And it's telling us this is again another area that is good to get long the market or this market. Okay. And that could happen several times throughout the life of a trade. So what we like to do is get in here and then add to our position here, add to our position here, and then exit when it tells us to exit. Now, the exit can either be a direct exit flag or a change in color. Okay. Now, the point here is not to take every single symbol that you see on your chart. Okay. When you start using this add-on, you're going to receive a couple of different training modules with it that will go into detail explaining exactly which trade you should take, which one you shouldn't, and comparing different setups, how we go about comparing setups. But I'm going to make it very, very simple and quick for you here today. What we're looking for when we're entering an order are three things using Victory. Obviously, we're looking for an arrow or a dot or a circle, right? And again, green means to go long, red means to go short. Secondly, we're looking for the price or that current bar to be near that 20-period moving average, okay? And lastly, but probably most importantly, we're looking for that 20-period moving average to have a slope in the direction of the trade. And again, the higher the degree of slope, the better, okay? So if you see a long here, right? For example, this has 2 out of the 3. You have the arrow, you have the price being near the 20, but is the 20 sloping higher? No, it isn't. It's actually slightly sloping lower. So we do not take that long trade, okay? We only want the ones where all three things are there. So red arrow, meaning short trade, right? Price near the 20, yes. And is the 20 sloping lower, sloping in the direction of the trade? Yes, it is. And that's when we take that trade. If you stick to those three things, not only will you have many more winners than losing trades, but what you should experience is your losers will be much smaller than your winners. And that's the kind of math you need to be successful longer term. Okay. So don't get sucked into trades that do not have all three of those things. If you're more aggressive and you want to do that, by all means. If you want to add other indicators to it, that's all on you. You can. What I'm telling you is you don't need it. Okay. A lot of years of experience went into identifying these signals. And the reason why we put this together is because it is extremely effective and works consistently. So let's go through a few examples. Now, I should say, again, there's the odd time you see a yellow bar here or a candlestick. You can use candlesticks. You can use open, high, low, close bars, whatever you want. I use open, high, low, close bars. Yellow bars mean you should not be long, nor should you be short. You should be out of the market, okay? So sometimes when we exit a trade and it immediately goes into yellow bars, it means there is no other signal yet. So we need to wait. Good news is they usually only last 1 or 2 bars, and then we're back in, okay? So now, if you're more of an investor and don't have time to watch the markets on a regular basis, etc., you can use Victory. Again, same 3 criteria. Okay, you're looking for an arrow, in this case a buy. You're looking for price near the 20, and you're looking for slope in the 20. Okay, if that's the case, you can buy your stocks, sit on it, let them appreciate, collect dividends, whatever you want. If there's a color change, if we go from green to red, you exit completely, the full position, okay? Whether you see a red bar, a yellow bar, or an exit flag, you're out of there immediately. Now, doesn't mean you can't take profits along the way. And during those training classes, we will show you exactly how to do that as well. But there are times where you get into a trade like this, and it just goes your way. It's just a beautiful runner like that. You never know when it can quickly turn around on you. So you take profits along the way. And when you see the change in color or the exit flag, you're out of the full position. All right. It's that simple. But let's say you're just a regular day trader or a swing trader like I am. Okay. I use mostly the daily time frame. And I stay in trades a week to 2 weeks. It depends on the trade. But I can use the monthly chart and the weekly chart for some guidance, meaning what I'm looking for is a trend one way or the other with momentum. So if we were during this period here, when I go back to the daily time frame, what I'd be scanning for are long trades. Okay, the overall market is heading higher. I'm looking for long trades. I'm looking to trade in line with the overall market. Okay. If the market is in a short or a downtrend, I'm looking for short trends on the lower time frame. If we have a sideways market, then it's not an ideal environment. But what I'm doing is going back to the lower time frame, but I'm making sure that I am following those rules religiously, meaning I'm looking for those three things and I'm not settling for 2 out of 3. You have to have all 3. You have to have the arrow, you have to have trade being near the 20, and you have to have a significant slope. Now, during times like this, when it's just a choppy sideways market, I'm usually looking for a higher degree of slope than normal. I want to make sure there is a ton of momentum, and you'll be in the trade for a shorter period of time. So as I'm going to flip through some charts, and by all means, put up some symbols if you want. If you want me to look at certain markets, by all means, we've got plenty of time here. I'll look at as many charts as we can. But as I flip from one chart to another, what I'd like you to do is focus on those signals that have that slope, because those are the only ones you will be taking. Are there moves that we're going to miss because of that? Of course. For example, when you had the SPY moving up here and then it turned around and we exited that long, okay? It again tried to get another long trend going and couldn't. And we had this big bar here with a red arrow. So A, we were not near the 20 because we closed all the way down here. And B, we had no slope at the time. Now, did it move lower? Yes, it did. So we missed that opportunity, didn't we? But we don't care. And here's why. 9 times out of 10, you enter that trade up here, and I shouldn't say 9 times out of 10, but the majority of the time, it won't work out very well for you. What we're trying to do is make trading easy on us and play the odds. So what we want to do is put the odds in our favor so that we can make money on the majority of the trades that we place. We know there's going to be losers. No system is 100%. Victory certainly isn't. Okay, you will have your losses, but what we're trying to do here is keep our losses small. Okay, let our winners run as much as possible. And when I show you the expert commentary, etc., you're going to see how the victory add-on helps you do that. But we want to take the best of the best trades. And that's why we're willing to give up a little bit of that move and wait for the ideal condition to enter. And so, yes, we would have missed this one, but boy, we would have caught a nice run in here. We would have added to it, caught a lot more here. And along the way, taking some profits and then eventually exiting the full trade. Okay, that's what you want to do. I see Carolyn, Gary, Robert, Wendy, all with symbol suggestions. Let's start going through them. So Chewy is one, and that was from Caroline. Thank you very much. Let's look at Chewy. And if there's a specific time frame you want to look at, by all means, type that in as well. But when we look at this chart, right, there are periods that are very, very messy, like back in here, okay? The good thing is that if you follow those 3 rules, you will skip most of those entries that would have been losses anyway. So, for example, you take this green one here, and did we have slope in our favor? No, we did not. So we would have skipped that, right? This red one here. Now, again, you could say it moved, but if you go back and look at where the exit was, it was actually higher than where the entry was. So again, that would have been a loss, but a loss we would have avoided because we had no slope downward at the time. We didn't take it. So when you get into one of those chop zones, those consolidation areas, victory is going to keep you out of most of those if you follow the rules. But once we start to trend, that's what we want. And there will be trends that are so strong that you won't even get a pullback to the 20 and another entry. Now, as you get better with technical analysis, as you get more and more sophisticated and experienced with it, there are other types of entries you can take, and we will share those with you in our training sessions. For example, when you have a consolidation area, right? You mark it with your trend lines. You mark the highs, you mark the lows, and you're looking for a breakout. So like here, we were already supposedly in a short trade. Not that we were, because we wouldn't take this entry. There was no slope in the direction of the trade. But Victory's telling us we should be on the short side of this market. Once we break out of this channel, we break out to the downside, you're free to jump in there, right? It's just that if you're not very experienced with technical analysis, you wouldn't know that, or you wouldn't know exactly how to handle that. So it's easier if you wait for the next proper signal. Okay. But during the training classes, we will cover things like this as well. So we take that drop and then we turn around. And now, as we start to slope, now we can look at these entries again, right? We have a green dot. It's the same as a green arrow, same formula behind this, same algorithm. Are we near the 20? Yes. Are we sloping? Yes. So we jump in and it moves great. It pulls back. Now, this one's a little questionable. Do we add? Do we not add? That's, again, how aggressive or conservative you are. I am extremely conservative. I hate risk. So this would probably be one that I would skip, meaning I wouldn't add to it. I'm still long and I'm ahead on this trade, but I wouldn't add to it only because it's a little further from the 20. So it's not as ideal of a setup as it could be. I let this continue. Again, here, do I add to it? Again, we're a little further away, so I probably wouldn't, but many of you probably would. You move up, then suddenly it turns around on you and it indicates an exit and you get out of your full position. Would you have made money here? Absolutely. And that's all that you should be concerned with. So, if we look at Chewy on a higher time frame, on a weekly, for example, again, the higher the time frame, the smoother the charts, right? So if you have the patience to stay in trades longer, I highly suggest you look at the weekly or the monthly charts, because boy, oh boy, when you catch a trend, it is wonderful. And so again, look at this trade, look at this trade, look at this trade. All the criteria that we talked about, those three things are there, and it's just a nice, easy run that we can take advantage of. And you don't need many of these to make your year. Let me tell you, when you go back and look at a full year's worth of trades, what you're going to find is that a handful of them made 80% of your profits. You don't need many. But here's the advantage with Victor's one. I'm going to show it to you in, maybe 15 minutes or so. I'm going to show you the scanner. And the scanner allows you to not only look for opportunity, but it allows you to also judge the amount of slope that you're looking for on that 20-period moving average. There's a slope calculation in there that is going to allow you to really look for the best of the best trades, okay? And it's a real advantage. So the other thing you should know about technical analysis is that when you get a strong move, the stronger the move you get, the less support it leaves behind, meaning once it turns, it usually retraces that full move. So not only do you get to take advantage of it to the upside, but once you can confirm that it's turned around, you start looking for those entries to the short side, and again, you profit on the full ride back as well. When you go into a channel like this, you don't want to take these symbols. Look, if you went short here, you'd be out here, you'd have a loss. You go short here, and you're out here, you have a loss. You go long, and you're out short here, you have a loss. So all of these would have been losses. But if you follow those three things I just told you, meaning you have an arrow, right? You're near the 20, yes, so you have 2 out of 3. But is the 20 sloping? It's not. So you skip it. And the 20 sloping would have been the reason to skip every single one of these trades. So you will completely avoid the sideways action, but you take advantage of the trends. And that's what you want. If you're trading with trend and momentum on your side, trading becomes so much easier. And then with the tools that MetaStock gives you here, not just the add-on to show the entries and exits, but when I show you the expert commentary, and it allows you to trail that stop, and then shows you the scanner where you can identify these quickly, it all comes together nicely. Let's look at a few more of those symbols, and then we'll try to get to some questions, because boy, they're coming in pretty quickly here. Let's look at Tesla, because I know it's a popular stock. Wendy was asking for it, but a lot of people want to look at Tesla. So, you look at the weekly chart here. Yes, there's the weekly chart. And again, it smooths it out. You can quickly tell when you should have been trading and when you should not have been trading, right? This one here, no brainer, right? You're near the 20, you get that green dot, and you have slope. You actually would have taken this one as well. You also had slope here, okay? You just had a higher degree of slope here. So you would have caught this full move right here. And we're not talking about a small move. If you're looking at this, the close on this candle was 50.25. So it was a $50 stock when you got in, and you exited here when it closed at 199. Okay, it's a 3-bagger, 3x your money right there. Just incredible. Do you have to hold through the whole move? No, you don't. Can you scale out along the way? I would actually recommend, and we'll show you during the training how to do that. Do you want to trade during the choppy part and lose money? No. Another thing that a lot of traders don't realize is that not only are they losing money during the consolidations, these sideways movement areas, but it's dead money. Even if you don't lose money, if you just hold through it all, it is dead money. Your money could have been earning you something somewhere else on some chart that actually had a trend. So even for investors, for those of you who just park your money in a retirement account, buy a few shares and leave them for the long term, only stay in them if there's a clear trend with momentum. When there isn't, get out, put your money in a stock or in an index or bond fund that is actually trending. Don't stay when it's dead money. Okay, it'll multiply your gains over the years, many times over. Let's have a look. Prakash says, asking me what type of chart this is. This is open, high, low, close bars. Again, you can change to. So you can change the candlesticks, right? It doesn't matter. There we go. We can put on regular candlesticks. It's going to work the exact same way, and so it really doesn't matter. I prefer open, high, low, close bars because it just keeps my chart a little cleaner. And I'm not, I'm letting victory tell me when to get in, when to trail my stop, when to get out, etc. I'm not looking to read every little movement on a candle. That's how I remain disciplined. I forgot to mention one thing that might have become obvious to most of you by now, but when you're in a trade, you notice how every single bar is green once we get into this long trade, and then when you get short, every single bar is red. That's not because it's going up every day or going down every day. It's because that's part of the design here from MetaStock. That was done with a purpose to help you remain disciplined. If you look at this move, you get in normally, it's great. But once you start getting a few red candles coming in, you start questioning yourself and you start wondering, am I about to give back all those profits? Should I get out? And that usually scares people out of the position only to see the stock turn around and continue going higher. Okay. So we paint them green for a reason. We paint them red for a reason to help you remain disciplined. Let's look at a few others. Who was it here? Robert wanted Johnson & Johnson. And I apologize if I don't get to all the symbols. There's going to be too many to look at. And here's a great example. Okay, thank you for bringing this up, Robert, whether you meant it for this or not. When I see a chart like this on a higher time frame, like the weekly, and you see that it's back and forth, it's really hard to read, right? If you're going to look for higher highs, higher lows, et cetera, those pivots, it's difficult to read. And I have decades of experience reading charts. I can spot pivots very, very easily. This chart doesn't make it easy. When I see that, I immediately flip to another chart. I don't want to deal with something that isn't trending strongly. Now, Doesn't mean that I can't do so on a different time frame, but it's just very difficult. If you look at Johnson & Johnson here, even on the monthly, has it been moving higher? Yes, but it's been going back and forth, big range bars back and forth. So you're up big one month, you're down big the next month. You're up big, you're down big. It can really, really test your patience, really scare you out of the market. It's a tough way to make a living. Now, doesn't mean that on the lower time frames, you can't pick out part of that move within each bar, right? So if you're a day trader, you're not really going to care about this type of look on the monthly or the weekly chart. If you're a swing trader like me or a longer term investor, you should care very much. But, let's bring this down to a 5 minute. And most likely we're going to see a mess, but there are times when it's trending, you see? So this is what you want to look for, regardless of whether you're on a 5 minute chart, a 1 minute chart, a 1 hour chart, a daily, weekly, month. You want to look for the same three things, okay? Only look for trades that are trending. But when you come across a choppy, ugly chart like J&J, finding those ideal setups is going to be difficult. So start with a nice, clean looking chart. Let me give you a hint as well, that the market, like an index like the SPY, right, is made up of the S&P 500. There's 500 of the biggest companies in there. Now, those companies will be from different sectors, right? But sectors come in and out of favor. So at times, you'll hear, well, oil is moving, so the energy stocks are moving, right? Other times it's financials. Well, the banks, there's something going on with the banks. So there's either going to be a strong downtrend on financials or a strong uptrend, depending on what those banks are doing. So sectors tend to trade, very smoothly. So if we look at something like an ETF for a specific sector, so the communication sector comes to mind. Now, keep in mind, this is a 5 minute chart, okay? And I'll show you why I'm showing you this. On a 5 minute chart, you see how nice and smooth the price action looks? Look, this was a nice, clean, short trade right here. Look at the slope on the 20. We had the red dot. We had price near the 20. Nice slope, and off it went. Exit here. Nice, easy trade, right? Profitable. We turn around. Here the 20's flat. Do I get in here? No, I do not, because I'm conservative. I want the ideal trade setup. So I wait. Now we get a dot. Okay. Is the price near the 20? Yes. Is the 20 sloping? Yes, I get in. I add to it. I add to it. I add to it. And I'm out. Nice, easy trade. Why is this nice and smooth on the 5 minute? Probably because if you go to a higher time frame like the weekly, look at this trend. And remember what I told you about when you get a very, very strong trend going north and it leaves very little support. So when the trend is over, everything goes south, right back to the start. It retraces that move. Look at how many entries here. 1, 2, 3, 4, and you exit, right? You skip this one. Why? There wasn't any slope. Do you take this one? Yeah, you had slope. 1, 2, 3, and you exit. You get back in. Was there slope here? Yes. You get in. There you go. Again, you get in, and you're out right near the bottom. This isn't rocket science, but you have to gain an edge if you're going to beat this market. You have to do and wait for those few little things that give you an edge. And victory helps you identify those, okay? Let me show you those couple of other tools quickly, the expert commentary and the scanner. Then I'm going to try to come back and hopefully we'll have time to answer all your questions because there's many of them there. If you go to the top left of your MetaStock platform, click View, and come down and click Expert Commentary. It's going to bring up this box. Now, you can dock it on any part of your chart if you want. But what this is going to do is tell you a bit about myself and Trading Winds and a bit about the victory system. But what it's going to do is put a little triangle on the most recent candle. If you look here, there's a little green triangle here above the most recent bar, today's bar, or this week's bar in this case. It's a weekly. Okay. It always defaults to the most recent bar, but you can move it around, and you can do so by clicking above one of the candles here, okay? Or using the arrows here on the expert commentary window where you can move that bar. You see it's here. I'm going to move it forward. Okay. There it is. And now it's over where the circle is. I don't know if you can see it on your screen. It's right here. Okay. So when there's anything of significance, like an arrow, like a dot or an exit flag, etc., it's going to populate some extra text here. And it will do so in the same color as the current trade that you're in. So if it was any time in here, it would be green text. Anytime here, red text. And it's giving you instructions. It's telling you at this point that victory is currently signaling a short sell re-entry. Okay? So it'll refer to the arrows as entries. It'll refer to the dots as re-entries because we're already in a trade. Okay? And then it'll go on, and if you're an options trader, it'll give you some guidance as to what type of option you might want to look at, you know, how far out of an expiry, what kind of delta, etc. But the important thing isn't here because we can tell by the dots and arrows when it's time to enter or exit. But what do we do once we're in there? So as every new bar develops, okay, this little triangle will move to the next bar and it will give you instructions. So not only will it tell you what kind of slope you're in, but here's the important part, the trailing stop level. So if you can't sit in front of your computer, you have a full-time job, a family, you have other things to do, you're going to enter your order and walk away, okay? But you feel a little uncomfortable about, you know, just walking away. You want a stop in there. You want to know what stop you should use. The level is right here. Okay, see 70.82. So it's telling you if it trades above or closes above, actually, if it closes above 70.82, you want to be out of there. Okay, now we go to the next day, right? The next day, it moved even lower. So what does it do? It moves our stop level down. Now it's 69.94, etc. So it is going to help you trail that stop all the way through. And then if another red dot shows up, it'll tell you, again, here's another re-entry opportunity, etc. So it'll hold your hand throughout the whole process. Remember, I told you need patience to wait for those ideal conditions, but you need discipline to follow the rules. The candles all being colored one color helps you with that. Having the expert commentary here telling you exactly what to do along the way makes it that much easier. All right. So the expert commentary is a huge tool. Now, the other thing is if you go to the top left and you click on the letter P here for the power console, this is where you can scan for it. So what you want to do is go down to the third tab on the left, Explore. And you want to, now I have it set under favorites, but you can have it, you can look at or pick it out under all the explorations. This is alphabetically sorted, so mine, all the Vora signals are at the bottom. So you have to scroll to the bottom and go here. Now, you're going to see that there's a Vora victory, and then there's a Vora victory filtered, okay? There's several different ones. Vora victory filtered meaning we're going to look for a certain degree of slope, okay? Once you get the add-on, we'll explain all that to you. Then you come down here, and you want to look for the what you're going to scan. So I'm going to go under index constituents here and take the 30 stocks in the Dow Jones Industrial and 100 in the NASDAQ 100. And then we go here and we search for our time frame. So I'm going to go to daily. But again, you can see here, you can search for 5 minute, 1 minute, 10 minute, whatever you want, weekly, monthly, it really doesn't matter. This here will confirm what you're searching for. So we want Vora victory filtered. And then we hit start exploration. Another box comes up and it's going to quickly run through those charts. So, so here we go. 45 out of the 125 already scanned. There we go. Now we're up to 89. In just a few seconds, they're going to be sorted. And it comes up with one. Now I was searching for, only 125 stocks. The market isn't really moving much today. But here's one, Intel Corp. Okay. So you're going to have the long and short columns. Whichever one has a number 1 in it, that's the type of setup it is. So looking at this, you can tell that it's not a long setup, but it is a short setup, okay? And then the slope, the degree of slope. Now, you want the highest degree of slope. So if it's a long setup, you want a positive number, the highest positive number possible. If it's a short trade, you want the highest negative possible number. But since this was Vora Victory Filter, we're only looking at trades with either a +5 or greater or a -5 or greater. And this is the closing price, and that's the stock symbol. So if we highlight it, we can click Open Chart, and it'll open, and we can see here on our far right, there it is. So looking at this, again, we go through the 3 things. We have a red arrow, number 1. Price is near the 20, right? That's number 2. And is there slope on the 20? Yes, there is, right? Number 3. So this looks to be a valid trade, right? Now, here's the thing I want to caution you on. That these symbols, whenever a bar is live, meaning this is the daily chart. So throughout the day, the price of Intel can fluctuate back and forth. And in some cases, greatly it can fluctuate. So what you want to do is wait for that bar to close, because throughout the day, as it moves around, this can go from a red arrow to a yellow bar to a green arrow, whatever, as the bar fluctuates. Once it closes, if it closes with a red arrow, that is there for life. So there is no repainting after, okay? But you need to wait for the bar to close. So it works the same on a lower time frame. If it's a 5-minute chart, throughout those 5 minutes, that signal can change. Well, once that 5-minute bar closes, that signal is there for good. Okay, so you want to make sure it's there. Now, you can wait till 5 minutes before the market closes, or so on. If it's there, it's going to be there. You can enter the trade if you want. But again, so there it is. And the other thing that we're going to teach you on those training sessions are the other things that you might want to consider when placing a trade. So for example, here we had 1 show up on the scan. What if we had 10? How would you choose the best of the best, right? So if they all had identical setups, meaning identical slope, etc., what other things can you look for, right? So you can look in this case for support below, right? Is it going to run into a lot of support, right? Or a lot of overhead resistance if you're trading to the long side, those kind of things. So we'll teach you all of those. But, this is the gist of it. You have a scanner that can get you some trade ideas in a matter of seconds or minutes. You have an add-on that will take care of every single step. It will identify the trend. It will identify the momentum. It'll help you with patience, waiting for those ideal conditions, and it'll help you with discipline in managing those trades once you're in it. Okay, so I'm going to turn it over to Jeff in just a couple of minutes. Let me quickly scan the questions here, and I know there's probably many more on the YouTube channel as well. But let me see. Hey, Michael, how are you? Michael's at our sessions all the time. So Dean says, can you please define the previous +5, -5? Yes. So we worked a long time, myself, Jeff, and a couple others at MetaStock, working on the so-called formula for the slope. How to identify the slope, or how to quantify the slope on the 20. And that 5, for example, the +5, it's not 5 degrees. It's what we identified as any number greater than 5 for long trades, or greater than -10 for short trades, indicates a significant slope. So what I look for when I'm trading is I want to, more or less a 45-degree angle on that line, right? But that it visually can be difficult to judge what degree of slope that is, and depending on whether you squeeze your charts in or you expand them, that could change, right? So what I like to do this is why we worked on a mathematical way of calculating the slope, and we came up with that. So that filter that we added to the scan has us look for setups that are only either above +5 or below -5, and that guarantees that any signal that we look up with that come up on the scan is going to have a high degree of slope. So it saves us time. That's all that is. Let me see. Okay. Jeff, if you're around, I'm going to hand it to you because I'm worried about the time, but I'm more than happy to stick around with questions. So I'll let you tell everyone how they can grab a copy of the indicator on their own, but I will stick around if you like to answer questions.
That's good. Thank you, Vince. I really appreciate it. One of the things I was going to mention too is I know that there was a lot of symbol requests and we have a lot of people here. If you want us to pull charts for you, we will. You just need to get in touch with us at metastock.com/sales chat, and we will be happy to send those charts over to you. So, Vince, thank you very much. I appreciate that. And
thank you.
Let me go here.
Thank you, Jeff.
You bet. Okay. I'm going to make myself the presenter here, and we'll go ahead and show the screen. And Vince does do a very, very good job of kind of showing you how the scanning works and how the expert works and all the commentaries and that kind of stuff. So I'm going to, since he does a really good job of that, I'm going to kind of jump in and just talk a little bit about the actual thing. Andreas wanted to know if there's a secret, if the formula for the slope is a secret. It isn't. I don't think we disclosed the exact kind of calculation on it. But what we're looking at is a rise and run of the actual moving average. So what we're looking at is a period of days. I think that we take about 3 sample points, if I remember right, and just calculate whether it's going up or down and by how much. And the reason Vince and I worked on that so extensively was just to make sure that we had an objective way to measure that. And so I wouldn't call it a secret sauce, but I think that's the best I could kind of talk about. Sergio says that was very interesting. Was the yellow design in the chart? I'm not sure what that question means. Kishore is what I'm going to say. So in any case, let's go ahead and talk a little bit about that as an add-on. Again, thank you very much, Vince, for kind of showing us the method and the scanning. And one of the speakers said it, or one of the attendees said it earlier, is like the ability to scan and identify these patterns in MetaStock in any market is so powerful. And again, it's one of those things that I use every day. So as part of the add-on offer, you're going to get one of our best-selling MetaStock add-ons. As you noticed, it has the detailed commentary that kind of shows you exactly where the setup exists, some options for what you can do with it in the chart. You're going to get expert alerts. You're going to be able to scan and do scanning for either the triggers, or we added the filtered scans that only show the long setups that have a positive slope or the short setups that have a negative slopes, and it includes system testing as well. And so this package here, Vince Vora tested over the years. Normally it's a $19.97 purchase price, and that's a one-time cost. So you pay for it once and you own it for life. Here at the event, here at the conference today, we're going to do a one-time price of $9.97. That's going to include a bootcamp class. Vince sat down and actually recorded 2 bootcamp classes where he talks about how he uses it, how to run the scans, so like the specific setups that he likes to look at, how he likes to identify support and resistance on a chart. Did a super good job at that. In addition to that, Vince has started throwing in a year membership to his Trading Winds Pro membership service. And with that service, you get videos every week. They do a bit of a session every week. They do a webcast. He does 3 recorded videos every week, and you can kind of get access to that. That service by itself is $97 a month if you go sign up for it on this website, but it's included with this. We also back it with a 30-day money-back guarantee, so you can try it. It's a great risk reward. If it's not something that's going to help you with your trading, you can get a refund, but you're not going to do that. You're going to love it. It is one of our most popular add-ons. So give us a call. You can do that by giving us a call at 882-3040. You can also visit us online at metastock.com/saleschat. And you can also go to metastock.com/conf promo. So if you haven't heard about MetaStock, maybe you just kind of stumbled across us today, I'll just say a couple things about MetaStock. MetaStock's been the highest rated software in its price category by the readers of Stocks and Commodities magazine for 30 years in a row. If you want to try out Vince Vora on our 30-day money-back guarantee, I'll throw in, or actually I should say we will throw in a trial to MetaStock. Absolutely free for you to help you evaluate the Victory app platform. So give us a call, 800-882-3040, metastock.com/conf promo, or metastock.com/saleschat. So thank you very much. Doesn't look like we have any more questions. If you have them, keep coming. One quick note before we kind of transfer over, if you're watching us on YouTube today, welcome to the MetaStock channel. I do want to say quickly, make sure to subscribe. We are doing great videos all the time. It's very helpful for the channel, and it helps you get more of our content. And so if you're liking today, the first thing you should do is subscribe. And we do appreciate that. You should also like the video and make sure to say hi. So those things all help the algorithm, and we do appreciate them. So there you go. All right, very cool. As I said, MetaStock, 30 years in a row. We've talked a lot about scanning. I think it's one of the things MetaStock does best. We've talked about scanning and the ability to scan, but you can scan anything you want to. We cover about 200 exchanges globally, some of the best data on earth, and all of the MetaStock as a platform starts at $69. So that's our end of day platform. One of the things we're going to do as part of the conference today is if you buy a month, we will give you the second and the third month for free. So if you have any questions, you can sign up at metastock.com/conf promo. You can give us a call. We've got full staff here, 800-882-3040, or metastock.com/saleschat. So I hope you're enjoying the event today. Thanks for coming. It's good to see you. I do want to highlight AAII, a brand new sponsor of MetaStock for the May conference. We appreciate their sponsorship. A couple of things you might not know about AAII, but they have been doing their nonprofit for over 40 years. They're very, very well respected, have a great reputation. They do a great job, and we're really happy to bring them on as sponsors this time. They've helped 2 million individual traders over the last 40 years. If you're curious in terms of what they do education, they do newsletters, they do stock ideas, they do a lot of research. Again, great, very well-respected organization. We'd like to welcome them as sponsors. And if you want to find out more about AAII, go to aaii.com. So there you go. Prakash, you're welcome. Thanks for coming today. All right, very cool. Our next presenter today is Raymond Rondeau. Raymond is a person that I've known. I think he went to our office in the Gateway, so it'd be almost like 10 or 15 years ago. He contacted us actually it's going to be over a year ago. Now I think it was back in February of 2022. He wanted to kind of design some of the systems that he creates into MetaStock. And I've known him for a long time. He actually works with AAII as I don't know if you'd call him an instructor or something over there, but he's very smart. He's a very, very prolific system designer, very, very well-respected technician. We're happy to have him on here today. So let's go ahead and bring him on. Ray, how are you?
I am well, Jeff. I am well. Thank you.
Awesome. I'm going to go ahead and let's make sure we get the presentation. Welcome. I didn't also mention, but this is your first MetaStock event. So welcome. I just sent the speaker over to you. Raju says, great speakers. Thank you. Thank you, Raju. It's great to have you. Okay. Now I can see your screen. I think you also wanted to share your camera yet, and that's the only thing I can't see yet. Perfect. Oh, you look great.
Unmuted.
We can see you. I can hear you. I can, let's see. The view that I do see, though, is the speaker view. So if you want to switch the screen so you can get it to the right view. I also, under display settings up there, you can actually switch it right there if you want to just display it on that screen. But we are seeing the wrong screen.
Give me a second, Jeff. Show my screen. Let's try this one. Is that any better?
Perfect. Ding, ding, ding. All right.
You're on the welcome screen?
Yeah, you're on the welcome screen. I don't see the speaker's notes. I see welcome in a lot of different languages. So, all right. This is the point of the where I just get out of the way. It's your turn.
Right. Well, thanks, Jeff. And welcome to Trade with Conviction. And I'd like to thank you guys all for attending. This presentation's focus is primarily on the concept of conviction, its theory, its application, and of course, its viability. In line with our lead, the question is, are trading strategies with a hit rate of 85% and a profit factor of 2 to 1 realistic? And more importantly, is there evidence to back this up? So for this presentation, we're going to start with some basic theory on volume, quickly advance to conviction. We'll look at 3 new conviction indicators, and then conviction systems, including performance results. And then in the last segment, we're going to explore 5 additional methods to improve the conviction systems results. And these can really be applied to all systems, including everybody else here today. As referenced, evidence-backed. Evidence-backed is important to AAII. As Jeff said, we're a nonprofit organization. We have a team of analysts working full-time developing these tools. And the primary focus really is education. And because of that, we're going to talk about the factors that make up these systems so that you can understand them. And then we're also going to supply the back-tested performance results to you to support that theory. And we think this is important, and we realize that not many people do that. With that, we literally have 98 slides, and I have about 50 minutes in my presentation, so it'll be right at 50 minutes. But you're going to probably need additional information, okay? And these videos right now that you see are AAI education classes. The goal today is to introduce you to these tools and systems to see if you have an interest in them and if they're right for you. But you're probably going to need extra education. We have our own instruction manuals, which you'll get. They're very thorough. And you also get the classes on these, and they're free. They're complimentary. If you get Conviction Plus, you're going to get all that. And the classes are very interesting. They include resources. You get the slides, tools, testing, credits for certification. They have perks, etc. And even if you don't get Conviction Plus, we have a suite of these classes, and some of them are free. So if you're interested in that, you can visit us or just contact us at ves@aai.com. The complete set of tools that we're covering today, again, is called Conviction Plus. And the Plus is an additional tool to the package that really doesn't have anything to do with conviction, but it can be used with most portfolio balancing systems. And it basically specializes in risk control. The tool is called PROVE, and it stands for Position Ratio Optimizing Volatility Engine. And it does pretty much what it reflects. Its function is to calculate position size, the number of shares for you to buy or rebalance to. So each position will have a projected similar end effect on your stock position's performance of a portfolio. The goal here is to prevent any one issue from becoming overly dominant or risk-heavy, skewing the median position's overall performance. As we don't want 1 or 2 positions to dominate, we want them to all be balanced. Now, position sizes is often confusing, and sometimes it's hard to illustrate. But here we have a slide, and some investors, not many, but a few, still try the equal share approach. And with this approach, you can see in the Dow 30 components that if you did an equal share approach, I mean, your position size would go from anywhere about $3,000 in Intel to over $49,000 of United Health. Not really balanced or what we're looking for a distribution. The next level of investor tries the equal dollar amount approach. And although it's better, it's still missing one key element. Here in this slide, we can see that on a fixed $10,000 equal dollar amount of the same Dow 30 components, that Johnson & Johnson would have a maximum 5-day loss over the last year of 5.95%, while Intel would have incurred a 21.26% loss. To attempt to offset these relationships, proof factors in the missing element, which of course is volatility, but it does so in a slightly different manner than traditional volatility approaches. Proof measures and uses downside volatility only. More accurately, it measures the percentage loss of an issue on an average down day. Okay, the percentage loss on an average down day. And this method was chosen for a few reasons. We have a little humor here, but one, it's very rare that an investor will come up to me in a show or at a conference and tell me that they just can't stand the magnitude of the upward moves. They're making so much money, it's happening so fast that we have to adjust the systems down. I mean, this is a rarity. It just doesn't happen. But the truth is, that we know that downside volatility is much greater than upside volatility. We can measure this. So the question becomes, why use symmetrical standard deviations? And we also know that good investors and traders focus on the risk, and they let the profits take care of themselves. So we want to focus on the downside to set up position sizes. On this slide, we can see the number of shares and dollar amounts adjusted for an average day loss of $50 for some of the stocks in the S&P 500. And this $50 risk level amount can be easily adjusted to each investor's needs and circumstances by changing a single parameter, as you see here in this video. Now, if you need help in determining what dollar amounts to first target, we provide 3 different methods in the AI version of the Proof Instruction Guide, which everyone will be sent. Once this value is determined, and probably one time, unless your circumstances change, Proof can then be used for both establishing new positions, how many shares should I buy, and by periodically checking the value to see if a stock's volatility or price change in subsequent value is going to warrant any adjustments. The kind of how many shares should I add or how many shares now should I remove. For monitoring and rebalancing, it's pretty straightforward. If a stock's position's number of shares are much greater than what Proof is calculating, then the investor may want to consider reducing that position size. If a stock's position size shares are much lower than what Proof is calculating, then the investor may want to consider either increasing that position size or reducing the other stock's position sizes to bring them back into relative proportion. Again, all of this is covered in the instruction guide in the education class videos. Lastly, I should add that Proof can provide whole shares or fractional values, and it evaluates stock tendencies by providing up and down day average percentage returns and the percentage of time that an issue finishes up, down, or has no change, along with some ratios to quantitate these measurements. In conclusion, Proof's purpose, to calculate position size so that each position will have a projected similar and end effect on a stock position's performance. And how do you use it? You enter the desired risk level one time, and then the stocks you want to be evaluated, 1 to 1,000, and then purchase the suggested number of shares initially and rebalance them share amounts as things move going forward. That's Proof. On to conviction in our first indicator. And here we're going to make an assumption that you understand volume basics and that you're familiar with using the MetaStock platform. I'm not going to cover that in this presentation. If you don't know what volume is, and we'll touch on it, it's simply the number of units, shares, or contracts transacted in a given time period. And we display this amount on the bottom of a chart, and we keep this simple. Our charts will always be a day. We're going to keep this simple, no intraday right now. So now that we have it displayed, how do we use volume? Well, it's believed, and it's logical, that price movements on days with relatively heavy volume are more important and relevant than price moves on days with lower relative volume. Just think of it like with a significant other, a teacher, or a boss. The higher their voice volume, the more serious or meaning the event or the message that they're trying to translate. And we see relatively heavy volume for a variety of reasons, but usually it's because of some unanticipated revelation about a security causing some type of price shock. The big boys are coming in and they may know something. We see their footprint, so it makes volume relevant. Another reason is technical events like we see here with this breach on major support in this chart at points J and K of gold. technicals have relevancy if for nothing else than self-fulfilling prophecies of the patents and the computers that are programmed to move money off of them. And don't let anybody tell you differently. Now, expanding this theory to volume and trends, we were taught that volume expanding with price moves in the same direction of the trend is supportive of the continuation of that trend, our green arrows. And similarly, lower relative volume levels and diminishing normal natural price retracements back towards the trend are also considered supportive of that trend, our red arrows. And this theory is logical, it's straightforward, and it's been around for a long time. But unfortunately, our markets have changed dramatically since these tools that plot and analyze volume were first developed. On this slide, we're highlighting several of those reasons, and they're all legit. And that's what we're going to look at now. Not necessarily a paradigm shift on the analysis technique, but adjustments to the way that the intensity is measured and displayed. And this will lead us to our scans and hitting our 85% hit rate. This brings us to the term conviction. To be clear, this is just a term that we are using, and this concept has been around essentially as long as volume has. In fact, in its most basic form, conviction is almost identical to dollar volume, with both values representing the approximate total dollars exchanged over a given time period. Not volume, but total dollars. How does conviction differ from dollar volume? It's pretty straightforward. Conviction uses the average of the bar's high, low, close, and open prices, as opposed to just using the closing price as per the dollar volume definition. And in this slide, you can see the differences in the calculation. Why do this? Because closing prices tend to gravitate to the high and low bar extremes of the day, and average price gives us a more accurate estimation of the total dollars exchanged. Note I said estimation. Why not use volume-weighted average price, or VWAP, to calculate the exact number of dollars? Because most charting platforms don't offer historical VWAP on daily bottoms to perform the calculations. And in truth, the difference in the calculations between dollar volume and conviction are irrelevant, but the benefits of using conviction or dollars over volume is not. This is a critical point and purpose of our first tool, Relative Conviction Momentum, or RCM. This is a key slide here. Here we have in the middle pane single colored volume bars plotted in the middle, and conviction dollars with the RCM indicator plotted in the lower pane. Now look at point A. Here, the amount of selling pressure seems to be increasing with the volume bars on this downtrend. And because of this, we would conclude, according to traditional theory, that the downtrend intensity is increasing and likely to continue. But when looking at the actual dollar values, true conviction at point B, we can see that the intensity is actually decreasing from a total of around $100 million per day to $80 million per day from the start of the downtrend. Yes, the volume may be increasing, but that's only because the stock prices during this period are less than half of what they were when the downtrend started. Volume gives us an intensity illusions. Unfortunately, this phenomenon has hurt many investors who have attempted to use volume analysis in this manner. It's not because the investor didn't know the rules, but it's because of this visual volume skew that occurs on large price moves, which conviction in general and RCM specifically addresses. And this obviously works both ways when prices rise dramatically. Here, with volume, it looks like the buying pressure is decreasing, when in fact only the share amounts are decreasing because the prices are now relatively higher. And it's leading us to do the exact opposite, to sell when prices are going up, and to buy when prices are going down. It's the exact opposite of what we really want to do. It's dollars that matter. Here in this chart of Tesla, we have an example showing diminishing conviction pulling back to support, and conviction giving us a reinforcing signal that the prices may be ready to turn upward. We use the same theory, but conviction just gives us a clearer picture on large price swings. Now, you also see in this slide another aspect that we designed into RCM, the Expert Advisor Commentary Reports. These reports provide a user with about as much statistical analysis on volume and conviction on both the current and historical bars as anybody would want. And for those that are new to price intensity analysis, RCM also provides written assessments and guidances to aid and interpret the important RCM measurements. And yes, it certainly displays the signals, as we can see on this chart with QQQ. And although not perfect, the primary signals, when grouped together, and you get a lot of them, which are the red or green dots, do identify general areas of short and midterm bases and plateaus. Again, multiple, grouped together, and better when they occur with the prevailing trend. Now we can see another example in this chart of AT&T, and here we can see that RCM gives a lot of primary and secondary signals if you turn the secondary signals on. So in this sense, RCM is somewhat of a better education tool, and it's not as great of a spot signal generator as our next indicator, OBC. But RCM is a superior alternative to plotting straight volume bars on the bottom of a chart. Because of this, we've built in several other enhancements that you may have noticed. RCM not only displays if the security finishes up or down, but it also adjusts the intensity of the color to reflect the magnitude of the price move. Brighter green colors highlight larger relative upward price moves, and brighter red colors highlight larger relative downward moves. And this makes it much easier to identify important price moves like blow-offs, which are high volume, large upward price moves, and selling climaxes, high volume, large down price moves. And these patterns are often seen at the start of a new trend or sometime ending an established one. They're important and we want to be able to spot them quickly. Another element that was built into RCM is shown here. At point D, we have a volume bar on the bottom of the chart, colored in green. And at point E, we have RCM, the bar is colored red. That's different. Here, RCM is displaying the return direction of where a stock finished from the previous day's close as opposed to from its open. Overnight price moving gaps in our current market environment count for a large portion of a stock's movements. We can see this at point F right here. The stock dropped 42% from the previous day close, but because it finished higher from its opening, standard volume bars would print it green. Why would we want to color it green on such a large drop in price? Right? The open-close relationship is already reflected in the candle colors up top. And unfortunately, these calculations display anomalies. They're not an isolated issue. In fact, many of the most commonly used volume-based indicators like OBV and Chaikin's accumulation distribution have similar issues, as we're going to look at next with what I just talked about, OBC, a much better spot signal generator. In conclusion, RCM's purpose to be used as a substitute for standard volume bars to offset large price skew readings. How do you use it? You evaluate price trend intensity momentum and look to see if the intensity is diminishing with an established trend and likely to pause or reverse that trend, or if the intensity is growing and the price trend is more likely to continue. As a secondary reading, look for tall, brightly colored red or green bars, as these often begin a new trend or end an existing one. And lastly, I should add that RCM can display any combination of volume or conviction or formatting from open to close or previous close to close. These are all controlled from the dialog box, so it's customizable to your needs. Our second conviction tool is OBC, Optimized Balanced Conviction. RCM looks at increasing or decreasing volume in relationship to trend, but with OBC, it does it a little bit differently because now we're evaluating up volume versus down volume, or up conviction versus down conviction. And we call, again, this optimized balanced conviction. Now, OBC analyzes up versus down intensity like Granville's OBV, or on balance volume, But OBV was created literally 60 years ago in a completely different market environment, in an era when we were using pencils and paper for calculations. There's a difference. As you would expect, OBC uses modified dollar volume or conviction, and that has the same advantages on the price skews. But OBC does something else that's very, very important. It proportions the amount of the intensity to the magnitude of the price change of the day that calculates its values. And here's an example of the calculation differences. And I just put this here if you requested the slides. I'm not going to go through the mathematics. But the point is here that with OBV, the stock could literally drop 1% or 50%, and OBV will subtract the same amount of volume in both circumstances. From another perspective, if a stock finishes up a penny, it would add all that as positive value. And if it finishes 2 cents lower from that, it would then subtract all of that as negative value. It totally disregards the magnitude of the move. It's all or nothing, and it's probably not the best approach. Now, that's an extremely simplified example that I showed, but as the percentage factors and thresholds for OBC, they are complex. I'm going to try to describe it in one sentence. Most of you won't need to know this anyway, but in a sentence, OBC proportions a percentage of the dollar volume up to a certain ATR threshold. And then it takes a linear one-to-one measure up to another ATR threshold, and then buffers extremely high readings over that threshold to prevent outlier skews. And all these thresholds have been back calculated and tested. We don't guess on what they were. The takeaway here is that with this approach, accumulated conviction is more representative of the intensity of the moves, as moves on higher volume and larger price moves are given more weighting than moves on higher volume and smaller price changes. And that differs greatly from OBV. But there's more. Here's another example, again, that we won't cover live, but this one's with Chaikin's accumulation distribution. The catch here is, with AD, it doesn't include overnight price movements. And I don't know about you, but my accounts, they matter. I'm not kidding here. A stock could lose 30%, but if the close finished higher than the open, it would count that as positive value. It only calculates from the open to the close. With OBC, it includes the overnight price action, as I think most would admit it should. We'll get off the math for a second. How do we use OBC? Like OBV. We plot it over price, and its interpretations are the same. In this chart, OBC is in white, and OBV is in magenta. The primary signal is a divergence from the price action. Now, you won't find many of them, but when you do, they're often meaningful. And for those of you who are unfamiliar with the concept of a divergence, this occurs when price and an indicator are heading in different directions. An OBC bearish divergence occurs when prices are heading upward or sideways, and OBC starts heading downward in the opposite direction. And here's a good example of an OBC bearish divergence on CLAC. You can clearly see it. Price going up, OBC heading down. An OBC bullish divergence happens when prices are heading down or sideways, and OBC starts moving upward, again in the opposite direction. Here's an excellent OBC bullish divergence on Tesla. Unfortunately, most of these are not that obvious, but I want to take a look at this a little more closely so you can see the difference. If we zoom in on this example, OBC is in white and OBV is in magenta. And in the blue square here, we have a number of down days. They're shown as dots on close, but these down days are very, very small. You can see they're barely going down. Here, OBV kept subtracting the full value, propelling the line further downward. But OBC only took a very small proportion of that conviction amount, and hence the line started upward, plotting that correct divergence that you just seen in the previous slide. Now, a critical point, OBC displays areas of potential change in trend, and it's not an absolute. And this is true with all the conviction indicators and probably all indicators in general. You always need more evidence. But OBC shows another perspective that is not apparent by looking at price and conviction bars alone. Here we have a chart in the ETF SPY, and at point A, right up here, you can see a significant divergence occurring. This is something we had noted for a while. Prices are still heading up, but without OBC support. Here, OBC clearly begins heading downward, creating a significant bearish divergence and one that correctly forecasted a 6-month decline in prices. Looking to the bottom right here at point B, we can see OBC printing a bullish divergence from the declining price trend, again, correctly forecasting a 17% intermediate term rise in prices. Now, if you're new to charting again and you're having trouble, the expert advisor will certainly help you with these. And we also plot the signals right on the chart. And you can see the signal I just gave you right there, lots of red dots. It's showing it its potential weakness in the upward trend. Start to look further into this. OBC has the assessments and the guidances in the report. Here we have a chart on Kellogg, printing another beautiful OBC divergence in March of 2022, led to a strong subsequent uptrend. And to the left, you can see in the commentary report, giving you some written guidance on that, alerting you to it. Also, if you look closely in these reports, we give you a lot of statistics, but we also have an important strength rating when a divergence is occurring, with higher positive values representing more of a bullish turn in prices from a current downtrend, and lower negative values, representing a possible bearish turn in prices from a current uptrend. Again, we need more information, but it's a secondary reading. Couple final points on OBC. There are other analysis methods that you can use with OBC, but true divergences are the most important signal. We cover these in the manual. There is other ways you can use them. If you're going to use OBC, there's a few tendencies that you should be aware of, with the most important being that bullish divergences are rarer, but they also seem more reliable. There are some general elements of OBC that you should understand. They're not difficult, but we're not going to cover them here because of time constraints, but they're very similar to OBV, which you're probably already familiar with. And lastly, for professional users, there are a number of adjustable settings to control OBC to show more or less signals, but I would use extreme caution here. I would say that probably for 98% more of OBC users, the default settings and factoring divergence will probably give you the most benefit. We just want to let you know that they are there for mathematicians and professionals. Our final indicator is kinetic conviction. And we're not going to spend a lot of time on this one, but it is a very useful tool, especially for traders. And it's one of the key elements of the conviction system scans that you probably have the most interest in and that we're going to be looking at next. Going back to our theory with volume of conviction, days of high magnitude are relevant and considered more important. But there's a caveat here, in that the actual volume of conviction readings are only relevant when compared to the issue's historical levels. They're not absolute. Here we have standard volume bars in the lower pane and kinetic conviction in the middle pane. With standard volume bars, it's not always easy to see if the day's intensity is noteworthy, or if the recent volume levels are above or below average, or if they've been above average or below average for a long period of time, right? The zero axis is static. But that's what kinetic conviction does. It helps us determine if there's more intensity or less intensity as compared to its very recent price history. How does kinetic conviction do this? It displays the conviction differential as measured by the difference between the current bar's conviction and its exponentially weighted average conviction differential. It shows the differential. It's not showing the level, okay? And it emphasizes recent conviction measurements because it's an exponential moving average. So we're looking at differentials. And then KC takes these values and it calculates standard deviations bands for determining conviction relevancy and importance. And although the description can be confusing, it's a very simple indicator to use, as you're going to see. If KC values are above the zero line, and you can see the zero line right in here, they are displaying that the bar's conviction differential is above its conviction differential average. If KC values are below zero line, they are displaying that the bar's conviction differential is below its conviction average. KC price moves with intensities values above 150, and you can see the green band right here, are considered more relevant and meaningful. The move is of greater importance. KC price moves with intensity values below -50 are considered less relevant and meaningful. They are under the lower red band, and they're probably less relevant, and you may want to question the associated move if it's really a strong move. Now, not only is kinetic conviction beneficial for single-day evaluations, but it's also useful for trend evaluations. Here we can see an example of this with kinetic conviction being combined with the same trend analysis theory as we covered earlier. Yes, prices were pulling back right here, but they were doing so on clearly diminished conviction. And then the trend began again to start resuming its path upward on stronger conviction. Again, Casey as the expert advisor in the commentary report. And it gives you one key measurement that I would say is probably the most beneficial of all the conviction measurements, and it's the KC dollar intensity. You can see it with the blue arrow. And this displays the dollar percentage above or below its exponential moving average. A value of 0 will represent that the bar's dollar conviction is equal to its average. A value of 100 would indicate that the bar's dollar conviction was twice its average. And a value of -50 would indicate that the bar's conviction was half of its average. Our last example, this one's on Tesla. And this is just another view how you can kind of see we have high conviction right here with the upward move, low conviction, and then we get that conviction breakout, which is supportive of the entire conviction profile for an upward moving stock. In conclusion, Casey's purpose: to identify if a recent move or series of moves are of significance or importance to its recent exponential average. It provides us a quick glance intensity value summarizing all the factors, alerting if a user should look more closely, or maybe there's really nothing here to see with conviction or volume at this point. How do you use it? If a bar is above the upper band, it's considered highly relevant and more emphasis should be put and added to the price move. If there are successive lower bars below the lower band, then the associated price move should be given less weight and questioned. Lastly, KC can be set to measure volume of conviction, and again, from the open, the previous close to the close, or the open to the close, we give you all of them opportunities. Now that we've covered all three indicators, this is the money slide. Here we have the recommended setup for a complete conviction view, and this template's already set up for you in MetaStock, and it's called the AI Conviction Trilogy. On the bottom, point A, we have RCM for classic trend intensity momentum analysis and for spotting selling climax and blow-offs that often start or reverse trends. In the middle pane at point B, we have kinetic conviction to highlight recent moves or moves of relative significance by plotting conviction differentials over or under standard deviation bands. On the top, point C, we have OBC that measures up day, down day conviction, or volume if you want, and its key signals are divergences showing potential areas of a change in trend. The expert advisor is set to OBC, which is probably best for investors, but it can be adjusted to kinetic conviction for shorter term traders. Basically, it's complete volume of conviction analysis in one window, and in truth, it's kind of easy to interpret once you get used to it and once you know what to look for. Now the conviction systems, where we look to validate the indicators and use them to reinforce our investment analysis. And then, of course, to generate the trade ideas in MetaStock's Explorer. Results for this study were compiled with a third-party portfolio backtesting program. In this video, you can see an example of this type of study and the amount of detail that goes into it. It's important to note we're not testing on a single stock. We're testing on 500 stocks all at once. In fact, it's a 10-year study from 2013 to 2023 on every single component of the S&P 500 at that time of the study. When the signal occurred, we said that we'd buy $5,000 worth of the stock, and we always rounded down to the nearest share. We used whole shares. And the signals were end of day, close of the day. We just wanted to make it easier. A few cautions here. I could have easily manipulated these numbers to show unrealistic returns and expectations in numerous categories. It's not hard to do. Unfortunately, with system evaluations, curve fitting, data mining, and other practices tend to be a little more common than we wish. So when evaluating systems, like with this picture, I would recommend that you always ask yourself, does everything seem right? That's why, again, we've mentioned that if you want to use Conviction Plus, we're going to give you a printed version of the performance reports for every system so you can look through them and assure that there's no trickery here, that we're trying to deduce the purest values that we can. Of course, we have no idea if that's going to project into the future, but we can see consistency of returns through our profit target lines over time, which I'm going to show you. I can't just, as an analyst, make statements, okay? I can't just say that something's going to happen 90% of the time because I've used it for years. I want it to be evidence-based. I need it to be, and you should require it if you're going to follow a system. And to do this and to create an evidence-based system, we have to validate the factors. We have to validate the factors and the cofactors that are together. We try to synergize these factors to form an efficient system. The systems that we have here, the conviction systems, have 7 total factors. And one of them is a gap, just so you know. But if you just use gaps in isolation with the exact same study parameters, your hit rate would be 57%, not the 80% when we combine and synergize all the factors together. So we test each factor, we optimize it, we make sure it stands the test of time, that it has validity, and then we try to combine these together. And that's how we do this approach, and I think that's the best approach. Now, isolating factors is not always easy, and it's rarely conclusive, but we do the best we can. This is an important slide. Here's an optimization test on conviction. Notice how every time we increase the conviction factor at the far right, the number of trades decreases as we would expect, but that the average profit, the K ratio, and the total return to the max drawdown results universally step-by-step improve right across the board. Research like this, along with the conviction scans, reaffirms the potential of conviction and is an evidence-backed viable factor. Okay? Do not anchor to the results I'm going to show you. As you're going to see in our final section, all of these systems and the results that I'm going to show you are likely being understated in performance, and they can all easily be improved, and I'm going to show you how to do that. This is critical. What you're seeing is baseline out-of-the-box results. Here's the results for the LT scan, and LT stands for long-term. Highlights are here, a good number of candidates, 1,725, and a strong 2.70 profit factor. Profit factor is total dollar wins divided by total dollar loss, 2.7 times as large. LT generated an average trade return of $240 on a $5,000 investment at 4.67% with a modest holding period of 3 months. That return includes wins and losses of $240 per trade on average. Okay, so that return is not just your winners, it's the winners minus the losers. Every trade, it was returning $240. And it had an incredible maximum consecutive win number of 51, as you can see right here. But unfortunately, it also had a maximum consecutive loss number of 14, which is the ramification of a long-only strategy having to hold through the COVID drop, which we could not change. Here's the equity curve. It did have a minor drawdown right here during the COVID crash, but it held up well over the latest bear market. So I would say LT is probably appropriate for investors and traders with a longer-term time horizon who are focused on total return and who are looking for a system to identify potential positions or even assist with the timing on a group of securities that they're currently interested in. Here's the results for the ST scan, short term. Highlights are a good number of candidates at 1714, and this is the most balanced approach. It generated an average trade return of 2.4 with a modest holding period of 34.1 days, which extrapolates very well for an annual return. Remember, it's 2.4%, but you're holding it for 34 days. Negatives, it had the lowest profit factor, although almost 2.5 to 1, well above our goal of 2 to 1. And it did have 9 consecutive losses at one point throughout in the 10-year period. Here's the equity curve. This is a beautiful, consistent equity curve with no signs of the COVID crash at all, and a fast acceleration of profits after it. It also created profits, albeit slowly, but it's still churning them out even during our latest bear market. I would say this is appropriate for investors and traders with an intermediate term time horizon looking for a system to identify a list of potential positions. For optimal performance, investors can apply additional analysis methods to kind of refine these candidates, improve the baseline reported results. Here's another view of the short-term version from a realized equity curve perspective. And the realized equity curve shows results after the closing of the positions and not on the day-to-day closing price reevaluation or recalculation. Here's the results for our last scan. It's called PT for profit factor. Highlights here, 80% hit rate out of the box and a solid 3.3 profit factor. It generated an average trade return of 2.6% with an average holding period of less than a month. It had an incredible maximum consecutive loss number of only 2. Through an entire 10-year period, according to the study, it didn't lose more than 2 trades in a row. Negatives, it only generates 375 trades a year over the 10-year period. It's very restrictive. Again, though, that's reinforcing the factor of conviction. And here's the equity curve. Although it's very selective, again, it didn't have a losing year over the entire 10 years. I would say this system is best for investors and traders with a shorter term time horizon who prioritize risk and consistency of returns and who are willing to scan a larger universe of stocks for potential positions. Our final segment, and we have about 7 minutes in this segment, just so you know. With the KC profit target system, we're at a canned baseline 80% hit rate at a 3.3 profit target, which is way over the goal, but we're still short of the 85% hit rate that we set out. So how do we get there? We're going to look at 5 ways, and these can be used with any trading approaches, okay? So this is important about improving performance. With our first one, you don't even have to do anything at all. All of the scan results that we covered are price-based only, and they don't include dividends. That's right, there's no dividends. According to a study by Ibbotson from 1926 to 2020, dividends accounted for 40% of the total return of the S&P 500s. And those are the very components of our study. Here we could see on the screen a sorted list of the percentage losses of the LT system. And you can see out of the 437 losses, remember it hit 75% of the time, 115 or more than a quarter of them lost less than 2.5%. and 62 of them lost less than 1%. With a total return approach after adding in the dividend amounts, which you certainly would have received some of them, many of these reported small losses would have been gains, automatically bumping up the hit rate towards our 85% goal. And we can look at this from another perspective. In this chart, look at the areas A through E. These are all where the stock went ex-dividend, and these were paid on annually. Notice the large down gaps. Not only are we not getting the dividends, but at times we're getting stopped out of the conviction positions on the systems, and that's lowering our hit rate simply because of the equalizing drop in prices when the dividends were paid. So that is one way where your performance is likely to be much better than what you're seeing here. Number two, we don't have a market timing filter embedded into this, meaning that we are penalizing the system by forcing not only a long-only strategy, but the system to hold long positions through all types of market environments, including obviously bearish ones. When one couples the conviction scans with other timing systems, all of the performance statistics are likely to improve. The recommendation here is that if you have your own viable timing system, don't hesitate to overlay it with the conviction system. For those of you that you don't have one, AI does have a long-term technical-based market timing system coming out with MetaStock in the fall. And we have a few slides on this showing the exits and entries as they happen going back. It saved about 31% on the dot-com bubble. It saved 36%. You can see the getting out in the entry right in back right here on the Great Recession. Now, you may notice it's not catching the exact tops and it's not checking the exact bottoms, but this particular market system is designed to keep you in the markets the majority of the time. We want to be there. We want to make money, but still while preventing you from the large losses. That's what the system is designed for. Unfortunately, during the COVID crash, you did not gain much. You gained a little bit on the market, but the Fed fixed the problem so quickly that it sprang up so quick that the system just wasn't able to adapt. You didn't lose anything and you avoided most of the pain, but you just didn't really gain that much by following the system. Our third way, and I would say this is the best way to improve your performance, other technical elements, of course, right? Scans are built off of a system and they are meant to identify securities with a certain set of criteria and to reduce a large number of securities down to a manageable size for further evaluation. They're not necessarily the end all. Even someone with modest trading or technical analysis skills is going to be able to filter the bad setups, improving performance results. Here you can see some analysis on Murphy Oil. Here's another example showing entry timing on Amazon. Now, I grant you the amount of benefit here will be correlated with the skill of the chartist, but for many, come on, gaining another 5% in the hit rate is not unreasonable at all. And for a professional, that's downright insulting. I mean, filtering these signals is certainly going to improve your performance. Number four, the system and scans are only looking at a technical perspective and prices. What about the fundamental aspects for choosing stocks with a greater probability of outperformance? Here we can see an example of combining technicals and fundamentals with relative PE support and resisting lining up with the price action on Lockheed Martin. And to support this approach, anyone who gets the conviction package will also get a complimentary one-year membership to AAII, and that includes some excellent fundamental scan tools. The video shows some of these scans right here, and these are based on the philosophies of the world's all-time greatest investors. My favorite is the one that you just seen, where it shows the individual stocks that meet the most fundamental criteria and appear in the largest number of systems. For some investors, the integration of fundamental stock selections at some level is an area that could improve performance. It really depends on your choice and how you approach the markets. Last one, money management. First, compound interest. For the systems test that we did not reinvest the returns. We thought you went to Bermuda with the gains. There's no compound interest. We stayed at $5,000 per position over time. If you were reinvesting the profit, you would have greatly, greatly enhanced your overall returns. Second, these systems were primarily developed for educating and identifying strong conviction-oriented setups. They were not solely designed to maximize profits on the exit criteria. The exits are based solely on a number of conviction-related factors to stay true to its purpose. So try scaling out of your positions. When you hit your first profit target, which would be generated by the conviction system, thinking about taking half off the table and maybe moving your stop up to a strategic locations to lock in a game, minus gapping, of course, and at the same time, let them profits run, right? It's always easy to play with house money. And with that, I guess I'm on my last two slides. I think I'm just about out of time, but my sincerest hope is that you learn something here in this presentation that you can incorporate it and improve your trading and investment returns. For more information on AI membership, the tools, the courses, or anything else, you can contact me personally at aitools@aaii.com. I would love to hear from you. And if you're interested in any of the educational class content, contact us at ves@aaii.com. My name is Raymond Rondeau. I thank you for your time. I thank MetaStock for this opportunity. And the big finish, remember that AI is always there to help the individual investor because that's our purpose. Thank you.
Thank you, Raymond. Really appreciate that. Good job.
Are we taking a question? No time for questions, Jeff.
We don't have a lot. So I do appreciate your coming in. You did a great job. I'm going to talk a little bit about how we can get, how users can get this tool that we've been working on for a minute.
Okay.
Cool. Awesome. Thank you, Ray. Appreciate it. All right. Very cool. Let me go ahead and do this. And let me go ahead and kind of put the presenter over here and go ahead and show my screen. And as you, as I just mentioned, we have been working on this tool for quite some time. We're hoping to have it ready for our November conference, but right now we've got it available as a pre-order. It's something that you can get. We're hoping to have it downloadable and available for you to purchase this week. But I am very, very impressed. It's a very unique approach. It looks for, it accounts for volume, volatility, variations and divergences, volume and volatility, anomalous, overnight market activity. It's been re-engineered. It's not like your grandfather's volume study. So let me go ahead and do this real quick. All right, very cool. In terms of the indicators that are provided, he's got the optimized balance conviction, the kinetic conviction, the relative conviction momentum. And he talked a lot about kind of how those work and how they can be utilized to kind of help you with your trading. Very, very unique and interesting takes on indicator or on volume and conviction studies. So in total, basically, you're going to get a total of 3 methods. You've got the LT, AI kinetic convection LT, which is for the longer term trader with a longer term horizon. His average length is the average hold length on that is about 82 bars. In addition to that, you get the ST, which is a 32 bar average. It's perfect for investors who have an intermediate term trend horizon. And then you get the PT, and this is for investors who like to scan. I like to scan. It looks for shorter term horizon opportunities and it helps you find those as well. Has an average length of about 27 bars. So in addition to that, you get the shares calculator. It is totally integrated into MetaStock, which means not only can you scan for signals with the different methodologies, you get the buy signal annotated on the chart. You do get the commentary ratio, the commentary quite a few times. Here's a commentary on Mar. That we ran a scan on and came up. So it's totally integrated into MetaStock. One of the things that is particularly impressive to me is the amount and the seriousness in which they take their system. Raymond, in particular, takes his system design into. He really, really tests the systems. He looks at them. He kind of knows kind of the the hazards and the pitfalls that you can fall into with system testing. I think that makes him a really, really good system designer. So we're really, really happy to get this AAII Conviction Plus out there. As part of it, you're going to get 7 indicators, 4 explorations, 8 expert advisors, and 7 templates. And normally, we're going to retail this at $14.97. We're going to introduce it here at the conference today. It's $9.97 here at the event. You can get it here at 8. There's a couple of different ways you can take advantage of it. It is a pre-order. Again, we're not quite ready to go on this. It's going through testing. It's going to pass testing. It's going to be ready to release, but we hope to have it available by the end of the week. Here today, we're going to give you a $500 discount. So it's $9.97 here at the event. You can give us a call at 800-882-3040 to get it. You can go to metastock.com/conf promo to get it. You can also, if you have any questions, if you want to get some more information about it, go to metastock.com/sales chat. So as part of that, you're going to get all of the 3 systems, the indicators, the shares calculator, $9.97, one-time cost. Not every month. You just pay for it once, you own it. It's a good way to kind of get it. So 800-882-3040, metastock.com/conf promo, or metastock.com/sales chat. There you go. And we do thank AII for sponsoring today's event as well. So in any case, I do want to kind of highlight another one of our sponsors here at the event today, CMT Association. CMT Association has been sponsoring MetaStock's events for a while now. They're another super good nonprofit. They work with accreditation of traders. If you are trading as an institution and you're interested in finding out more about how an accreditation can help you with your actual career, you can find out more at cmtassociation.org. You can also give them a call at 646-652-3300. So very, very much thank CMT Association for their sponsorship of the events. Of course, we're MetaStock. You're familiar with MetaStock. You might have heard us talking about it. You can do scanning. Might have mentioned already today a time or two that we've been rated #1 30 years in a row by the readers of Stocks and Commodities magazine. I do love testing, but I also like the ability to scan the markets and find good trade ideas. I like the patented forecaster that we have in MetaStock, the commentary, and I'm going to go into some commentaries that I really like here in a little bit when my presentation comes up. But our MetaStock platform for the real-time program starts at about $265 per month for end of day. It costs for $69 a month. We are running a promotion here where if you pay for a month, we'll give you the second and the third month for free. Kishore, yes, that is a one-time cost. You pay for it. We do offer it on a money-back guarantee. If you're happy with it, you can keep it. It's a one-time cost. So give us a call. Thank you for your interest as well. 800-882-3040. So let's go ahead and migrate. I hope you're enjoying the class today. We have a great attendance. We have a bunch of signups. And we've had, I feel, some great speakers. So I hope you're enjoying it. If you're watching us on YouTube, hit the like button, hit the subscribe button. We do appreciate that quite a bit. Our next presenters are Alexander Cole, Tyler Wood. They're going to talk about a GoNoGo system. They do a really, really good job. They've actually included in MetaStock, and they're going to talk a little bit about this, a free expert advisor that you can use to actually look at the markets and kind of get trend readings on the markets. And if you have MetaStock, the 18 version, it's actually part of MetaStock for free. But these guys do a great job. We love having them in here, and we're going to go ahead and bring them on. Alex, Tyler, how you doing?
Doing well, Jeff. Can you hear me?
Yes, I can hear you. All right, and I can see Tyler, winner of the Best Beard Award, but I can't see him quite yet. I mean, I can't hear him.
Tyler, you're muted.
Yeah, you're muted, Tyler.
Oh.
There you go. Well, let's see. No, not yet.
Thank you, sir, for unmuting me. How about now?
Yeah, we can hear you now. Yeah. Always a good part of it, right? Let me go ahead and let's see. Is it Tyler or Alex that's going to be doing charts today?
I'll show some charts.
All right, but I'll make you the presenter.
Thank
no,
you.
we're running. I know we're running about 5 minutes late. It's not uncommon. Don't worry.
Well, we talk really fast, so we'll try to catch up on some time. How about that?
You're fine. Let's go ahead, and I can hear both of you. I can see both of you, and I'm going to get out of the way.
Thank you so much, Jeff. Thanks, Kelly. Thanks to the whole team at MetaStock, and thanks to all of you for tuning in to this week's conference. Alex and I are coming off of a three-dimensional live in-person conference, and it's really a testament to all of us that you can take a break from the markets, set your trading platform aside for a minute, and just think about your process and tools. Take this next hour to just learn a little bit about how you might develop your own rules-based discipline. The title of today's presentation is Data Over Emotions. And what we mean by that, in the macro narrative, right, we're coming into a recession. Well, we often don't even can't accurately label a recession until long after it's over. We're waiting on elongated Fed and global macro data to do those things. And then at the micro level, think about your own psychology as you place trades and the fear and greed that can oftentimes derail us from doing things more systematically. So what we're going to talk about is a set of tools. Alex and I, over the last 20 years, have spent a lot of time with institutional research analysts, portfolio managers, and traders on the buy side. And what we've learned from all of them is that, number one, they need to simplify their process. And the second thing is that they want to use the weight of the evidence. All of us are bound by these human emotions that can derail us from making thoughtful and logical decisions. So for this next hour, that's what we're going to talk about. We're going to talk about equipping yourself with some tools that will help you distinguish those data-driven decisions from something more emotional or irrational. So Alex, why don't you walk us through these next couple of slides?
Would love to. And I take issue with Jeff for giving you the best beard award. I'm going to have to talk to him after.
We've grown a lot through the pandemic. As traders, as analysts, I've grown laterally. The beard's gotten larger. Yeah, we've all been personal growth.
Absolutely. But yeah, so, we at GoNoGo Charts, we are big believers in trend following and the importance of having a well thought out process. And that previous slide just said we are what we repeatedly do. And so that's what we want to do. We want to make sure that we have a system, we have a checklist, we have a set of tools that we turn to, that we have confidence in, and that we follow our process to remove any kind of subjectivity. Now, my son is learning to drive. I've said this for the last few months, and it's scary. You have a 16-year-old, and he's going to go out there in a machine that is quite dangerous. So you need to have a routine to follow. I want him to always put his seatbelt on. I want him to always have his foot on the brake when he starts the car. He should check his mirrors before he pulls out. He should signal, but then engage the gears and pull off. And if he does all of those things, if he checks his mirrors, if he signals, then he's going to have a better chance of being safe out there on the road. And that's the same thing with technical analysis. We have a system. We want to have a process. We want to have a checklist of tools that allows us to repeat our process and to stack the odds in our favor. And it could be anything. You could be using Dow theory, trend lines, moving averages, whatever it might be. But you need to have something to turn to give yourself confidence so that you don't fall into moments of self-doubt and confusion and conflicting information. So that's what we are talking about today. And when you move forward and talk about trend identification, we know that that's the most important part of our discipline, because if you can identify a trend, then you can trade in the direction of that trend and you can profit from most of that move. Now, it sounds simple. You buy a security and then once it's gone up, you sell it, right? If you're from the TikTok generation, that sounded great in 2020 and 2021, right? Just, it's buy it and it goes up and then you sell it. Well, that's the essence of trend following. It's just not easy. It's a simple concept, but not necessarily easy. So let's just walk through real quickly how somebody might go about doing that. And the first thing you're going to do is just visually try to identify whether or not you're seeing higher highs and higher lows. That is a trend. If your price is moving higher in a series of higher highs and higher lows, then you have a trend in the direction that you're seeing that happen. But you're going to want probably to automate it. The whole point of this is to remove subjectivity, have a disciplined process. So you might turn to something like the Donchin channels. We were at the 3D conference Tyler was talking about just over a week ago. the CMT Symposium in New York, and we got the honor of listening to Jerry Parker, one of the original turtle traders and one of the most successful. And one of their entries originally was using Donchian channels. And Donchian channels just looks back at a time period and asks whether or not price is trading at the high for the look back period. And if it is, then it moves that line up to correspond with that new high. So you can see here on the chart that red line is moving higher every time price makes a new high. And then the same for the green line on the bottom, that would be representative of the lows. But after having identified automatically some highs and lows, you might throw another indicator on there. Bollinger Bands really helps people with trend initiation, right? Understanding when a trend might have started. Because we know, if we're familiar with Bollinger Bands and technical analysis, that there's really two general ways to use the bands. One, when the band is wide, then you might expect price to revert back to its mean if it's at those limits. But when the band is narrower, then the suggestion is to trade in the direction of the break, meaning that you've had compressed volatility, price is broken out to a new high, and then we expect price to move in that direction. So you might put Bollinger Bands on there. And in this no particular order, of course, simple moving averages would probably be the first thing on anybody's chart. But so many people will turn to a moving average, and with good reason. If a price is trading above the average of its historical prices, then that's an inherently bullish situation. We're able to say that people are prepared to pay more now for this security than they were over however many periods running up to that. So looking at where price is relative to a moving average is very important. You might want to throw a confirmatory indicator on the chart, something such as volume. Charles Dow reminded us that volume really represents market participation. So if you're seeing a break to a new high in price, is the market participating in that move? Do you have nice, healthy volume? You might want to have a look at that while you're trying to identify a new trend. And then, of course, you could throw any number of indicators on the bottom of the chart as well in separate panels, but something that somebody might look at is an indicator called the moving average convergence divergence, which it looks at the difference between two moving averages to try to get an understanding of whether or not prices in the short term are moving quicker than they were over a longer term average. And so when you end up with 3, 4, 5 things on the chart, you start to get a sense of trend forming. So somewhere on the left side of this chart, you could run through the list and say, okay, yes, Donchian channels making a new high. Yeah, just about there where that dot is. You can say, yes, price is above and finding support at a moving average. You could say that the MACD is crossing above its signal line and is in positive territory. And you can also say that it was breaking out of those Bollinger Bands. So somewhere over there, you're feeling fairly confident as a technician that you're identifying a new trend in an upward direction. But even with a process like this, we have a problem.
Now, as students of the market going through the CMT program, that stands for Chartered Market Technician, every new page, every new chapter of the curriculum introduced powerful tools, things that we really want to know, the weight of the evidence approach, right? You want to have multiple confirmations from multiple different signals, not one pet indicator that, of course, is only going to work probabilistically, maybe 60% of the time. So when you take that combined, the combined tools together, you might end up with a chart like this. And I'm guilty of creating these. I know Alex is as well. And it's because the information is so valuable. But here's the problem. When you add panel after panel after panel, when you add indicator after indicator on top of your price panel, you start to introduce analysis paralysis. And I'm sure I'm speaking something that hits pretty close to home for many of you. If you have a process, a checklist, do you wait for every single box to be checked? Do you need 100% consensus across all of the indicators that you use? Does that help you enter trades at the right time, or are you often too late? What about getting out? What about your high conviction trades where you just know this company? I mean, the story's so good and their products are so great. Even if it's broken all of your trend lines and many of your indicators are telling you to get out, you may end up sticking with it. Well, what if that trade is turning into a loss and you're not following your rules? If you have enough squiggly lines on the chart, you can convince yourself of just about anything. So what we have come up with is a way to blend all of the most widely used, widely back-tested indicators from the technical toolkit, but we're doing all that computation in the back end so that what we can see on the chart is a crystal clear image of the price action itself with a blended trend identifier. So these 5 colors, give us the idea of go trends, right? We're borrowing this terminology from NASA. If they're launching billions of dollars of hardware into space, they want all of the conditions to be optimal before they launch that rocket ship. Same thing for an investment idea. If you have a go condition, if we're in a go trend, then that weight of the evidence, the checklist in the background, is telling us that all signals are go. We've got a strong form and a weak form. So those blue bars are the strongest form of a go trend condition. The aqua bars are the weaker form. And then when we're in a no-go trend, when we are trending downward, we have the strong form in those purple bars and the weaker form in those pink. And right here at these periods of transition, you might see some amber bars. And that's when all of the background indicators are in their neutral territory. Alex and I are big fans and followers of the life and work of Jesse Livermore, who said that in markets, there's a time to go long, a time to go short, and a time to go fishing. So if all you take away from today's talk is that you've got go trends, no go trends, and go fish, meaning that neutral or uncertain territory. That's really the basis of our work, is to try to simplify what it is that we're seeing in front of us. Now, we're so proud of this work, and we want everybody to have these tools that institutional portfolio managers and traders and analysts have been using for a while, and we're giving them away for free. So as MetaStock users, you can apply the template for the GoNoGo trend on your charts right now, or right after this session, I should say. All we would ask is that you let us know how it's working for you. What securities are you trading? What time frame is most comfortable to you? And has this helped you enter and exit your trades in a more responsible, data-driven way? And that's really what we're all about. So Alex, why don't we walk through a little bit about the process and approach that we're hoping to follow?
Absolutely. And I don't know if your PowerPoint's not moving forward, but...
Are you guys seeing on screen what we are really looking to do?
No. Well,
not at all.
We are.
But I know what we're looking to do, but I'm not seeing it here on...
I think that's a personal problem, Alex. We can see what are you looking to do, participate in trends, not anticipate.
Interesting. Maybe I pressed something on my side, but that's okay. I got my PowerPoint here. Give me 1 second.
I'll let you troubleshoot, and I'll keep going.
Yeah, you keep going.
So the idea behind today's talk and behind every presentation you'll ever watch from GoNoGo charts is that we're trying to participate in these trends, not anticipate, right? So much conjecture, so much talking head nonsense on financial news media about what we predict will happen in the future. Now, what we are trying to do is remove that uncertainty and simply listen to the message of the market. The best analyst, the greatest research department on the planet is the market itself. And it's price that indicates all of the information that we need about not just the fundamentals of the underlying security, but also the sentiment of investors writ large. So we want to remain objective. And here's what I want to walk through real quick is some behavioral research from Terence Odian, who's a Berkeley Haas School of Business professor. And they looked at 360,000 day traders over a 15-year period. Right? That's a statistically significant sample size. And what they were looking for was, what percentage of those traders do you think lost money over that 15-year period? And go ahead, you can type it into the chat. You can shout it out at home. How many do you think were successful? How many lost money over that 15-year period? Well, the answer is 87%. Less than 1/3 of 1% of those who try to trade the markets are successful over the long run. And what we really come down to is that the behavior is the biggest impact on long-term profitability. So I've got another question for you. This also comes from Terence Odian and his fellow researchers, and they took 43 million currency pairs trades from DailyFX, and they were looking at what percentage of those trades were profitable. So remember, we just said that over the long term, individuals have a very difficult time beating the market, maintaining profitability over the long run. And I'm also here to tell you that the institutional community has struggled to beat their benchmark as well. They fall victim to the same behavioral biases. So the question now is, what percentage of these 43 million trades were directionally correct? What percentage were profitable trades? And the answer is over 50%. Well, that doesn't really add up, does it? Right? The win-loss ratio is greater than 50%. So why are so many individuals losing money over the long run? They clearly have an edge in their decision-making. They can get their directional bet correct. Well, the answer lies in the behavior. The position size of the average gain for winning trades versus the average loss for losing trades. And what we're seeing is that people are holding on to losing trades far longer than they are letting their winners run, right? As Alex said at the beginning, this is a very simple concept, but it's very difficult to execute because of our human emotions. Now I'm going to get mathematical on you for just a second. We're going to talk about the expectancy formula. And I've got some good news, okay? So don't get bummed out yet. I know it's a Monday, but stick with us here. So we know that behavior limits gains. Folks like Daniel Kahneman and Amos Tversky in the 1970s wrote about prospect theory, meaning that we experience far less joy from a winning trade than we experience suffering from a loss. So we don't want to lock in that loss. We hope that the security will come back, make us whole. We'll get back to break even. If we just stick with it, have some conviction, we don't have to admit to the loss. Okay, that's the emotional side. And Kahneman and Tversky identified many other heuristics or behavioral shortcuts that our brains have to help us through nature, but they get in our way as traders. So on this diagram, what we're looking at is an efficient frontier. Every trading system, every trading strategy along this curved line is going to break even. So let's look at this dot right here. We've got a 50-50 chance of a winning trade, right? We're just flipping a coin, meaning you have no strategy, no edge for how you're selecting securities. Just flip a coin. Do I buy it or not? Well, you can still be profitable even with no analytical discipline, so long as you control your risk. And the risk management comes down to cutting those losers short and letting the winners run. So if you have a 100% or a 2-to-1 win-loss ratio on your trades, you're still breaking even if half of those trades are losers. And somebody like Paul Tudor Jones is happy hanging out up here, right? These incredible hedge fund traders, they know that they're not going to be right. In fact, they're very comfortable being wrong regularly. And they take many, many positions in a highly diversified basket of securities. But when they are right, when the trend is in their direction, they really press their bets and they get those outsized gains, those 5-to-1 ratios on winners versus losers. Just think about professional athletes, right? In the Major League Baseball, Hall of Famers, if they're batting a 300, right, that means they're striking out 70% of the time and they still make it into the Hall of Fame. So as investors, we have to get very comfortable with not being right all the time. We don't need to be right. The market is always right, and we simply need to follow the message of that market. Alex, are you seeing what we're seeing on screen now?
You know, it's very strange because I've never had this happen before, but your voice and your mouth are moving as one, but the slides are coming in on a delay. So very strange, but I've got the PowerPoint up and I'm good to go. Yeah, we really both, and so do so many of the people we work with, believe that price is paramount. And we love this quote from Mark Abraham. And he said that ultimately it is the dollar-weighted collective opinion of all market participants that determines whether a stock goes up or down. And that consensus is revealed by analyzing price. So we cannot allow ourselves to clutter our charts with so many good technical indicators and technical concepts that we can no longer see price. Price is never restated. It is not an estimate. Price is the amount that the market is prepared to pay for whatever it is that you're looking at. And so we can get so much information from analyzing price. I mean, you and I go back to Edwards and McGee. That was probably my favorite book for a long time when I first started getting into technical analysis, written in the 40s, but still so applicable today. Being able to see the market dynamics of supply and demand being played out on the chart through support and resistance levels, through prior highs, through base building. We talked about Ralph Acampora, the CMT, the bigger the base, the higher in space, and the bigger the top, the bigger the drop. All of these classic sayings have come from the fact that we know when we analyze price, we get so much value out of it. So let's move on. We'll simply consider the trend. We've gone through those 5 colors, and this is what you then end up with, a chart like this. And this is a chart of Meta. This is from about 6 months ago, and we have a current Meta chart later on in the presentation. But what we want to highlight here is how clear you can see the change of trend from a go trend to a no-go trend. And yes, you can see the uncertainty there. You can see about 4 go fish bars in the middle of that chart, but you can see actually price rolling over as it comes through the colors into a no-go. And if we move forward, what we might have been looking at with a different chart, even a very sensible chart, this is a chart that I worked on with a client, it's a good checklist of technical indicators, but very much more difficult, I think you'll agree, to see that dynamic change from go trend to no-go trend, because the price panel in the middle is fairly small. We've had to compress those price bars because we've put multiple indicators in that panel. We've got indicators above and below, and it doesn't jump off the page quite as quickly or as easily as when you can identify trend by coloring the bars. And if we move forward, we'll just visually see that again. That's the same period of data that we just looked at. And there's that change from the go trend through some uncertainty into the no-go trend for Meta.
And from a risk management perspective, for Alex and I, when we enter these no-go colors, right, we never know what holds, what is beyond the right side of the chart, right? Anybody who tells you they can predict the future is probably steering you in the wrong direction. So if we simply follow our risk management discipline, right? Facebook was a killer through the stay-at-home trade, right? The darling of 2020 and 2021. But as we came into the 4th quarter of 2021, we saw this weakness. And if we stick to our rules, if we get out at the first sign of a no-go trend, we avoid all of this downside. And I know we're going to have some questions later. For those of you who trade to the short side, right? Trend following works in both directions. And yes, you can use GoNoGo charts to lean into your short trades when they're in these no-go conditions. We're going to explain exactly how these work in just a minute. Now, the next thing that I wanted to talk about, going back to the OG technician of the West, Charles H. Dow, many lessons there that have been evergreen over the last 130 years. And this is not a person who had advanced data analytics or data visualization. He was a reporter, right? He created the Wall Street Journal. He created the Dow Jones Industrial and Transportation Averages. But he also talked about multiple time frames. And Charles Dow was an accomplished nautical sailor. He talked about the market in these analogies, and he said that there were 3 trends that we could pay attention to. And that primary trend is like the tides of the ocean. It's unflappable. Human emotion is not dictating where the tides of the ocean go. That instead is governed by things like the gross domestic product of the countries, that expanding or contracting, the fundamentals of the underlying companies that we are buying shares of. That's our primary trend. And if you pay attention, if you step out to a very long-term chart, you can see the overall direction or drift of the market, right? And that time frame is going to be dependent on your personal preference. But we can see that there's a primary trend, but price, of course, moves above and below that trend, right? The concept of mean reversion, over time, it's going to average out to that primary trend. But this secondary period, what Charles Dow compared to the waves of the ocean, is really governed by a lot more human reaction to those fundamentals, to the information that we're getting from the market. And of course, human beings can become very exuberant, right? We can push prices well above the primary trend. They can go parabolic at times. They can also become severely depressed when we are despondent, when we've ended a bear market. People can push prices even lower than what the intrinsic value or that primary trend is looking at. And then, of course, there's the minor period. Charles Dow compared that to the ripples on the surface of the water. Folks like Jim Simons, high-frequency traders, maybe even many of you who are day trading have made hay in this tertiary period or this minor trend, because we can scalp those very short moves above and below the secondary period. All right. So that's multiple time frame analysis. And if there's something that you want to jot down in your notebook, it's that no matter what time frame you're trading, when you're doing your analysis, you want to take stock of multiple time frames. You want to pay attention to what is the primary trend that you are trading in, and then thinking about your execution on those shorter time frames. So let's go through a couple of GoNoGo charts using this multiple time frame approach. And one thing to note is that any technical indicator worth its salt is going to work the exact same way on any time period. If you're looking at weekly bars or you're looking at 5-minute bars, the GoNoGo concept is exactly the same, and the calculations are exactly the same. So, Alex, why don't you walk us through these next few as we look at the weekly, daily, and intraday charts?
Absolutely. So you can see on the weekly chart here that we are in a go trend. The bars being painted are the stronger blue color. So the strength of the trend is strong on a weekly chart. You can see consecutive strong blue go bars as we come off those higher lows, right? You can see the higher lows that we've been making since Q4, since that ultimate low in October. We are seeing higher lows and we're looking for a new higher high, but the trend is a strong go on the weekly. If we move forward to the next chart, I think we've got the daily chart next, and that's a week go. So some weakness in the daily chart. You've been around the last couple of weeks, then you can probably attest to that. We've been very choppy. We've been up, big days up, big days down. So, but we are still, the weight of the evidence still suggests we are in a go trend, albeit painting weaker aqua bars. And then what you would be doing with these multi-time frame approaches, if you think about perhaps a portfolio manager working with a trader, or perhaps somebody looking to take a position, trying to get a good entry on a shorter time frame chart, given his overall market bias was based on a weekly or a daily chart, you might drop down in time frame. In this case, we've got a 60-minute chart on here, and you may be looking for go trends on the 60-minute. If your daily is a go, your weekly is a go, if we are lining ourselves up on that side of the market at the moment, we may be looking into the shorter time frame charts to look to participate in that by going long when we see go trends on a 60-minute chart.
Absolutely. Now, the next lesson, when Alex and I spent a lot of time with the CMT Association, folks like John Murphy, who's a chartered market technician, and really the author of the seminal work on intermarket analysis, CNBC's top contributor and technician for many years. He talked about the correlations between things like the fixed income markets, T-bills, what we're seeing from yields and rates, how that impacts equities, long-term commodities trends, and then even fluctuations in national currencies. This was all pre-crypto. How that would impact not just the overall equity markets, but also the sectors and styles that we'd want to be investing in. And of course, many have built upon that work. Folks like Marcos Katsanos have really tried to quantify some of those correlations between the asset classes. So just as GoNoGo charts work the exact same way on any time frame, they also work the exact same way on any liquid security. And I'll repeat that. If you are trading currencies, if you are trading cash-settled butter futures, if you are trading penny stocks, as long as there's liquidity in the market and it's governed by the free market capitalist rules that our markets here in the West are, you will be able to use GoNoGo charts on those securities. So, Alex, let's do a quick round robin, a little multi-chart layout, and let's just get a sense of what the overall picture of the markets looks like.
Absolutely. So we love to do this. It gives you a quick sense of where the trends are. And remember, big part of trend following is that diversification that Tyler hinted at earlier. You need to know where your trends are so that you can catch them. And we can see that on the top left, we've got a weak go in US equities. Treasury bond prices, remember, moving inversely to yields, are in a weak no-go at the moment on a daily basis. US oil has been up and down, but is now in a strong no-go. On the bottom left, Bitcoin is in a strong go. And gold in the middle, also a strong go. Gold has been a good performer this year so far. And then on the far right, the US dollar still in a no-go trend, but moving mostly sideways. But you see those weak no-go bars there towards the right side of the chart.
So in addition to thinking about our trade methodology, our psychology around individual trades, Alex and I spend a lot of time with some of the top research analysts in the country. and really across the world, whether we're talking about Wall Street or Dalal Street or Bay Street, these folks have a top-down approach. And what that means is that they're starting at the asset class level. They're trying to get an understanding, right? In 2022, equities were down, cryptos were down, gold was down, oil was up, and the US dollar was up, right? We saw a rising rate environment. We saw a commodities cycle that was driving this inflation. And so as Warren Buffett songs, not Warren Buffett, Jimmy Buffett songs that Alex loves so much. I don't know if Warren plays the guitar quite as well. I don't think he would look as good in Bermuda shorts either. Jimmy Buffett says, it's 5 o'clock somewhere, right? Well, there's always going to be a trend somewhere. So getting a sense of the nature of the markets, getting a sense of commodities trends or interest rate trends that you might not find the same opportunities in the equity space that you would in others. And for years, no one wanted to touch cash, and now it's yielding 5%. So you have to change with the times. You have to be flexible and adaptable to what the markets are giving us. For this purpose, Alex and I do publish subscription research every single week for our institutional clients. That's actually where this whole concept got started, using GoNoGo charts, but showing people that top-down perspective, giving some comparison of the asset classes, and then drilling into the sector groups of the equities market and down to individual securities. You can find out a lot more about those weekly publications, Flight Path, that goes out pre-market Monday morning, a little more narrative, a little more setting a trade plan for the week. And then, of course, Saturday morning, we like to practice what we preach, which is that it's best to step back from the market, back from the anxiety of trading itself, and think about those longer-term trends and what are those primary drivers. So we send those out to institutional subscribers. You're welcome to check those out. This is just an example from back in May of last year, talking about inflection points that we were seeing in the US dollar. And that brings us to the 50-yard line. Give yourselves a pat on the back. We're halfway through today's presentation. We've talked about multiple time frames, talked about looking at across the asset classes. Even if you're not trading rates or trading currencies, paying attention to whether the US dollar is strengthening or weakening, paying attention to a rising rate environment and how fast that rate of change is moving can really help guide a lot of your equity work. So thinking about multiple time frames and cross asset work. If all you do the rest of this week is test out that free GoNoGo trend indicator, we'll be very happy and feel like today was a big success. But let's move into the second half of today's presentation, where we can get a little more data driven, and we can talk a little bit more specifically about the life cycle of a trade and the complete GoNoGo chart. So there are more tools to this. Also available on MetaStock. We've been talking about the trend, that's this top price panel, and the importance of being able to see price action for those classical technical concepts like support and resistance or even pattern recognition. But what we're going to talk about here in the second half is what's going on in the lower panel. And that's the GoNoGo oscillator, where we're combining momentum, volume, and volatility. So Alex, why don't you talk to us a little bit about the concept of momentum?
Absolutely. And it's always the next thing that analysts will turn to. Once you've tried to identify the trend, you want to know how strong it is. And momentum ideas really help you understand the velocity of price movements. And so when price is moving very quickly in a direction, then we're going to get high readings on those momentum oscillators. And a lot of that is very, very valuable. And as everybody on the call, I'm sure, has done their studying and done their research, you need that information. You want that information. You feel naked without it, right? So there's a lot of good information in some of these oscillators, like the RSI, like stochastics, you name it. But as you can see, if you add 3, 4, 5 momentum concepts to your chart that we had at the beginning, think about that now. Now we've got 10, 11, 12 things on here, and it becomes even more complicated. So we want the information from momentum, but we don't want to complicate our chart. We want to have something simple that gives us a complete understanding of all the technical analysis in a chart. So what we came up with was the GoNoGo oscillator. And in the same fashion, we blend multiple foundational concepts of momentum analysis into one oscillator in the lower panel. Now, we can still get all of the traditional value from momentum that we get using those other tools. We can look for extremes of overbought and oversold. You can see on the chart where highs in the oscillator line up with highs in price, and the same with the lows in the oscillator leading to troughs in price. And you can also identify divergence. Divergence is such a powerful concept, and you can see when price is making a higher high, but the oscillator is making a lower high. That is an example of bearish divergence and should be paid attention to. And we also incorporate volume in the oscillator. Now, in the implementation here on MetaStock, we have that ribbon along the bottom, and that turns blue when volume is heavier than usual. So you put it all together and you're starting to say, okay, we are seeing highs, new higher highs in price. We're seeing heavy volume on moves up, but then you get lower highs in the oscillator. That's some divergence. It allows you to take some kind of warning from what you're seeing on the chart. You can also look at these areas of overbought and oversold conditions. So you're getting that complete picture through the one price panel and the one panel in the bottom.
Absolutely. Now, what really sets the GoNoGo oscillator apart from any other momentum indicator, really got a couple of things. One is that we're simplifying, right? We're going from -6 to +6. If you think about momentum oscillators that move from -100 to +100, you have a lot more nuance and subjectivity, right? When we see an overbought or oversold extreme, it's very easy to identify, right? We're simplifying our tools and locking into those pieces. The other piece about momentum, and this comes from a conversation I had very early on. I just moved to New York. I just finished my MBA, where I understood managerial accounting and corporate finance, and everything that I thought I knew about investing was fundamental. In fact, technical analysis was denigrated by a few of my professors. I got to New York and I met this gentleman, Ralph Hackenpora, and he said, Tyler, let's talk a little bit about momentum. He said, picture a baseball in your glove. Now, Ralph is from the Bronx. Everything with these Italians from the Bronx is baseball. And he's like, when a trend is moving upward, right, that's when you throw the ball in the air. And the fastest your ball is going to move is right when it leaves your glove. And it's going to go as high as you can throw it, right? It's going to hit that apex. It's going to decelerate, still moving higher, but slower, slows down. And then what does it do? It comes back down to your glove. Okay, you catch it in your glove, you throw it again. And the game of catch can continue. So when I was first learning about momentum oscillators, I said, oh, Ralph, it's overbought. It's a sell signal. And he said, no, Tyler. When momentum becomes overbought, you're seeing that there could be an exhaustion in the short term, right? Momentum can come back down to neutral and then keep going. But that neutral level is very subjective. Folks like Connie Brown, Andrew Cardwell, they've done a lot of work on how you could apply momentum oscillators in a trending security, not just for mean reversion in a range-bound market, but indeed to find those neutral levels. Well, neutral can be very subjective. Is 38 a touch of neutral, or is that negative? Are we still neutral if we're at 45? Instead, you have an objective zero line for the GoNoGo oscillator. So this green line is coming up to zero. And here we've struck the go trend. Tyler threw the ball in the air and he caught it back in his glove. Game's still on. Finds support at zero, takes off again, surge in momentum, price gains, comes back to zero. Oh, Tyler caught it again. The game continues. And every time momentum surges in the direction of the trend, where it finds support at zero, that's powerful information to trend followers. Remember when I was talking about Paul Tudor Jones loving to live in that world where they don't have to be right all the time, but when they are right, when they can really press their bets in the direction of a trend, they can get those outsized gains. So a lot of portfolio managers will pyramid into a position, right? They'll scale in and scale out, particularly if they're moving large institutional pools of capital. You can do the same thing. You enter a trend, maybe it's a small position at first, but as that trend continues and you continue to see this GoNoGo oscillator find support at zero, you can add to the position, right? Now, that is the driver behind some data visualization tools. Alex and I love simplifying things. So even if you're not paying attention to this lower panel, what you're going to see on the chart up here are trend continuation and trend reversal icons. So the trend continuation icons are these little green circles. And it's just about that interplay. When we're in a go trend, we found support at the zero line with the momentum oscillator, and it's surging back in the direction of the trend. That's our trend continuation icon. That's when we want to add to our positions. the counter trend correction arrows, again, this is in a go trend, we're going to see these little red arrows. And what it's telling us is that the momentum oscillator has become overbought in an extreme sense, and price may struggle to go higher in the short term. So if you're looking to exit that trade to put capital to work in another security, or maybe you've got a college tuition payment due for your child, that's a logical short-term place to take some of that position off the table, right? That's a counter trend correction arrow. Not a sell signal, but that we might see some pullback or some correction in this underlying trend. Now, for those of you who do trade to the short side, this entire process works the same way in no-go trends. And we're going to show some examples later where you can really lean into your short trades and still have responsible risk management as you cover those positions at counter trend corrections. All right, so we've got trend continuation and counter trend correction, and it's just the interplay between these two independent studies: the price panel, GoNoGo trend, and this momentum panel, GoNoGo oscillator. So now, maybe for the main event, Alex, we're going to talk about this this orange grid that's building in the GoNoGo oscillator. First, we got to talk a little bit about volatility. Why don't you walk us through this slide?
Absolutely. So volatility scares people. That's what we find talking to a lot of people over the last couple of years. But it shouldn't. What we actually want to do is look for areas of volatility that happen often at inflection points, and then we can use that to identify a move that might be profitable. So we know that after periods of low volatility, we often see periods of high volatility. And that's that idea of searching for compressed volatility that can lead to big moves in a certain direction. Now, we've got lots of technical indicators that capture this kind of idea. Bollinger Bands, Keltner Bands, to name a few. We want to see areas where those bands narrow. When we learn about it, I was taught that it was like a tube of toothpaste. If you squeeze that tube of toothpaste, the cap will come off. And that's what we're looking for. We're looking for that high volatility move. Now, it can happen in trend continuation or at times of reversal. We can see a really narrowing of price activity at the top, or as price consolidates before making another push higher. So we want to look for these areas of compression, but we need to do it without subjectivity, and that's where it becomes difficult. So if we're moving on from that slide, here's an example of using the Bollinger Bands to look for a squeeze. And this example is using international seaways. But what you're seeing is the bands around price, and we know that it's important information because the price will trade within those bands the majority of the time. But when they trade outside of those bands, it's very, very powerful information. Those can either happen at periods where the bands are narrow, or as we mentioned earlier, when bands are wide. So we want to look for those areas of narrowing bands where we have volatility compression, because that often leads to breakouts in another direction. So I want you guys to look towards the right side of this chart where we see that narrowing of the bands in about October. And that's what we're looking for. We're looking for that narrow bands, trade in the direction of the break when they break above the bands. But the problem we have is we need to understand whether or not those bands narrowing is historically significant. So we have another indicator we can add to the bottom, which is the Bollinger Band Width indicator. And we can look in that lower panel and see that in around October, that seems to be just about as low as it's been, right? So we're saying, okay, compared to other narrowings at other times, this seems to be a fairly narrow moment in the Bollinger Bands. So when they trade out of the bands, we're going to choose to trade in the direction of the break. And so that's what you would be looking for when you're using a typical band squeeze type of idea.
This is the trend continuation example, right? Where we see a consolidation in price, the bands narrow, and then the trend continues in that upward trend. This is a chart of international seaways. Let's take a look at another example, Alex, with the chart of the US dollar index, an ETF called UUP.
Yeah, so again, we were surprised, many of us, by the strength of the US dollar for such a long time, right? And people were calling for the dollar to roll over, but nobody really knew when it would. And so using a band squeeze to try to identify trading in the direction of a break below the lower band, this is that reversal type of idea, we're looking at this chart of UUP, and over towards the right side, we're going to wonder when we trade down in November to that lower band, are we going to trade in the direction of the break, or is that going to be a mean reversion type of idea? Well, this is a bit more complex than the International Seaways one. That band narrowing doesn't seem as pronounced. If you look at the Bollinger bandwidth on the lower panel, it's not making a new low in bandwidth. It's narrow, but is it narrow enough? Would we be sure that that's becoming a trade in the direction of the break opportunity? So we want to objectify that. And of course, the problem then becomes is you add Bollinger band width to our problem chart, you add the Bollinger bands, and now you have an even more complicated chart to try to identify that situation. So I'm going on my end here, Tyler, to move to the GoNoGo chart.
Yes,
of the
GoNoGo squeeze.
The GoNoGo squeeze slide, because you were several minutes behind on my end, so I really don't know what's happening, so I apologize about that. But hopefully that's clear with everybody, that when we add all of this extra stuff now, including trying to identify squeezes, we get an even more problematic, complicated chart. But what we did then with GoNoGo squeeze, that fourth tool, that fourth component to our chart, is try to zero in, for lack of a, well, for a poor pun, if you will, but to zero in on the importance of the zero line. We know how important it is. We know that when all of the blended inputs to our momentum oscillator in neutral territory, the oscillator is going to hit zero, and that gives us that objective level that we can use when securities are trending. So now with the squeeze, for every bar that the oscillator remains at zero, we allow the grid to build. Because what we're looking for then are situations where momentum has been neutral for an extended period of time, meaning there's very little directional pull. There may be heavy trading, maybe heavy volume, but there isn't a winner in terms of whether we are on the positive side of momentum or the negative side of momentum. So we can visualize that squeeze. We can visualize that reduced volatility period by just looking at the climbing grid of the GoNoGo squeeze. And when it rises to its max, we can then look for the break of that squeeze. So in this case, this is a reversal type of situation. If you follow the chart from left to right, we were in a no-go, price moving down, making lower low. The oscillator in negative territory rises to touch the zero line, gets rejected, comes back up to test the zero line, and then gets stuck there as price moves sideways in what looks to be a bit of a base. So then when we see that break in the other direction, positive momentum when in a no-go trend, then that's very important for us, and we see the go trend then follow suit. So
that's really what technical analysis is trying to do for us. We are visualizing the behavior of investors. And right here is this tug of war where the price range itself becomes narrow, right? Volatility is compressed. We're still at zero, but we're also seeing a lot of heavy trading, right? We can see the heavy volume here at tighter and tighter price ranges. Now, all else being equal, in a no-go trend, right, we expect that this zero line will be our level of resistance, and it would be rejected back into negative territory, and price would continue to fall in that no-go trend. When we see the break above the zero line, when we have enthusiastic buying in a no-go trend, it means there's a real threat to the longevity of that no-go condition. And indeed, momentum is a leading indicator of the price panel, right? We know that trend following is by its very nature a lagging indicator. We're not trying to capture the absolute low. We want to get in when the herd is moving in our direction. We want to follow that. So we're seeing that leading indicator with the break out of the squeeze. Now we can get more aggressive. We can enter earlier when we see those significant breaks of a GoNoGo max squeeze. That means the tug of war, if anybody's watched Squid Game, right? The team that wins tug of war has a very dominating effect over the other team. And that's the same thing in markets. When there is a clear directional bulls or bears taking control of the market, that's when all traders pile in that direction of that trend. So that's where we get the high velocity move. Let's go back to our examples of international seaways and the US dollar. Let's just see how this might work in practice. Okay, so we're looking at international seaways. We're seeing end of summer 2022. The trend is really moving strong in a go condition. We're finding support at zero. We come down to test the zero line, right? There's a lot of congestion, right here. Market is digesting those quick gains in international seaways. But when we see the break back into positive territory, positive momentum, indeed, that surge of momentum leads to high velocity price gains. And we come back close to the zero line, maybe not quite steady riding, but vacillating there around the zero line before breaking to the downside. And that's where we see the no-go trend take over. Let's take a look at that chart of the US dollar, right? Trend reversal, where again, we've been in a go trend. We've found support at the zero line repeatedly. Now we're building this max squeeze, and we see a break below the zero line. It comes back to retest zero, right? This concept of polarity. I know we're using a little bit of technical terminology here today, but divergence and polarity is another really important concept, where when something has been support for a time, once broken, can become resistance, and vice versa. So our zero line was support through the go trend. We break below, we come back to retest, and we're rejected to the downside. That precedes the no-go trend in the US dollar index. And again, we're seeing that resistance again here in early 2023. So let's look at perhaps our more traditional chart, the things that we go through with our clients, right? Try to tell me where you can see trend reversal for the US dollar on this chart, right? There's a lot of analysis paralysis being introduced here. There's a lot of subjectivity. And then we are not making data-driven decisions when we start to second guess ourselves when we're looking at a more complex chart than what is actually helpful to us. All of the information, extremely helpful. All of these tools, very, very powerful. But we don't want them to get in the way of us making data-driven decisions for our portfolios. So let's look at some current examples, Alex. I'm gonna turn to this chart of Apple, and let's take a look at where we're at right now.
Yeah, this is an example of Apple that came across our screens a few months ago now because of that max squeeze that fired off in the middle. This is an almost perfect go trend. You see the higher highs and higher lows. You see the counter trend corrections and then the trend continuation icons. And Apple has been a great performer for much of the year. You can see how we are currently in a strong go trend. We've recently found support again at the zero line on heavy volume, that blue ribbon at the bottom. And we've just seen recent trend continuation as we hit new highs. So a very strong looking chart for Apple. The next one, I think, is that current chart of Facebook that we were talking about. We'd show you at the beginning. After we saw how that no-go trend happened and we saw how clear that rollover was, Facebook based and then gave us a go trend. And we can see how that was really started with that max squeeze break. You can see there in December of last year, the go trend identified, price moved sideways, a little bit of consolidation, very small price bars, lots of compressed volatility, and then that max squeeze break as we moved higher. Then there was that big gap in the middle. Another thing just to point out, the ability to do traditional technical analysis because there's nothing else on the chart. We know how important gaps are. We know that gaps should provide support. This looks like a runaway gap, and you see the support found by the price as it enters that gap, goes towards the lower half of it. And then we go breaking again. We have a max squeeze and we go higher. And we've got those trend continuation. Right now on Facebook, we're in a strong go again, and we are at zero. So very important now for the Meta ticker to see if we can hold the zero line and find support again.
And Alex, as I look through our Q&A here just real quickly, I have to say MetaStock audiences are fantastic, super engaged, staying right with us every minute. So let's answer a couple of questions. I know BB had a few. Obviously, you can choose bars, candles, whatever works best for you to guide your charts. There was some question about getting an MBA and then forgetting about all fundamentals. And the way I would answer that is that fundamentals drive all long-term trends. Fundamentals are very important. However, what any given Wall Street analyst says about the fundamentals doesn't really have any bearing on the market. The market doesn't care about any bank's opinion on any stock that they cover. And more to the point, as an investor, let's just think about, maybe I want to put some money to work with Taiwanese semiconductors companies. Do I know the first thing about their management team, about their facilities? Have I toured their chip making plants? Absolutely not. Do I see at certain times that trends in the information technology sector, and in particular the industry subgroup of semiconductors, are leading the markets, and in fact investing in foreign securities versus just US might have some relative strength advantage? Absolutely. But do I have to be an expert in semiconductor manufacturing or biotechs or even cryptocurrencies? I mean, just ask my daughter. Do I really know how a blockchain works? No, I definitely don't. But I can be a responsible participant in those trends using what we have here from an objective lens. All of that fundamental information that we know, and everything that we don't know, and everything that we don't even know that we don't know about these companies is reflected in the price. That is the most important part for Alex and I, is that in terms of how we would do our analysis and to be a well-rounded, diversified investor, there's no possible way we could have the depth of fundamental knowledge about each and every one of these different industries and different companies. But we can, with technical analysis, be an informed investor in every single sector of the economy. The other question was, can we draw trend lines right on these charts? Absolutely. I love that question, because we do it all the time. We annotate these charts. Maybe you're a big fan of Fibonacci extensions and retracements. Throw them on this chart. And because the chart is so crystal clear, you can see those important levels without cluttering your view of the price action itself. And there are a few other questions, about short-term futures trading. Absolutely. One of the things we mentioned at the beginning was that all time frames are going to work the exact same way. So whether you're looking at a monthly bar, right? If you're a very long-term asset allocator, maybe you just rebalance your portfolio a few times a year as a self-directed investor. It works the same way on a monthly bar as it does on a 1-minute bar. And the one thing that I would add is that if you're looking at very long-term charts, right? So if this is if we're looking at a weekly or a monthly, while that period is still in play, particularly when we are in a very volatile market, large moves in either direction, the bar will paint in real time what the trend conditions are telling us. So on Tuesday of the week, it might be in a go trend, and if we've had a very heavy several days of selling, it might move to a neutral or a no-go trend. The point being that when that period is over, nothing is ever changed, nothing is ever restated or reconfigured. It locks in at the end of the period. So when we think about our trading rules, if you're trading a 5-minute chart, that 5-minute bar closes, you have your signal, and you place the trade following the end of that period. All right. One more question to answer here. I want to find strong stocks in each sector. Can we do that with GoNoGo? Absolutely. Sounds like we have a research reader in our midst. And yes, we do that top-down approach every week in our research. And then, of course, beyond the weekly research, let's see if I can get to the next slide. We do offer premium research, which includes daily individual trade ideas, where we're drilling into not just the relative performance of each sector versus the index, the benchmark, but also the industry subgroups within those sectors that are leading. So just last week, we were talking about the financial sector being very beaten down. We've seen some banks collapse in the regional and municipal side. But there are strong performers within financials when you look at insurance brokerage firms or reinsurance companies. And those are outperforming their industry group and, in fact, outperforming the financial sector and outperforming the market. So certainly, if you want to have broad-based diversification, it is a market of stocks, not a stock market. And you can really dig into those things. Yeah. So, Alex, we've got... Why don't we just show one of those examples and then move on quickly to show the implementation features that MetaStock has got. Sounds great. ANET? Yeah, ANET was just one that came across because it's been in a go trend. We had a really strong move, but then we saw the max go-no-go squeeze. So we were sending out that note to make sure that people paid attention to what happened on the break of the squeeze. So that was a really a strong go trend with several higher highs. But then we saw that max squeeze build at the end of that move, and then we wanted to pay attention to that. And it, of course, broke down from that max squeeze, telling us that there was a problem with the go trend, telling us that momentum was no longer on the side of that go trend. And in fact, then that happened to lead us into a change in trend to no-go bars.
So at the moment on ANET, we're in a strong no-go, oscillators below 0. But if you want to scan forward to the slide about explorations, we did want to touch on that. I know we just got about a minute or so.
Sure.
Let's hit the commentary first, because that's such a fantastic piece of the implementation. We love to explain. We love to educate. A big part of our roles in our previous, in my previous career was training at places like Bloomberg and Wiley's CMT prep course, and educating people on how to understand and use technical analysis. So the fact that in MetaStock we can provide commentary is very exciting for us. And so you can just hover or click on any bar in MetaStock, and up pops an interpretation from us about what that bar is telling you, whether or not there's an icon on the bar, what it means, what the trend is, if there's a squeeze building. And so you get that on every bar when you click on it in this implementation of the commentary by MetaStock. And then, of course, the next thing we wanted to just make sure everybody's aware of is the ability to scan, to use MetaStock's explorations to find these GoNoGo setups. So you can search through MetaStock's entire security set to find Go trends, new Go trends, new no-Go trends, to find icons such as trend continuation, to find securities that are in a max squeeze where there's compressed volatility. You can find all of that information, through the Russell 3000 or whatever it is that you're looking at very, very quickly, and then of course link out to charts and take it from there. But those extra features in MetaStock, very powerful and incredibly useful. We have some other examples, but I know we're probably out of time, Tyler. I don't know.
Yeah, absolutely. So Jeff, Kelly, everybody at MetaStock, thank you so much for having us back to this week's summit. It's a pleasure talking with all of you. And for Alex and I, we're leaning on the lessons that we've learned from some of the legends in technical analysis. Many of whom we got to spend a lot more quality time with, again, last week at the CMT symposium. But happy to answer any other questions, Jeff, if there's time.
I heard that the CMT symposium went really well.
I heard somebody call it the Coachella of charting.
Oh, ooh.
Pretty good time. And we were able to close the markets at the New York Stock Exchange Thursday, up 2%, sunny days. Felt like all the stars aligned. It was a really wonderful week.
Alex, I meant to also at the beginning, I just wanted to clarify a very important fact. I meant to say that both of you are Beard of the Club winners.
Awesome.
Sergio says, "Great job." I think we covered most of the questions. I really appreciate you guys coming in here. I'm going to talk a little bit about how to get GoNoGo and MetaStock and the charting and that kind of stuff. But you guys do such a great job. I really appreciate your coming in. And for all of those, I know that we had a number of symbols that came in through the course of the event. If you would like us to send you a chart, we'll be happy to. Metastock.com/sales-chat. We'll be happy to send you whatever we want, or whatever we want. We'll send you whatever we want to. And,
some short-term futures, some Axon. Yeah.
All right. Very good. Thanks, guys. I appreciate it.
Thanks so much, Jeff. We'll see you real soon. Take care.
Absolutely. Okay, let me go ahead and make myself the presenter here. Show my screen. Go ahead and kind of clean up a little bit. Okay. All right, very cool. And I think that's good. Let me know if there's any issues in the control room. And I want to say thank you for all of the presenters so far. Great job. Okay. Let's talk a little bit about GoNoGo. It's something that we released last year. It's also been a very, very, very popular add-on. And Tyler and Alex, they do a really good job of talking about it, but they did talk about the trend. If you're a MetaStock 18 user, the trend is now included. It's available as part of MetaStock. And you can get that free trend template just by right-clicking on the chart and applying the template. I think it starts with GNG or GoNoGo, something. You'll be able to find it. If you can't, email us and we'll help you find it. As part of the GoNoGo add-on, the GoNoGo Charts Complete, you'll also get the oscillator, the icons, the squeeze, the notifications, all of that kind of stuff in a very, very well-rounded presentation. Thing. So with it, you're going to get the icons. You'll get clear, with our expert advisor commentary, you're going to get clear English definitions and explanations of what's going on in every bar when you're looking at it. You get the identification of the trends. You'll get the explorations that are included as well. And here at the event, we're going to do a special price. So normally, the cost of GoNoGo would be $14.95. That's a one-time cost. If you pay $9.97, and we'll back that with a money-back guarantee, we will include, we'll give you a $9.97 price, and we'll include a 30-day money-back guarantee. We'll also include bootcamp training, trial to MetaStock. If you haven't tried MetaStock, you may not be aware of it. If you haven't heard that MetaStock's been rated the #1 price program in its price category for 30 years in a row by the readers of Stocks and Commodities, and maybe you're playing with it with a different platform, we'll give you free access. You can evaluate it. You can take a look at not only GoNoGo, but also our award-winning MetaStock program as part of it. So you can give us a call, 800-882-3040. All of the offers that we do today are going to be available at metastock.com/conf-promo. And you can also visit us online at metastock.com/saleschat. So there you go. Let's actually answer a couple questions. Actually, I think we've caught them all up. Vladimir, reach out to us at metastock.com/saleschat. We can send you whatever charts that you're interested in. Sergio, thank you for the great job. And Jeannie says thanks, or yes, please. And I'm not sure what exactly she's saying yes, please for, but but if you need something from me, let me know. All right, very cool. Let's also look at, let me see if we have anything that we're kind of sitting on YouTube. If you are watching us on YouTube, make sure to hit like and subscribe. Like really helps us with the algorithm. We appreciate that. And subscribe will also help us out as well, and it'll help you because you'll get other conferences like this. In any case, take advantage of that. 800-882-3040. Another great add-on from some great people. So let's go ahead and we will talk a little bit this time about the CMT Association. Tyler is going to come back a little bit later in the week. He's going to talk about the CMT Association, but we do appreciate them. They've been a part of the summits and the conferences and the events that we do here for a couple years now. And they're a very well-accredited organization. They do systems development, portfolio management. But one of the things that was really eye-opening to me, and I think you'll find this in the seminar that they're running, when Tyler talks, is if you are looking to manage money, or if you're looking to become a money manager, if you have funds under asset, they have a lot of research that's showing you that CMT designation could be very, very helpful in what you're doing. So if you want to find out more about that, cmtassociation.org, 646-652-3300. So there you go. So Ashik, I believe that GoNoGo is available on version 17, although if you haven't upgraded to 18, you don't necessarily have to get the GoNoGo. It's available on version 17, but version 18 is an awesome upgrade. It's one of my favorites. You should really look at doing that too. But to answer your questions, thank you for your interest. Yes, it's available on version 17. So there you go. All right, cool. Oh, it's my turn. All right. And of course, we're MetaStock. I'm going to talk a little bit about MetaStock and that kind of stuff in just a minute. I'm the next presenter, so I'm going to read a legal disclaimer. Today's actually, I'll recite it from memory. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading, and MetaStock shall have no liability for any investment decisions based on the use of this software, any trading strategies, or any information provided in connection with the company. So, hope you enjoyed that. If you're a MetaStock user, let us know. Type yes in the comments, and just actually tell us what version you're on to. I'm kind of interested, but for those of you that are using MetaStock, I very much appreciate that. Thank you. So in any case, let's go ahead and kind of, I hope you enjoyed that. Let me go ahead and I'm just kind of getting things situated so I can keep an eye on all of the questions and that kind of stuff. So as I've mentioned a couple of times already today, one of the things that we're super proud of with MetaStock is it's been rated #1 in its price category for 30 years in a row. And we are going to be doing Okay, that slide was a little bit out of order. We're going to talk a little bit about MetaStock and kind of what it can do for you and kind of why it's been rated so highly. But we really appreciate that. Let me tell you a little bit about me. I'm not going to spend a lot of time on me because I don't care. But like I've been here at MetaStock for, I think it's 26 years. Is it 27 years now? I don't know. I had to look at my my profile on LinkedIn and see. But I love working here at MetaStock. It's something that I started a long time ago. And as you can see here from there, actually I started in 1997. So when I started here, we were owned by Reuters. Reuters then became Thomson Reuters. Then it became Refinitiv later on. We were owned by Reuters, wholly owned. About 10 years ago now, we actually purchased ourselves back from Reuters, but we still have a really good relationship with that and with them. And the thing that's really cool about Refinitiv now, basically, is they're one of the best data providers in the world. So, and just to give you some numbers, they've put about $1 billion into their software. They've got thousands of actual reporters and hundreds of different news bureaus around the world. It's literally a competitor to Bloomberg in terms of the amount of data and the quality that they have. And so one of the things that we offer as part of our services is actually the platform that they spent about $1 billion in. But we have a great relationship. It's been very, very advantageous to us, our relationship with Reuters, because if you're watching us from India, which I know we have quite a few Indians in the audience right now, you're probably using MetaStock. You might have been using MetaStock. We offer data in Australia, London, Singapore, Sydney. There's basically a couple hundred of exchanges that we offer data for. And it's just not futures exchanges, stock exchanges, Forex, whatever you're interested in. If you're interested in really good, high quality data, we can provide it to you via our relationship that we have with Refinitiv. So I'm not going to try and get too off onto a tangent in there. Let's go ahead and talk a little bit about what I'm going to talk about today. MetaStock is a huge platform. We're going to be talking, shown a lot of how to use scans with it and how you can scan trading ideas, all that kind of stuff. Tomorrow, Kelly's going to come in, and actually Wednesday, Kelly's going to come in and he's going to talk about some of the power tools in MetaStock and kind of how you can use MetaStock as a scanning and testing and kind of all of the tools that are really included. Tomorrow, we're going to have Scott come in and he's going to talk about our forecaster. One of the things that I would say about MetaStock is it is a software tool that's been developed for decades. 30 years in a row, it's been rated the #1 software in its price category. And we're probably making it for close to 35 or 40 now. It isn't a software program that's just popped up in the last couple of months that it doesn't have any ability to scan, or it just has a few methods in it. It's something that's been very, very well designed over the years. So what I'm going to talk about today is some of 3, maybe, we'll see how it goes, maybe 2, looking at the time, 2 of my favorite systems in MetaStock, and maybe a 3rd one. And kind of, these are what I call the hidden gems in MetaStock. So if you've been using MetaStock for a number of years, actually nobody said yes. I know we have MetaStock users. Type a yes in the comments if you're using MetaStock right now. And if you're using MetaStock, I hope this is helpful for you because it's some of the things that I've been including in MetaStock, or some of the things I would consider the hidden gems of MetaStock, if you would. So there you go. Let's go ahead and kind of get started. So the first one is, gem #1, is a system that's in MetaStock called the Rahul Mohinder oscillator. And this is actually the first method that I ever spent any money on. So with the Rahul Mohinder oscillator, it's generally a trend following methodology, or a methodology that looks at the trend. So you might have heard many times before, maybe not, the trend is your friend, or a rising tide lifts all boats, et cetera, et cetera, et cetera. The method that we're going to be talking about today is called the RMO trading methodology, and it's designed to help you identify the trend. It was developed by a good friend of mine, Rahul Mohinder, who is actually going to speak tomorrow. But he's a seasoned trader. He's a panelist on CNBC and CNN India, has maybe half a dozen different offices throughout India. And he actually teaches people how to trade. And he's been a great dealer of ours. But the story behind the RMO, just to kind of thank you, Kishore. All right. Also, in just a second, I'm going to need some symbols from you guys. So if there's any particular stocks that you want to look at, type the symbol in the comments, and let's go ahead and get a few symbols. Bless you, Kelly. Okay. So Rahul has been a prolific dealer of MetaStock for a number of years, and very, very popular. He's helped us build a market in India. And one of the things I remember, this was probably 15 or 20 years ago, Scott Brown and I had him in the office, and we were like, we want to see kind of an example of what you're showing people and what you're doing with people. What do you teach people how to trade? And there was quite a few different methodologies that he used, but the one I'm about to show you is one that we liked. Well, we liked them all, but we made a deal with Rahul, and we said, hey, we would like to include your methodologies in all of the versions of MetaStocks. Okay, BB, we're going to look at Oxum. So we liked his RMO method for looking at long-term trends in the market. And so what we did is we bought it. We bought rights for it from him. And we've included RMO in every version of MetaStock since, I think, version 10. Aaron wants to look at Ford. We'll look at Ford with RMO. There's a couple things that I really like to show RMO. There's some reasons. I've put them on the screen here for you. But the reason that I like to show RMO on a chart is it's easy. If I do a pretty good job of explaining to you, you're going to be able to deploy it with MetaStock. It's also objective, so it's not subjective at all. It's very, very clear. It's actually pretty simple as well. Okay, we're going to show you how to use the RMO trading methodology to do stops. And I'll tell you this, you can use it on any time frame with different instruments. And this is a class when I kind of go and show people RMO when I'm traveling overseas, which I haven't done a lot of, or since the pandemic. I'll say, hey, give me some symbols. Let's look at the symbols you're interested in. And I like it because it's flexibility. It works pretty well. I wouldn't say it works on all of the stocks. And certainly when the market's sideways, it has a lower hit rate than when it's trending. But it's a very, very simple methodology that you can apply. And I think like one of the things that we're going to promote to you throughout the conference this week is either an extended trial where you buy a month of MetaStock and get a second and third month for free, or a free trial with thing. But the reason I like to show RMO is because I could come in here, and we'll talk about scanning and testing and all these other things. But I think if you start to trade, if you're new to the markets and you start to trade with RMO, it's something that's available in MetaStock. If you start to use it in your tradings, it's going to be something that's of value to you. So that's why I like to show it. It's objective, et cetera, et cetera, et cetera. So lots of comments coming in here. There's Axon, GE. XOM went down below 200 and then back up. Well, we'll look at it with XOM as well. From YouTube, okay. We have Aaron asking for Ford and Silvery Stars looking for Pepsi. So, okay. Let's go. We're almost ready for those stock symbols. Let's go ahead and talk a little bit about what it does. So the RMO, 3 steps. I'm going to cover all of the steps for you. And the first step is to identify the primary or the prevailing trend. And when I kind of say the primary or the prevailing trend, those are kind of the terms that Rahul likes to use when he's talking about it. You could also read that if you kind of wanted a similar way to understand it as a longer term trend. So what is the stock doing as a long-term trend? Because if we want to trade with the trend, okay, so that's what we're going to do first of all. Let's go ahead and go into MetaStock here. I'm going to go ahead and close out my chart of TLTA. We'll go ahead and click on no. Close out a couple of other charts here. Actually, let me just hit File, Close All. I'm not sure. I've been playing with MetaStock a little bit as we've been going today, and I just want to kind of get to the point where we're looking at a clear chart. So right here, this is our charting console. Right here's the time. I'm doing okay. I'm a little bit behind. It's all right. What we're going to do is we're going to open up some charts. So right here, we've got charts. These are kind of the major tools in MetaStock. You've got charting. This is a quote list. We call it the quote center. Explorer, that's our scanning engine. You can use it to scan for just about anything that you want. System tester, we probably won't play with it all today, but tomorrow we will. Wednesday we will. The forecaster, Scott's going to talk about the forecaster, but these are all the power tools in MetaStock, and you can get to and from the Power Console here. So the first thing that we're going to do is we're going to open up a bunch of charts that you guys want to look at. So let's start with GE, XOM, Ford, PEP, and the SPY for Aaron in YouTube. What I'm also going to do is BB put in the XOM, or the symbol XOM. I'm not really sure what the symbol is, so I'm just going to look that up real quick. So I'm going to go ahead and click on instrument search here. I'm going to go ahead and look for any of the symbols that are available, and we'll look for it by name. And we're going to say that it starts with AXON. Oh, AXON. Okay. So I can't search for symbols if I'm not sure what the symbol is. I can actually look for it. And axon.o would be the refinitive symbol that we're going to use. So go ahead and I've got 1, 2, 3, 4, 5, 6. I've got 6 charts that we're going to open up here. And you can open up as many as you want. I've just put a space between them so that it knows that we're looking at a different symbol. Now, to apply the RMO indicators, what I'm going to do is from the Power Console, right here where it says Apply Template, what I'm going to go is I'm going to go ahead and click down. I'm going to go down to the RMO Trade Model. So here we go. Okay, RMO Trade Model. We're going to go ahead and click on Open Chart, and it's going to open up those charts for us. So we'll go ahead and kind of take a look at them here. I'm just going to kind of window them off so we can kind of get a view for them. And I think we're going to start with this GE. Okay. The reason I'm starting GE is it's loaded. It's XOM was a bad symbol. Let's see if we can find it's XOM symbol. Okay. Must have just typed that one in wrong. Okay. Get the symbol right on that one. And PEP is a .02. Okay, so we'll go and fix a few symbols. I'm going to start with GE, and we'll go ahead and kind of take a look at that. Okay. And we'll spend most of the time in GE when we're looking at the RMO Trade Model. Okay. Step 1, identify the trend. Okay. So with identifying the trend, obviously, the first thing we're going to look for, if you remember, is the primary or the long-term trend. Okay. One of the things that the way we're going to do that is we're going to look at this Rahul Mohindar oscillator. Okay, let's go ahead and kind of make this full screen real quick. And then, did I close it? No, I actually hit the wrong button. Let's make this one full screen. Okay, and let's talk a little bit about how this is designed to work. Okay, so this is measuring the primary trend or the long-term trend of the stock. If it's above 0, we're going to say that it's bullish long-term. Okay. If it's down below 0, which it was right here, I'm going to just basically kind of draw a circle around this. If it's down below 0, like it was right here in this area, then it's going to be bearish long-term. Okay. So for the vast majority, we're looking at from October 19th to current right now in this view, the vast majority of this time, the RMO oscillator has been up above 0. And because it's been up above 0, it's going to be what? In a bullish state. Okay, so as long as it's above 0, it's bullish. That's that simple. Okay, if it's down below 0, then it's going to be bearish. So right here, for a few days in December, it knocked down below 0 and was bearish. Okay, just 3 days. Okay, step 1, identify the long-term trend. Are we above 0 right now? Well, yes, we're above 0. So that means that we're bullish. This also corresponds right here. You'll see right here at the bottom. You've got this RMO bullish, RMO bullish, RMO bullish. Here's the 3 days where it went bearish, and here is where it went bullish again. Okay, so the rules for that is simple. If it's above 0, it's bullish. If it's below 0, it's bearish. Okay, and you can either look at the indicator, as you can see up here, or you can look at the trend ribbon at the bottom. Either way, you're basically reading the same thing. Now, Rahul does like when he teaches how to do this. And if you use this, I would recommend you go up to our YouTube channel and watch a video. He does recommend that you ignore size and shape. Keep it simple. If you're above 0, it's going to be bullish. If you're down below 0, it's bearish. Okay. So what does that mean? Well, if we want to trade with the trend, we want the long-term trend to be the direction that we're trading. So if it's above 0, we're allowed to buy. If it's below 0, we're allowed to short. And it's not a trigger to enter. Okay. If it's above 0, you're not allowed to short. But if it's below 0, you're not allowed to long. So you want to trade in the direction of that primary trend. And just because it goes from below zero to above zero, that isn't a signal to get into the market. Okay, there's three things that we want to watch for, and the long-term trend is just the first of those three things. Okay, so one thing that I'll point out already is we've had a pretty dramatic upward move for GE. Okay, during the point of this chart where we've been kind of almost all bullish with the exception of those 3 days, we went from where a price of about 53 to a price of about 100. It's doubled in price during a sideways market, right? During that whole time, with the exception of 3 days, if we're just following rule number 1, we're not taking any short positions. I would say that if we're trading in the direction of the trend, we're kind of putting the odds in our favor already. Okay, but that's all you have to do. This is basically, it's either bearish or bullish long term. Okay, so let's talk about step number 2 or rule number 2. And for that, we're going to measure the short-term trend. Okay, so before we measured the short-term trend and the long-term trend, now we're going to kind of just, or the long-term trend, now we're going to kind of shorten down and look at the short-term trend as well. Okay, to look at the short-term trend, I'm going to come to this, what Rahul has called swing trade number 2 and swing trade number 3. Okay, I'm going to go ahead and make that full size like we did before. And what I'm going to do, I actually prefer a slightly different view for this. I prefer it to be a line and not a histogram. And with MetaStock, it's pretty easy. You can change anything you want to. We've made it easy on purpose. We've made it look very much like an Excel product or like a Microsoft product, where you click, you can drag and drop, you right click to go to properties, you can double click, click and pick. We've tried to make it a very, very user-friendly program. Okay, but if I want to change swing trade number 3 here, I just want to change the way that it's viewed. I'm going to right click on it and go to properties. And what I'm going to do is, instead of changing that, instead of looking at a histogram, I'm going to look at it as a line. And the reason that I like to look at it as a line will become a little bit more evident when we start talking about the blue line. But for now, I want you to ignore the blue line. We're going to kind of focus on kind of the pinkish line on here. And I want you to kind of look at this. This is also viewed as a histogram. You'll notice that it also is above 0 or below 0. And we read it the same way. It's very, very simple to read this thing. This indicates the short-term trend of the stock. If it's above 0, the short-term trend is also bullish. Okay, so right here, if we're looking at the hard right edge, the side that we're trading, right now we're bullish short-term and we're bullish long-term. And that would mean that we're allowed to trade. Okay. We're allowed to go long. Okay, if we're bearish short term and bearish long term, we're allowed to take short positions. But again, they have to match. Okay, so if we're looking at a weekly, or if we're looking at the long term and it's bullish, and the short term is bearish, we're going to wait for them to match. Okay, we want to be patient when we're trading. We want to put the odds in our favor, and we want the long term to match what the short term is doing. We want to avoid as much as we can the kind of the indecisive moves of the market. We want to, Steve Bigalow said it best. He didn't say it this morning, but it says it all the time. You don't want to trade indecision. You want to trade the decision. So if we're looking at GE today, long-term we're bullish, and short-term we're bullish. That means we're allowed to take a long position if we get one on the chart. Okay? And that's simple so far. So we'll recap. Oh, and before we get back into the PowerPoint, let's go back here. You can look at where this red indicator is. You'll notice that when this goes down below 0, the color of the price bars go down to red. Okay, if it's down below 0, it was here, you have red price bars. So like we could with the longer term oscillator, it was giving us the trend ribbon. If we want to look at what the short-term indicator is doing, we can either look at the pink indicator up here, or we can look at the color of the bars. And if the color of the bars are blue, short-term we're bullish. If they're red, short-term we're bearish. Okay. If we're looking at it right now, short-term we're bullish, short-term we're bearish. We actually have, well, we'll get into that in just a second. So again, there we go. Okay. So step 2, we've identified the long-term trend. Step 2, we've identified the short-term trend. And just to make sure I'm covering the rules, if the primary trend is bullish and the short-term trend is bullish, you're allowed to buy. We haven't talked about triggers and stop losses and all that kind of stuff. That falls into step number 3, okay? But if they don't match, you're not allowed to trade, You're allowed, there is scanning in MetaStock. We've talked about it. You can run different scanning and kind of come up with a methodology that does match. But if they don't match, you don't want to trade. You want them to match. Okay. It's not a trigger. We'll talk about the triggers right now. Okay. If they don't match, again, run a scan. Find something that matches. You want the long term to match the short term. Let's talk a little bit about how you did identify the very specific trade setups, okay? And to identify exactly where to trade, what I'm going to do is actually going to go right here to this area on the chart, okay? I'm going to kind of zoom in. I love that with MetaStock 18, I love the little splitter bar, so I can kind of adjust on the fly exactly where the zoom level is. I love the new charting object in MetaStock, but I want to kind of just talk a little bit about if we just started to look at GE, how we could kind of evaluate it, and how Rahul is very specific about where we should put our stop losses in and our targets and all that kind of stuff. So we're going to start right in this area, okay? Again, these were the 3 days that I circled earlier where we were RMO bearish. We're just going to pretend, for the purpose of just showing you how the system works, that we started looking at this right around Christmas time of last year, okay, 2022, okay? We just went from a bearish to a bullish space. But if we're looking at it here, we're bearish short term, but we're bullish long term. So we're not going to do anything. We're going to wait, okay? Right here, we get a little bit of where it goes above zero. Oh, I forgot something. And this is important. Okay. This has to do with how the signals are formed. You'll notice right here, we have a buy signal on the chart right here above on 1230. Okay. And I forgot to kind of cover exactly how that happens. Okay. So as we talked about just a second ago, very important, I almost missed a very important part of the demo. Right here, this is measuring our short-term trend. This blue line is the medium-term trend. And we don't really care if it's above zero or not. What we're looking at it is kind of, we're looking at it to measure the momentum or the direction of force in the market, is what Rahul calls it. So what we're looking for particularly is when the short-term trend is kind of lagging down, you're going to get a negative value. When it's bearish, you're going to get a negative value. When it starts to go up, the trend is starting to get more bullish than it was down here. Okay, not necessarily bullish, but more bullish, right? It gets bullish when it goes above zero here. But what we're looking for, and what Rahul teaches you to look for, is a change of force or a change of momentum. And what he's specifically looking for is for this pink line to go up above the blue line. So right here, you had that change in direction or that change of momentum or that change of force happened right on this bar, okay? When that happens on your chart, when it's a bullish shift of momentum, that gives you a buy signal. Actually, that's not the same button I meant to push. So when that happens on the chart, you'll see this buy signal form. That just tells you that there's been that shift of momentum that he's looking for, okay? So when you find that shift of momentum, that's a signal to trade. But you only want to trade it if long-term you're bullish, okay, which you are, and short-term you're bullish, which you are, okay? I'm just going to go ahead and get rid of a few of these ellipses on the chart. So if we're looking about here, we're right here on the 27th, we're bearish short-term because we have a red bar, but we're bullish long-term. Here we have a shift to where we're now bullish short-term, okay? But we don't have a signal to trade. We're still waiting for that shift of momentum. That's the third ingredient that we're looking for. Once this happens right here on December 30th, and if we run in a scan for stocks that had a new buy, this would have come up. And if we look at GE at that on December 30th, this is a valid buy signal because here's the process we would go through. We have that shift of momentum, okay? Check. We have a long-term bullish trend, check, okay? Step number 2. And we have a short-term bullish trend, which is why we have a blue bar. Step number 3. Once all three of those things match up, that's a valid buy signal, okay? And this is the bar that we'd start to look at a trade, okay? Now, there's a couple different things that he'll look for, but once you get this on the chart, what I'm going to do is I'm going to determine where I want to enter the stock, okay? Now, to do that, I'm going to grab my horizontal two-line tool in MetaStock. I'm going to look at this high. I'm going to look at the high on the bar before it, and I'm going to say, okay, well, this one I think is barely higher. So I'm going to go ahead and put in a line right above that high, okay? And what I'm going to say is, okay, if it goes above that high, which would be the higher of the value today or yesterday, that is the entry spot. Okay, so unless this goes ahead and breaks my 65.87 price, I'm not going to buy it. Okay, I want it to break the highs. I want that an additional signal that the momentum is going to come in. The other thing that you're going to want to look for is a stop loss. Okay, you want to have a stop loss in mind in advance. I think it helps with kind of the discipline in trading and that kind of stuff to know, okay, here's where I'm getting in. Here's where my stop loss is going to be. And if I hit my stop loss, I'm going to go ahead and get out. It allows you to have a good understanding of kind of what your risk is. Okay. Now, there's two different ways that Rahul teaches to look for stop losses. The first is looking at the low. So we looked at the highs. If I looked at the low of this bar or the low of this bar, I'd say that this low is a little bit lower. That's where you can put your stop loss. Okay, right here. Okay, that's the first way that he teaches. He also says the other way is to look for a recent support area. So I'd say, okay, well, right here seems like a pretty good support area for me. I'm going to give myself just a little bit more room on this trade. If it goes down below 62, this support area here, that's where I'm going to get out. Okay, so you can use, I'd recommend you play with them and decide what you want to use best, but I'm going to go ahead and use 62. So I know right now, on this day, that if tomorrow, if the trading goes above 65.87, my entry point, I'm going to go ahead and get in. I'm going to write that down so I don't have to keep looking at the line. Okay. If it goes down below 62.30, okay, I'm going to go ahead and get out. Okay. I know based on that, that's my risk. Okay. 65 is my entry point. 62 is my exit point. Okay. So it's about 3 points, 6 points. Pay no attention to my math skills. Okay. And I think that one of the biggest things they talk about in trading is discipline's important. I think by knowing where you're going to get in is helpful. And knowing exactly before you get in, where to get out is extremely helpful. I don't know if you've ever been in a trade and it kind of goes against you and you're like, oh, well, where am I going to pull the plug on this one? Have you ever let it go to 60, 58, 50, 55? At some point, you want to be able to you want to know what your stop loss is before you get into the trade, because that allows you discipline. Okay. I'm not looking at 62.29. 62.30 is exactly the price that I'm going to get in and out of. I'll have a disciplined approach. I'm not going to marry GE. I'm not going to let it slip below 60 and 50 and 40 and 30 before I make a decision to pull my losses and get out. The thing about trading is I might mess up the timing, but if I keep my stops tight and I respect my stops, I'm going to be able to trade again. And with trading, the way that it's gotten lately is trading doesn't have commissions that are associated. It's a lot less expensive to trade. So if we get out early on GE and decide we're wrong, we can always buy back in. There's not a penalty to do that. There is a penalty to hold a stock that's going against you for too long. And it's a very measurable penalty as well. So just a little bit of a soapbox here. Let's go ahead and get in here. But discipline is very, very important. You want to trade with a disciplined mindset. Okay. GE gapped down with the market on 1.4. No indicator could have not. And that's correct. That's one of the things that you do when you trade. I've been gapped down where I stopped out on a trade and ended up getting out lower than I expected. And that's just something that happens if you're trading stocks. That just happens. But it's a good comment, BB. It just happens. And that's why I said, that's why I phrased it the way I did. I have a pretty good idea of what my risk is going to look like. So, and it's a good point. I'm glad you said it. All right. So let's go ahead. Here we bought. Okay. And then the market, GE, started to go up. Went up pretty well right here. And then as the market does, it's going to start to correct a little bit. Okay. So I'm going to go ahead and kind of zoom out a little bit. Here we had a nice little run up. I wish every time I bought up a stock, it flew up 15 points, but that's what happened in GE. And sometimes it does happen and you're like, yeah. But here we went up about 15 points. It started to get a little bit more stagnant as it kind of got a little bit extended. And kind of went into a bit of a sideways matter. Okay. We had enough of a sideways action that you'll notice that we had a cross of momentum right here. Okay, so right here we had the short-term trend cross down below the medium-term trend that gave us this sell signal. Okay, that appeared on the chart right now. Now, if you're a trade and you get a sell signal, but you're in a long trade that's doing pretty well like this one, or no matter what, as long as you're still in a bullish trade, I'm gonna have to hurry. As long as you're still bullish, okay, and long term, and you're bullish short term, then you're not gonna do anything. You're just gonna wait, okay? Because if this starts to weaken more, what's gonna happen is your short-term trend is gonna weaken, and your long-term trend is gonna weaken. But generally what'll happen is you'll have a bit of a sideways move or a pullback. It'll set a new support level, and then it'll start to reset its momentum. Okay, so right here, we have a move up. It got sideways a little bit. We have this sell signal. And then maybe a couple weeks later, this happened on the 8th, this happened on the 15th. Maybe a couple weeks later, we had another buy signal in the same direction, okay? When we do have a buy signal in the same direction, there's two things you can do. There's one thing you should do, and there's another thing that you can do, okay? The first thing that you should do, and this is not negotiable, is you should move your stop, okay? We've moved up. We've set a new bit of a stop level or a support shelf here, I'd say, in this stock. And so what I want to do is I want to kind of change this to a profit protection stop instead of a stop loss, okay? And I'll use exactly the same kind of methodology I used before. Here we have our lowest point. This I'd call our support area for here. I'm going to go ahead and put it right under there, okay? So now what I'm saying is if it goes down below 79.57, I'm going to get out. Okay, I'll go ahead and write that on the chart real quick, 79.57. Okay, and most of the time you'll stop out. That's just kind of the way that it works. Here, it didn't continue to move on. It shelved for quite a little bit of time. Here you had a sell signal. You had another opportunity to move that stop, and I'm just going to move it up to right here under this one. So move it up just a little bit. I would say the price of that is now 81.04. I'm going to actually change that to say 81.04. Okay. Okay, let me go ahead and click OK on that. Let me go ahead and kind of zoom out a little bit more. Okay, we didn't stop out on that. We had another nice little move up. Here we had a high signal. I'm going to call that this. Yeah, I'm going faster because there's one other thing I want to show you. The problem is two things. But here you had a move of your stop. Here you had another move of your stop. So in the case of GE, which is a great case scenario, right now we'd still be in a long position. 93 would be our stop loss. Okay, we'd be waiting. We just keep moving it up. As long as this trend keeps happening and moving, we want to stay in there. Okay. Oh, actually, there's more chart data left. Let's go back a little bit more. Here, we had another buy arrow. Probably put my stop right there. Okay, and we still haven't stopped up. So our stop's right now at about 95. Okay, but you see how easy that is? One of the things I love about it is its objectivity and its simplicity, okay? But we're also keeping in mind the trend. We're putting our stop losses in. We're using a good, solid money management program as well to kind of manage our losses. One of the things that the RMO method is not good at is getting in at the bottom, okay? You'll notice that we had a bottom right about here. And it wasn't, well, actually here we had a bit of a bottom. Actually, this, in the course of this example, did a pretty good job of getting us in pretty close to the bottoms here. But if we're looking at this GE from the bottom right here, I'd call the bottom at about 48.80. The first time we really would have got a trade consideration is right here at about 53. And we would have been considering, actually, no, probably 55, okay? This does a really good job of kind of keeping you in a trending stock and kind of just locking in big parts of profits. One of my favorite technicians of all time is a person by the name of Dr. Alexander Elder, who just, actually, he's also my favorite. He's just coming up next. It was actually Robert Deal, and he used to say, bulls will make money and bears will make money, but pigs will get slaughtered. With this one, what we're looking to do is identify stocks that are trending. Long-term, they're trending up. Short-term, they're trending up. And trading in the direction of that trend and taking good pieces of profit out of that trend, okay? It doesn't do a great job of identifying an exact entry at the very bottom. It's a trend-following methodology. So understand why you're trading. and what is driving those. BB, I really appreciate that comment. I'm going to go ahead and send it to everybody. So there you go. Let me go ahead and send that to everybody here. Okay. There's one other thing I'm going to show you real quick. I'm looking at my time, and I need to wrap up just a little bit. But there's one other thing I want you to kind of be aware of in MetaStock, because this is very good trend following system. Another methodology that people like to look for breakouts. If you're familiar with that kind of technical methods, like the turtle traders looked at the very first famous technicians looked at stock breakouts for long-term breakouts, and that's a scan you can run in MetaStock. But there's another set of tools in MetaStock that I'm just going to show you real quick. And I'm sorry we didn't have a chance to look at some of the other tools, but I want to kind of make you aware of one other one, or some of the other symbols. This is a great one. Again, if we didn't have a chance to look at the 6 different stock symbols, it's just because I managed time poorly. But if you are interested in kind of finding, looking at RMO charts, get in touch with our sales team. You can get a hold of them at metastock.com/sales chat, and they can send you any chart that you want. Second hidden gem of MetaStock is called dynamic trading tools. I'm just going to show you. We'll apply it to this General Electric chart. What I'm going to do is going to apply a template. I right-clicked on the chart, choose to apply template. We're going to go to dynamic trading tools. I'm going to go ahead and apply it. Okay. Now, what this does is it's going to identify key areas of support and resistance on a chart. Okay, so if you're interested in finding stocks that are breaking out of, like say, a longer term or shorter term support or resistance, or 3 trend lines, this will not only plot them on the chart for you. So you notice we had a bit of a trend line that was drawn. This was drawn by the software. Okay, you also have a bit of a longer term breakout right here. Longer term resistance was shown here. You'll also, there's a bit of a shorter term. You can see that here. Okay, here's a trend line that was going down. And interestingly, a trend line that was going up. We actually kind of broke through a wedge pattern here. Okay, these are actually automatically drawn for you, so they're super objective. But the reason I like them is because they can allow you to scan. So if I wanted to find stocks that are breaking up above a longer term trend line, like right here when GE broke through this longer term trend line, that's a scan I can run. If I wanted to find a stock that was breaking through a longer term area support level, or resistance area, I should say, right here, that's a scan I can run. Okay. Also, we have the shorter ones. And these are scans that are in MetaStock. If you want to find stocks that are doing breakouts, just come in here to the Power Console, go ahead and click on the scanner. And what I'm going to do is I'm going to go ahead and click on search right here. And right here, if I want to find like longer term breakouts of trend lines, I'm going to go ahead and run this trend line breakouts. Okay, I've got it set to run the whole S&P 500. And if I just click on start scan, it's going to chunk through all of that data. It's going to tell me any stock that is breaking up above a trend line or down below a trend line, and how many days ago it went. Okay, so I'm not gonna let that finish just because we're going to move on to the next presenter in just a few minutes here. But this is just going to give me a list. And one of the questions that we get a lot about MetaStock is what sets you apart from charting platform ABC. One of the things I would say is like the wealth of the tools that are available in MetaStock. That's a big one. Scanning for me is such a huge thing. The ability to go in and kind of scan any market that you're interested in any of the 300 different global exchanges, it's just huge. It's something that I use every day. And actually, it did finish that exploration. So if I look on the break up, here is the stocks that have broken up. And GE was on that list. You saw that on the chart, but it happened about 200 days ago. If we wanted to find something a little bit more recent, we could come down here. And we're not giving recommendations to buy or sell today, but Coca-Cola broke above a longer term trend line today, or within 1 bar. So we could go in and take a look at that chart and see exactly where that happened. CS Diamond broke above 1 bar ago. Diamond, FactSet, this one indicates that it happened 1 bar ago or just recently. So maybe something you could take a look at. Obviously not a recommendation. Go take a look, see if you like it. You didn't hear it from me. So there you go. Anyway, let's kind of wrap up a little bit. And we'll just talk Don't know. Okay, that tooltip finally went away. The other one that we have that I was going to show you, but I never have time for it, is Vora. Vora is a really cool system, and if you're using MetaStock for a while and want to learn more about it, search Vora on the YouTube channel. It's a really, really cool system. So Michael says one of the greatest features is all the gurus and their plans that have been coded for MetaStock. Thanks for that comment. I appreciate that, Michael. I'm going to go ahead and send that to chat too. All right, let's get to the. Do you want to talk here? We do have two versions of MetaStock. We have a real-time version and the end of day. And I did mention just earlier that Zenith is a data feed that they spent about $1 billion on the data feed. It's an institutional feed. It's very, very much like a Bloomberg, and it does come with a lot of news and information. And later in the week, we're actually going to come in and talk about Zenith and kind of, if you're interested in fundamentals, it's one of the best places where you as an individual trader can come and get signals or fundamental research. It has a lot of the institutional stuff that Refinitiv is famous for. Okay, with MetaStock, you can get their $1 billion platform plus MetaStock for about $265 per month with data. So that includes Zenith real time. It includes all their news, their information, a lot of their research reports, a whole platform that we haven't even opened today, but also includes MetaStock, which is the scanning engine that we've been talking about. So it's $265 a month, which is, I know it's a fraction of what you pay if you're an institution, but that's where it would start in terms of an individual pricing. Okay. We also have an end-of-day version, which includes MetaStock, includes all the scanning, everything we've talked about today, and that's only $69 per month. Okay. As I had said at the start, it has been rated #1 in its price category for 30 years in a row. It's not a program that was kind of came around and was designed a couple years ago and like has just like a handful of features that you're just going to grow out of it really, really quickly. This is something 30 years. It's a mature product. So it's been designed with lots of trading methodologies and a lot of stuff in there, including the ability to scan, which the expert advisor commentary, the built-in systems. It's a huge program. Anyway, what we're going to do is if you pay for a month of MetaStock, we are going to give you a second and a third month for free. Okay, that'll include MetaStock 18. It'll include the data for whatever data region that you want. We have a service, we call it a white glove installation support, where if you're new to MetaStock, what they'll do is they'll set up an appointment with our support rep where they'll sit down with you for an hour and they'll, well, actually it's a 2-hour window, so it usually goes a lot longer than an hour, but they'll make sure everything's installed. They'll answer questions. They'll kind of give you a tour of the program, and they'll specifically be interested in kind of talking to you about what you want to get out of the platform, whether it's using RMO or the scanning or the testing or whatever it is that you're interested in. They're going to help you understand the tool and how to use it. So you're going to get that. We do offer, and I love our support desk. We keep more people in our support team than we keep in sales and marketing put together. If you're ever going to have any questions, you can give us a call. You can chat online with us. You can send us an email. We'll answer it. One of the things I also like to talk about is if you're a MetaStock user and you do contact our support desk, they're going to ask you how you liked it. And one of the things that I like more than anything is that we will go weeks and weeks and weeks at a time where we have perfect 100% surveys out of support. They do a great job. The dedicated team right here, they're right across the office, they're right outside. They're not like some outsourced thing that doesn't know anything. They're very, very well versed in the software, and that's what they do. So you'll get that. And we'll also give you a home training course called Unleash the Power of MetaStock. You can go through it as you will. There's a class on RMO in there. There's a class on scanning. There's a class on some of our other favorite systems, and it's all in there for you. So let me break it down. Basically, if you are interested in the end-of-day program, and you want to try it for 3 months, you'll pay $69, and you'll get it for 3 months. So that means you'll pay $23 per month. So May, June, July, you'll be running this into August. Well, into July anyway. June, July, August. Well, August. Okay, $23 a month to try the software that's been rated #1 in its price category for 30 years. And if you do the real-time version, you're going to have access to all of the research that's available to institutions and the hedge funds and all of that great Zenith platform. All that's going to be available for you as well. If you don't want it, if you don't like it, if you don't think it's going to help you with your software, there's no ongoing commitment. Just cancel. But this will allow you 3 months to try the software that's been rated number one for 30 years in a row. So if you want to get more information on that, you can give us a call, 800-882-3040. Visit us online at metastock.com/saleschat and metastock.com/conf promo. There you go. I did skip a lot of that, but I did end on time, so which is great. Let's go ahead and kind of just talk a little bit. I'm going to talk about stocks and commodities this time. Stocks and Commodities has been a sponsor of the Online Trading Summit and the MetaStock Conference for 10 plus years now. We appreciate them. They do a great job. If you do that 6-month subscription or that 3 months of subscription to MetaStock, you're going to get 5 months of Stocks and Commodities magazine just for doing it. But we really do appreciate Stocks and Commodities. It's a great magazine. I've been getting it since I started my job here, and I really appreciate the work they've done in sponsoring the events. So there you go. Sergio says amazing. I'm glad you enjoyed it. Thank you. Jax, I don't have time to talk about exit swing signal just because we're out of time, but it's another way. Give us a call. We'll show you a video, and we'll talk to you a little bit more about that in person. Sergio, thank you. I appreciate that. Okay, I think we were caught up with that. All right. Let me go ahead and go here. We'll talk about CMT or AAII. This time around, we'll talk about one of them next. So thanks for all of our sponsors for being so good. So metastock.com/conf promo will get you any of the specials today. Metastock.com/saleschat, 800-882-3040. So let's go ahead and talk about, Alexander Elder, Dr. Alexander Elder. I'm going to introduce you, okay? I can see it already. Alex has some of the best books on technical analysis. There's Coming Through My Trading Room. And which one of the books that you've written are the ones that you talk about your technical analysis? There's the one that kind of comes to my mind is where you're like, I woke up in a hot sweat about thinking about this trading idea. Do you remember which one was that?
Not hot sweat, but Jeff, I wrote many books, several books. They're quite different from each other. There's no repeats. But if somebody hasn't read anything by me, first of all, there is an ebook, and you can get it on Amazon or you can get it from elder.com. It's called To Trade or Not to Trade. This English guy, Shakespeare, stole my title. To be or not to be. Kidding. To trade or not to trade. So that's, lots of people get into trading for own reasons and they have no ability to trade and they're unteachable as far as trading is concerned. So that book will help you to decide to go forward or to back out before the damage is done. So
one of the things, before I let you go, and I understand we're going to kind of do this together, so I'm going to pull charts and we're going to talk about it. But one of the things I want to say is I don't know if you know how much I talk about you.
My ears are burning.
Yeah. I often refer to you as one of my favorite technicians. I love your take. You call MACD histogram the most powerful signal in all of technical analysis. Yeah. But I think you're one of the greats. So welcome. Thank you for coming and spending some time with us.
Thank you very much. Thank you, Jeff. And just to finish the question, if somebody is really interested in trading and wants to learn how to do it and do it right, my main book, if you're going to get only one book, the one to get, The New Trading for a Living. The first Trading for a Living book came out almost 30 years ago. The New Trading for a Living is really my life's work. And it's the only book, there are lots of books on different aspects of trading. It's the only complete book on trading. It covers psychology, technology, money management, and self-management. It's published in 16 languages, translated and published in 16 languages. So you can pick it up in all the European and major Asian languages. If you want to read it in Thai or Japanese or French or Spanish, The New Trading for a Living. And the Turkish edition is coming out soon, but Turks are slow. So it will be 7. So it's 16 languages now. It's going to be 17 after Turks finally get their act together.
Michael says, I have all of Dr. Elder's books, but very helpful in my daily investing and trading.
Well, thank you very much. I'm happy to. I wrote that book. I didn't have the slightest commercial idea when I was writing any of my books. I wrote them for a beginner, like I used to be 5-10 years before I wrote the books. And so I wrote the book as a manual, as a guide for myself. So and I think that's why so many people find them useful. It's not written to promote anything. It's just the book is the product. There is no hook in the book. It's everything. Cool. So we'll talk about the markets. And Jeff, instead of preparing a PowerPoint, I remember when we first talked about this event, I suggested to you, let's do it without a PowerPoint. PowerPoint is a wonderful tool for a marketer because you can find. Give me an hour and I will find you the best examples of everything, and I'll show you how everything is brilliant. And then you go home, and for some reason it doesn't work like that. Jeff, I hope you're drinking vodka there. It's such a long day.
It's coffee.
You sure?
Yeah, I'm positive. Like if I drank any liquor, I'd just be taking a nap. That's all it does to me.
All right. No, just pulling your leg.
Yeah.
So what I suggested, let's look at real life markets using real life MetaStock template that you guys have, and let us begin. Maybe give me 5-7 minutes to explain what it is that you see on the screen, and then we will be taking questions from our participants, looking not at things that I have prepared, just looking at my second screen to see if any questions are coming in. I guess not.
We have tons of questions. Yeah, there's tons of questions in there.
How come I'm not seeing them?
It's not under the chat. It's under questions.
How do I get the questions? Because I'd love to be able to see them and answer them directly. I go, let me call my tech person. Pat?
Michael?
Jeff is saying it's not on the main page. I went to YouTube/MetaStock.
Oh, no, okay. Yeah, there isn't a lot of YouTube questions. There's a ton of GoToWebinar questions, though. So, all right. Yeah, the last thing that was said in YouTube was, thank you for a great presentation to me. So.
So to go to questions here. Okay.
Yeah. And we will get questions on YouTube too.
Okay. But if you can please, 1 sec, Jeff. You told me MetaStock, so I set myself up. I set myself up for MetaStock. Thank you. Turn it on.
Okay, Maria says, it was a pleasure to meet you at the Las Vegas Money Show a few years ago.
That was a long time ago. I haven't been to Vegas in ages. I haven't been going to many shows because it's so busy in front of the screen. Okay. Yeah, I'll get it. It is questions. Fantastic. All right. Now I see it. Cool. If I can only make font a little bigger. Any idea? Okay, well, more or less visible. Okay, Jeff, lots of compliments to you. You're certainly a marathon runner with this conference. I tried to log in at the wrong time before because we're in different time zones, and I see you're going at the same speed all day long. Nobody else could do it.
This is fun. Well, I could do this all week.
Say again?
This is fun. I could do it all week.
All right. Glad to hear. So let me just say a few words about what our participants see on the screen, on this chart on the screen, and then we'll start taking questions. I believe in simplicity. You take a program like MetaStock, and there are probably a couple of hundred of indicators and tools. And the trouble, it's on one hand, of course, it gives you a tremendous amount of researchability. On the other hand, there is a danger in that. You can come with an opinion. I'm a bull, I'm a bear. You're looking at a stock, and you have all these tools, and you can always find a confirmation of what you think. You're a bull, you will find an indicator that confirms that. You have a bear indicator that confirms that. So you've got to avoid being seduced into using too many tools. And I call my approach 5 bullets to a clip. An old army rifle had 5 bullets. So a trader is allowed 5 indicators. And if you really need it badly, 6, 7, you're in trouble. So I use 4. That's what I have on my screens, and that's what I trade with. So here we see a chart of happens to be General Electric. I just noticed that Jeff selected it. So first of all, we're going to look always at 2 time frames. We will make strategic decision. I'm a bull, I'm a bear, on a weekly chart, and I will make a tactical decision. Where do I enter? What is my target? Where is my stop on the shorter term chart? So strategic on the weekly, tactical on the daily. Other than that, the charts are set up the same way. And what you see here is the chart, and this is the weekly. Maybe open it up a little, Jeff, just expand a bit on the screen. So that's it, thanks. No, not okay, that's enough. And what you see here, as the old song goes, you don't need a weatherman to tell which way the wind is blowing. General Electric is rising and rising very nicely. We'll see much more difficult charts, I'm sure, today. The first tool I want to put on every chart is a pair of moving averages, a short one and a long one, a short-term and a long-term moving averages. And that to me defines what I call a value zone. There is price and there is value. Price is easy, price is marked on the chart, but what's the value of this stock? Well, a fast-moving average defines a short-term consensus of value, long-term moving average, long-term consensus. So I always say value lives in the zone between 2 moving averages. And then there is a set of envelopes on this chart, ATR channels. What do? Markets are manic depressive, and they oscillate between depression and mania. The 3 ATR channel primarily, and there is also a tool called that I developed. A well-designed channel shows you when the stock is manic or when it is depressed. And since the market is cyclical, it constantly cycles between mania and depression. And you can see if you go back a year, Mr. General Electric was quite depressed in the middle of the chart, was hitting the lower channel line, and that's of course where all the let's go to the right edge. Let's go to the right edge so we see the whole chart.
Oh, okay. Do you want me to zoom out?
Right. In the middle of the chart, you see how, Jeff, just let it be how it was before.
Okay. I will stop playing.
Okay, that's it. So you can see this double bottom a little past the middle of this chart. And that's where GE was depressed, and that's where idiots were selling it short. Well, right now, GE is manic. And I'm sure there are people who are buying it and feeling very happy, but I always think depression doesn't last and mania doesn't last. So buying a manic stock is probably not the best idea in the world. So that's for the quick strategic view using a pair of moving averages and envelopes. In the next pane below is one of my favorite indicators. It's MACD lines and the MACD histogram. Would be nice, Jeff, if you could make the histogram just 1 degree thicker. Seems a little faint. Very flexible program, MetaStock. You see how easy it is to make it look exactly how you like it. And finally, last but not least, at the bottom, in the bottom pane, is the indicator that I developed and by which I live pretty much every day, force index. I think it's the best way of using volume in trading. You know, having just a bar chart of volume never speak to me now, but force index described in all of my books combines today's volume with today's price change. And you can see, by the way, here that as GE is rising, force index is sagging. So makes me double cautious about chasing this manic patient as he dashes about the building. I'm trying to think of a headline. Let me just take a look. I want to make sure I give you the exact headline and not just quote myself. Warren, there is this annual meeting of Warren Buffett's company going on in Tulsa, and I'm looking at his quote. Warren Buffett says, "Investment opportunities come from other people doing dumb things." Other people doing dumb things. So if you're a serious trader, you're not going to take money from other serious traders. You're going to take money from idiots who don't know what they're doing. And there are plenty of, well, there are very few idiots actually, but gamblers, lots of gamblers on the markets. So chasing stocks on the way up and selling them short at the bottoms. This is what good technical analysis allows us to identify. And they then take a very calm, cold, independent position and trade differently from the crowd. So that was a very quick intro of what my reading of the charts is, and I think now we can start looking at questions. Jeff, you're probably watching them much more closely than I do, so you can tell me what it is you would like us to look at.
I think it might make sense for us to start with kind of to look at like the general market, maybe the Dow or the S&P.
S&P. How about S&P?
That sounds good to me. I'm going to go ahead and go to a weekly first.
S&P, yeah, so weekly chart first. Now, another thing that I would definitely do, that I always do, is when I look at a broad indicator such as S&P, I want to look at several indicators outside of the immediate index. I said earlier that when it comes to a specific ticker, I have 4 tools. A pair of moving averages, envelopes, MACD, histogram, and lines, and force index bracketed also in ATR channels. But if I want to look at a broad market, I want to look at several other things. And the first of them is what I think is the best leading indicator of the stock market, and that's the new high, new low index. I take the number of, and I watch it every day with great attention. How many new highs are there in the markets? Because the new highs are the leaders in strength. And how many new lows there are in the markets. And I do this not in one time window, but in 4, in a monthly, quarterly, yearly, and then on the daily charts, and then also on the weekly charts. What's absolutely unusual at this point, that for the last several weeks, those numbers are very equally weighted. The number of net new highs, and new lows, is very, very similar. I'm looking at my second screen here on my side, and if I look at the new high, new low index. 1 second. New high, new low index. So right now, as we speak, in the monthly window, there are 457 new highs and 348 new lows. In the quarterly window, 202 new highs and 208 new lows. In the yearly window, 102 new highs, 116 new lows. These are very stressful numbers in the sense that the market is not making up its mind. And another point of view, every weekend I run several scans. I look for my trading universe are the 500 stocks from the S&P 500, and my scans they usually weighted. They may be 80 bullish finds and 20 bearish finds. So I know I should probably be trading more long than short. But now the numbers of those scans are just so crazily similar. So the outside indicators, the outside tools that always help me define where I am in the market are not being very helpful now. And so just look at this chart, and I say it's stuck in a trading range. I would draw a horizontal line across the February peak. This is not the current peak, it's the peak that happened on your chart, Jeff. Right. Here, if you can draw a horizontal line. And then another line at the December low, based on the December low. So the upper line is at about 4,200 for the S&P. The bottom line approximately 3,750, 3,800, and waiting for the breakout. And having said that, the bear market that began in December of 2021, that's when I began shorting and shorting heavy. That bear market has not been proven reversed. A bear market consists of lower lows and lower highs, and now it's gone horizontal, but we don't have evidence of a bull market yet. The S&P must take out this 4,200 level, and not just a little breakout and then comes back 3 days later, but a decisive breakout above 4,200 would turn this market bullish. Without that, we have to give Mr. Bear the benefit of the doubt. My view of the S&P. We'll take a quick look at the daily chart, if you like. Once again, bearish divergences. So we can see that last week, before this drop, before the Fed-driven drop happened, the S&P took out, made a new high for April. So there was a high peak in early April and then another peak later. Jeff, maybe open this chart quite a bit so we can really by 50%, so we can zoom in.
Just tell me where to stop.
Perfect. Okay. Perfect. Right. So you can see the peak in early April and the peak in late April, much higher. And that peak, by the way, looks like a finger pointing to the sky, which is a very nasty pattern. Those fingers, or as one of my translators named them, kangaroo tails, very often mark market reversals. If you go, for example, many examples on this chart, but it was a false upside breakout. Take a look at MACD lines, bearish diversions, MACD histogram, bearish diversions, force index, weak. So the daily chart certainly doesn't look too encouraging for the bulls, and so a bear finds some encouragement.
All right. Do you want to take some questions? Uh-oh. Uh-oh. Looks like we may have missed Dr. Elder. Yeah. Okay. Well, let's see. Might be time to play the video. He did go offline. I do see that he's offline officially. So he should be joining us again pretty quickly.
Individual stocks or anything else, Jeff. It's your concert. It's your show.
Hey, Alex.
You're the conductor. Tell me what music to play.
Okay. All right. Well, I'm glad to have you back. We lost you for maybe 20 seconds there. Can you hear me?
Say it again.
We lost you.
Yeah, I hear you perfectly.
Okay. We lost you for just about 20 seconds.
Okay, well, that's when I was giving out secrets of the universe.
Yeah. The exact highs, right? Here's a question that we have from Mattis, from a beginner trader and a spike trade member. Would you say your approach of trading weekly works more or less well in the current environment compared to historics?
I'm sorry, was that a question or a comment? I didn't quite catch what the question was.
Would you say that your method of looking at a weekly chart is a little bit more challenging in the current market environment?
I don't think so. I think I think being aware that the weekly charts are so balanced makes me doubly cautious in trading and helps me stay out of trouble. It's very easy to look at a daily chart and say, "Oh, this is bullish, this is bearish," and in this environment, trends tend not to persist very well. So no, I think this is the method of work. Look at the strategic on the weekly, tactical on the daily, and in this case, strategy says be doubly cautious, triply cautious if you keep in mind also that we're in the midst of an earnings season, and so before you trade any stock, you've got to look at when the earnings date is. You can do the scan in MetaStock. I like looking at finviz.com. I like earningswhispers.com very much. So rather than get crazy bullish or bearish on individual stock, begin by checking whether it is safe to trade it. Don't open a trading position going into earnings.
BB was wondering if you could talk a little bit about the force index here and how he can use it.
You know, I can talk about it, but it's you really should go to the book with formulas. Everything is disclosed, formulas, multiple examples, but basically just the general principle. Force index has three components: price change, direction, price change amount, and volume that it took to move price that way. So if a stock rises a lot, force index is higher, but if it rises on low volume, force index is lower. So it's a sensitive indicator both of price change and volume that went into it. And I find that two types of signals that are highly useful. One is divergences, of course, but another is when force index goes outside of the 3 ATR channel. For example, right here in the middle of this chart, you can see how force index sank below -3 ATRs. Right here. And that was a selling panic. Basically, gamblers were shorting the S&P, and force index says there's a panic going on. Buying panics and selling panics don't last. If you go further back in January, you can see there was a buying panic when force index right at the top in January, the force index went outside of the 3HR channel. So that's basically how it works. I have it on every chart. I watch for buying and selling panics, and of course I trade against them.
All right, very good. Thank you. I appreciate that. McMillan Jen, and I'm sure I said that perfectly, wanted to look at NHNL for a divergence setup.
We can't because it's not. I don't think we have prepared a template for that.
Okay, no problem.
Also, Jeff, my webcam window covers the chart. Is it only me or is it for everybody?
It is just you. In fact, I think that might be.
Yes, it's me. It's me. It's me.
Yeah.
Yeah.
In fact, since we lost you, we don't have your webcam on.
Okay.
But I wasn't going to worry about it. I was just happy.
Oh, should I? Oh, share my webcam, please.
Yeah. Perfect.
You know, when I go to speak at conferences, I often wear a tie. But I tried trading with a tie and without a tie, and I noticed that having a tie does nothing to improve my performance. So
we do not allow ties at the MetaStock conference.
I'm also fond of saying a man without a tie is like a dog without a flea.
Okay. Let's see. Amit wanted to look at Uber.
Yeah. So before we look at Uber, I'm going to look at my other screen. I'm going to FinViz, and I type in Uber because I want to check when the earnings are.
Okay.
So Uber had earnings last week, so we're allowed to trade Uber. So we have the weekly chart up first. Very nice rally, and rally continues. The rally is now on the weekly chart has reached between 2 and 3 ATRs. And Jeff, tell me, looking at the force index, what do we have at the right edge? We just discussed that.
Would you call that maybe a divergence?
I call it a buying panic. There is a buying panic.
Yeah.
Take a look at the previous buying panic, which was in August of last year. Yeah.
Right here. Yeah.
Yeah. So that pretty much stopped the rally for the next for the next 6 months. When was the previous buying panic? It was in in October, smack in the middle of the chart. What happened after the buying panic? Right? And before that was a great buying panic, but people got away with it because that was in the midst of a crazy bull market, right? So here, this buying panic did not accomplish what it's supposed to accomplish. And when we go to the left, further to the left, there was a buying panic which also nailed the top. So that was before. We have 1, 2, 3, 4 now fifths. One of them failed to deliver. All the others delivered. Somebody finds and shows me an indicator that works 100% of the time. I'll pay any money for it. But an indicator that works extremely well 4 times out of 5. That's what I'm very happy to use it in my work. So there's a buying panic going on. Let's go to the daily chart.
You bet.
So, Mr. Uber is manic. Mr. Uber is above the triple HR channel. And again, if we go back, there was a similar manic episode. By the way, you see the gaps, right? You see the gap that occurred last week. Those were earnings, right? Imagine selling short before the earnings, guessing cron. Trading into earnings is really a guessing game. If a company is honest, they don't leak data. And so those moves can be very unexpected. They can go up and down in a major way. In this case, it went up. And now people are piling into Uber. Previous time it went above the triple ATR channel was in February. Well, you can see what happened next. It went to the upper ATR channel in August of last year, and same thing. So these buying panics, they're great for sucking in gamblers. And this is how beginners trade. Oh, upside breakout, let's buy it. A professional trader looks at it very differently. Is this breakout for real, or is it likely to fail? So I haven't traded Uber in many months, but looking at this thing from my point of view, I would say, well, it's definitely way too late to buy, but it is too early to short. Why? Because the bars using the impulse system, another invention of mine, are colored green. You can see how all bars on this chart are colored. Impulse system described in the new Trading for a Living. It's not a trading system, it's a censorship system. It doesn't tell you what to do. The impulse system tells you what you are not allowed to do. So when it is red, you're not allowed to buy. When it is green, you're not allowed to sell short. When it's blue, you can do anything you like. So you can see if we go to the previous peak in February, green, green, green above the upper channel line turns blue. Prohibition is lifted. You're allowed to sell short. Now we can play. So I'm watching this and saying, well, give me a blue bar, and then we'll dance.
That also handled another question. Hemant wanted you to talk about the force index colors, or not the force index, but the red, blue.
Yeah, well, that's the impulse system. That's the impulse system. And I keep hearing every once in a while. I used to go to traders shows, expos, and I would hear this idiot saying, copy the system. He says, buy green, sell red, buy green. And I'm just saying, man, read the book. Read the book. It's not a trading system. It's a censorship system.
Cool. Let's see. Somebody wants to look at the Russell IWM. Let me go ahead and go to weekly. And this was from Peggy. IWM.
Okay, weekly chart. I'm sorry, I missed what you said. What ticker we're looking at?
This will be the Russell ETF, the IWM. Thank you, Peggy, for this symbol as well.
Well, we discussed the S&P. There's nothing much to add to this here. Okay. We see a bear market, which sort of degenerated into a flat market. So the classical definition is a trend is considered in force until proven reversed. We had a very clear bear market, and there's no sign of reversal yet. So bear market has to be given the benefit of the doubt. If somebody, and again, as I said before, if somebody held a gun to my head and said, Alex, you've got to trade this thing, get out of town for the next several weeks, I'd have to sell it short.
All right. David wants to look at the oil ETF, NRGU.
Why look at oil ETF if we can look at oil, right? Just puzzles me.
All right.
Why look at gold ETF if we can look at gold perpetual contract futures? I mean, why look at the derivative of a market where we can look at the actual market?
Sure.
So light crude. Let's look at the real thing. So
okay.
It's always a good idea to start from the left and go to the right, so we don't just jump into the right side. This wonderful spike pointing down. I mean, speaking about kangaroo tails, this is a kangaroo tail to finish all kangaroo tails. Followed by a very strong bull market, followed by a spike when Russia invaded Ukraine. And by the way, they plan to take Kiev in 3 days and have a victory parade 2 weeks later. Somehow didn't work out this way. They picked on their own guys. But you can, at that point, energy prices jumped because Russia is a major producer, a major seller of hydrocarbons, oil and gas, and everybody expected all kinds of trouble. And you see another kangaroo tail. This is of a more normal size. There was a secondary peak, and from that double peak, a bear market ensued. Oil now cost less than it cost before Russian invasion. And of course, everybody is a trend follower. And so people expect prices to go further and further and further down. However, we see 2 stabs to the downside, one in the first quarter and one just last week. And Jeff, if you can check the low points of both declines, what were they? So in
70. Ooh, it just went away. 71 and I'm getting the ATR instead. 71.67 and 71.37.
Okay, so
this one was lower.
This was 71.
This was a 71.31, and this was a 71.61.
Okay, this is a beautiful picture. This is a truly and really a beautiful picture. There is a massive. So we had a downside breakout last week. There is a massive defining difference between how professionals and amateurs use breakouts. A beginner sees a breakout and says, the new trend is there. A professional looks at this thing and says, could this be a false breakout, which most of them are. So what we had last week was a false downside breakout. It took out previous low and immediately pulled back in. There is a bullish divergence of force index, a bullish divergence of MACD lines. And looking at this chart, and remember, I'm not trading off of a weekly chart, but I'm making a strategic decision. What am I going to do? So my strategic decision is I'm going to look to go long this thing. I cannot do it yet because the impulse system is red at the right edge. But as soon as the red disappears, I will be a buyer. With this strategic decision in place, let's go to the daily chart and zoom into tactical decision making.
Okay. Tell me when I'm zoomed enough.
Yeah, that's good. Thanks.
Okay.
So again, you see this gorgeous kangaroo tail last Thursday. You see a selling panic on the force index, which dropped below 3 ATR channel. And if you look at the previous bottom, which was in February, there was a selling panic there also. And you can just see crowds of people who are gamblers or ignorant running to sell in short. I mean, that's what the selling panic is like. And we had another selling panic last week. So looking at the daily chart, I'm eager to buy this thing. And the only thing is I have to sit on my hands until the weekly stops being red. If we go back to the weekly and zoom in, I think that, and let's zoom in, like, okay. So I think you have an indicator in your template. It's not on the screen right now, but I'm 99.9% certain that it's there. It gives you it's called MACD X over. MACD X over, and it tells you at what point the color will change. Yeah, here it is, Elder, MACD X over. Is it?
Yeah, that's it.
The only thing that changes color. Okay. If you can interact. Oh, here it is. So what's the last point?
85. 68.
85. Say it again? No
85,
way.
68.
No way. Ron, no way. And the price of this thing now?
73.
Oh, no way. Because once it touches the fast EMA, the color will change. We'll have to talk about it, Jeff. Something wrong with the settings. I mean, it's what's the level of the fast EMA of this green line?
13 and 26.
No, but what's the reading at the right edge?
Oh, it is 75.93.
75.93, and the price is 72.87, I think. Yeah.
Correct. Yeah. Mm-hmm.
So we have to discuss settings. Yeah. So it's a couple of dollars away. But yeah, I think oil looks pretty bottomy here.
Okay. Yeah, I'll look into this a little bit.
Okay. Send me an email if you like. We'll compare the data.
Okay. Let's see. Just okay. Very good. Let's see. Going back. Paul wanted to look at NVDA. Would that be okay?
Sure. Oh, NVDA it's actually on my watch list.
Okay.
I didn't have a trade today, but it's definitely very, very interesting.
Okay, here it is. On a weekly basis.
I've got to apologize to all the people who are posting questions. With this mass event, there is really no way. There is a desire, but there is no possibility to answer every question. So
yeah,
NVDA. So NVDA weekly chart. NVDA had a fantastic bullish move this year, and it was linked, I think, to a series, to a big degree, with this whole artificial intelligence chat GPT business, because it requires very heavy duty chips, which of course NVDA sells. And it looks like those who wanted to buy those chips have pretty much got them. So if we look at the right edge of the chart, so the rally was absolutely beautiful. And by the way, the rally began with a gorgeous bullish divergence from MACD histogram by the end of last year. Just fantastic bullish divergence. I mean, I see things like that and say, if you don't trade this, what do you trade? Initial rally pulled back to value, and now NVDA is walking as we approach the right edge. It's walking near the upper channel line. Look at the force index. Very noticeable bearish divergence. How high it was in the first quarter of this year, the force index was, and how much lower it is now. It looks like this is a case of a rally continuing out of inertia. And the impulse system is blue, which means that once I decide to sell it short, I'm allowed, right? So let's go to the daily chart.
Okay.
So the weekly looks toppy and does not interfere with shorting. What do we see here? NVDA is having a good day today. Let's check. What was the high of what was last week's high in NVDA? Yeah, this bar.
Yeah, hold on, just it does not want to say. I just need to point at the bar. Actually, let me get a data window. That'll make it a lot easier for me.
That's it. Real men don't squint at bars.
For sure. Well, I'm also blind in one eye and I can't see out the other.
Yeah.
The high on that week was 290.58, and the
290.58, and today
292.18.
290.58 and 290. So today's a higher high, right?
Mm-hmm. Just barely.
Okay. Well,
just double checking my work.
But the impulse system is green, so shorting is not allowed. Shorting is not allowed, but watching is allowed. And it will take very little to turn this from green to blue. Look at the MACD lines in the next pane. What a great bearish pattern here. Look at force index in the bottom pane. And what a bearish pattern here at the right edge. So NVDA is getting there. Might happen this week. Now, let me just say, it is absolutely not my job to tell you to buy or to sell. I couldn't begin to say that for one simple reason. I don't know who you are. I mean, not you, Jeff, but the person who is watching this video. I don't know your account size. I don't know your risk tolerance, none of the above. And without knowing those things and having given them due consideration, I could not begin to tell you what to do. But I feel I want to give you my unhedged, clear opinion and view. And so what I'm doing here during this event, I'm really thinking out loud. This is how I process my own trades. I look at a weekly chart. It looks attractive. There is no prohibition on shorting. Say, I'm interested in shorting. I go to the daily chart and I say, wow, looks like we might be having a false bullish breakout today. As soon as the impulse system changes to blue, be ready to sell it short, which I'm ready. Actually, I have it on my screen, on my trading screen. No short today because the impulse system is green, but be ready, be ready. And that's now.
All right.
Let me also just interject and say this. We're focusing today really on only one out of the 4 M's of successful trading. Successful trading stands on 4 M's: mind, trading psychology; method, which is what we're doing now; money, which is risk management, essential topic; and then self-management, the kind of homework you do before every trade. In terms of money management, I could give a person the best of my trading systems, and they would lose money with it if they didn't use proper money management. And this is something that's another dividing line between amateurs and professionals. Beginners look at what can I buy, and professionals look what kind of risk am I taking, what is my dollar risk, what is my profit target, what. So I'll never forget when I was a very green beginning trader. I needed to be in Singapore, and I spent a couple of weeks at the apartment of a guy whom I sort of knew from New York, who was already a very successful trader, and eventually he became a very major trader. Tremendous hard worker. And one time on Sunday, I said to him, "Come on, let's don't just sit in front of the screen. Let's go rent bicycles and go for a ride along the beach." So I asked him during that ride, "So how much time do you spend on risk management?" And he thinks, "About 30%. I almost fell off of my bike. What can you do with 30%? I don't think I was spending 3% at that time. Of course, after I grew up and understood what the story was, I still don't spend 30%, but 20%, definitely. Risk management. And by the way, that's one of the reasons that my book, The New Trading for a Living, that's the value that it delivers. Everybody tells you how to find good trades. I also tell you how to manage your money, and not lose too much and make more. Next question.
Vladimir wants to know, what timeframes would you suggest for force index to be used most effectively? Thank you for the question, Vlad.
Well, the parameters are in my book. It's using something like 13 bar force index makes a lot of sense. Maybe a little faster, but nothing's wrong with 13. It's not. Okay. You see, the thing where I'm a little cautious with parameters is MACD, because everybody uses MACD, and if you use standard default values, you have no advantage, and you're actually part of a major crowd. Force index is not used nearly as much, and so setting up some private parameters is less important there.
All right, we have 2 requests, and so let's do one last chart. 2 requests for gold. And I'm sorry, we're not going to be able to get to all of the charts, but let's take a look at gold, if you don't mind.
Of course, gold for the not so bold.
Let me go to weekly first.
Weekly, yes, sir.
GC.
And you know, Jeff, for the benefit of our participants here today, you have seen I always begin with a weekly chart ahead of the daily, right? Strategic on the weekly, tactical on the daily. If we had more time, and if we looked at shorter time frames, day trading, even if you like, I would begin with, let's say, half-hourly chart, then go to 5-minute. Strategic on a half-hourly, tactical on a 5-minute. So always strategic on the longer-term chart, tactical on a shorter-term chart. Gold is on the weekly chart. Gold is in a very strong uptrend. It's sort of in a challenge. It's in a challenge zone. There is a triple top built over the last few years, and far be it from me to say, is this the end of the bull move, or the opportunity to jump to a new high? Because the quality of the rally is very impressive. If you look at the pattern of gold, you can see this very orderly pattern of higher highs, higher. It rallied late last year, pulled back to value, having another rally now. Now it deserves a pullback, but there's nothing in this chart that will confirm to me that this is the end of the bull move. Nothing. Look at MACD lines making a higher peak. MACD histogram never crossed below 0, so there is no divergence. Force index had a beautiful buying panic. Selling panic, where idiots were selling panic in January. So that was a very nice foundation for an up move. Gold does appear a little overbought here. Let's go to the daily chart. And I'm sorry if I'm using bad language like idiots too often, because I was an idiot myself when I started in this business. It's a curable condition in the markets. So on Friday, there was a false upside breakout. Today, prices sold off, bearish diversions. Gold deserves a little pullback here, but I really don't see enough to become a bear on gold. What I would, I'm not trading gold these last few months. If I had to trade gold, what I would do is I would take a small position, a marker position, sort of 20% of what I'm planning to hold, and then suddenly become a gold owner, and then I watch it with great attention without being distracted.
I just read a comment here that made me laugh.
I think that in terms of buying gold, I would want to buy it below the value line, below the thread line, below the value zone. Sorry, Jeff, interrupted you.
No, I read a comment and it made me laugh out loud. So I'm sorry I interrupted you. All right. Well, let's see. Michael said, this is the comment, just so you guys know. Dishing my tie from now on. Thank you very much. And then he said, dishing tie also reduces urge to hang oneself if a trade goes bad.
I'm sorry, I didn't catch. Once again?
You've made a life change for Michael. He is ditching his tie from today on.
As I said, a man without a tie is like a dog without a flea. If you want to be a successful trader, you have to be different. The markets are set up so that the majority of people must lose. Only a smart minority can win. So whatever you're doing in the market, and tie is just a little nothing item, but whatever you're doing in the market, you have to ask yourself: am I doing what everybody is doing, or am I doing something different? Are you doing a homework before the markets open? Well, that would be something different. That's what most people don't do. Are you reviewing your trading diary, your charts from your previous trades? not just charts of today at the right edge, but charts of stocks that you traded 2 months ago. Now those trades are in the middle of the screen, not at the right edge. Are you reviewing those? Are you doing things that will set you apart from the rest? Because that's the only way you can win.
All right, and I want to, I know we've got tons of questions, and we just are not going to have time to answer them all, but I do want to end on this comment because it states much more eloquently than I can exactly how good of a job you do. So Alina says, thank you so much, Dr. Elder. It is so nice to learn from you. I wish we can see you more often in other webinars. I wish we can also to learn from you about psychology of trading. Thank you so much for your great books. And it goes on. No.
Well, thank you very much. Read the books. You may want to visit spiketrade.com, which is a site I run with a very good friend of mine. He started as a student and became a friend and a partner. We run this spiketrade.com, which where our members compete for the best trade of the week, and of course Kerry and I post comments all the time and we answer questions. So that's how we really get communicated. But thank you very much. I just heard the bell. The market has closed. I have to review what happened today.
That was a quick day. Holy crap. Okay.
Well, but I'm not an afternoon person. I'm probably going to go into my garden and do some gardening work, some yard work, which I enjoy, and then I'll light up a fire and smoke a cigar. But I'll be up tomorrow between 6 and 7 doing my homework, and then I will come at 9:30 Eastern time and trade. And I'll trade against people who will show up at the office when market has been open for an hour or two and say, "Oh, it looks good." Well, what looks good? I've been looking at that for 4 hours. You coming now? Come on in. Give me some money.
Well, thank you very much, Dr. Elder. It was great to have you. I appreciate it.
Thank you very much. Thank you, Jeff. Always a
Great
pleasure.
job.
Thank you.
All right, very cool. I'm going to go ahead and we did have a question a little bit earlier from a gentleman that says, I don't have the ATRs for the Force Index. And there was a big improvement that we did just recently within the last few years, not really recently, but kind of recently, to the Dr. Elder disk. And so let me kind of go back into the PowerPoint and we'll kind of talk about it. So we do have the Dr. Elder's Trading Room. It's an add-on. It's been a very, very popular add-on and a great add-on for MetaStock. The Dr. Elder's Trading Room contains all the indicators of trading for a living. Come into my trading room, and in addition, some unique unpublished indicators. So in total, there's 15 unique indicators, 15 unique templates, 8 explorations, 6 expert advisors. What we did with the new version is we actually added quite a few things. And if you have the old version, you can actually buy the upgrade, and you should. It's relatively inexpensive. I think it was like $99, but give us a call. We can kind of help you get set up for the new version. With the new version, we added the Force Index with ATR channels, the MACD divergence helper, which is a really, really cool system that helps you find potential MACD divergences. There's the Force Index with the ATR channels. The biggest thing that I liked in the new version, it's worth it by itself, is the semi-automatic divergence expert. So these list the indicators that are part of that methodology. Here's the templates. In terms of the explorations, you've got that semi-divergence MACD. In addition, you've got the force interbands exceeded. So there's a couple new explorations. But in addition to that, there's a new expert advisor for the Force Index and that MACD semi-automatic divergence, which Dr. Elder did a really, really good job with. So if you don't have those in your Dr. Elder, give us a call. We'll give you an upgrade to the Dr. Elder's Trading Room. It's only, I think it's $99. But if it's not $99, it's a little bit higher, but I will honor the $99 because that's what I said right here. So normally, though, if you're brand new to MetaStock and the Elder's Trading Room disc, it's normally $499. Here at the conference, we're going to do a conference special. We're going to give you $100 off. It's $399. If you're new to MetaStock, we'll give you a 30-day trial with it. data for the regions of your choice, the unleash the power of MetaStock, white glove installation, everything that you get with it as part of MetaStock. So this is a great add-on. And if you like Dr. Elder, what he had to say, you should get this add-on. I feel like I should say it's like one of my favorites. It is, but they've all been some of my favorites today. So anyway, you can give us a call, 800-882-3040, metastock.com/sales chat, or metastock.com/conf promo. Also take advantage of that. So there you go. That's a really good question. I'm curious as to how he would approach banks today as well. There was a ton of questions for Dr. Elder, and I'm sorry if we didn't get to yours. If you wanted to see a chart with some of the indicators that he's talking about, get in touch with us, 800-882-3040, metastock.com/sales chat. We'd be happy to do that. As with everything else, this has a 30-day money-back guarantee. It's only $399. That's a one-time cost. Give it a call, 800-882-3040, metastock.com/sales chat. So anyway, there we go. Let's say thank you to AAII today for sponsoring the event. AAII has a brand new sponsor. We've been working with them for over a year now to kind of help get Raymond Rondeau's methods over to MetaStock, but they're a very well-respected organization. They've been helping traders for decades now, over 2 million traders that they've helped. And you can find out more about AAII at aai.com. But thank you for sponsoring. We definitely do appreciate that. And of course, we're MetaStock, metastock.com/conf promo to take advantage of any of the offers today, metastock.com/sales chat. You can also call us at 800-882-3040. And talk about going from one really great expert to the next. The next one wrote the book on options trading, Larry McMillan. Larry comes in, he does a lot of options analysis. You're familiar with Larry. I don't really need to introduce him. He is such a great presenter and just a great expert. So Larry, how are you doing today?
I'm good, Jeff. How are you?
I'm doing very well. The event's going great. It's great to have you on here. I can hear you. Let me go ahead and get the presentation turned over to you.
Okay.
And we'll make sure we can see your screen and that everything looks good there. Yeah, everything's going well today.
Oh, good.
Ooh. I can see your, I'm going to go ahead and I can see everything that you've got. And get out of the way so you can, it's your turn now.
Okay, thanks. So we're going to spend the next short while talking about the market, and then at the end, I do want to make some comments on the new one-day VIX index, which if you're trading the zero-day expiration options, it can be useful, I think. Anyway, so let's just get started. Just a little background on our company. I started it over 30 years ago as a derivatives research firm. We were publishing, selling data, statistics, newsletters, etc. We moved into money management after the 2008 financial crisis because we made some pretty good calls on that. So we're currently both a CTA in the commodity space and a registered investment advisor also. And then we also do option education in the form of mentoring or webinars such as this, etc. I'm going to come back to this later, but we are making the PDFs of this webinar available at this website, optionstrategist.com/MCM-web. I haven't put them up there yet because I usually, when I go through here, I might find a typo or two. So I'll fix those and I'll put them up when we're done. So what do we look at when we're talking about the market? Well, first and foremost, I look at the chart of the S&P 500 because no matter what your indicators are saying, price is king. So what's happening in the index is what's really happening, and your indicators, if they're not agreeing with that, you should at least understand what's going on there. Also, then we have our favorite option indicator, which is put-call ratios. Then we have an option-oriented twist to market breadth. And then we'll talk about VIX and the volatility indices and the volatility trading products too. So I have a very important rule, and this is kind of coming up back and forth right now. But oversold does not mean buy. So when the market starts to go down, it can get oversold and stay oversold for quite a long time. So you should wait for a confirmed buy signal. And the companion is overbought does not mean sell. So, we had a couple of decent rallies in the last couple of months. And while those are happening, you see the market getting overbought, but it's not a sell until actual sell signals are confirmed. So when we talk about the indicators today, I'll point out some of these occurrences. So here's the 2-year chart of the S&P, just to kind of generally orient you. So we've weathered a 1-year bear market here, the blue line, and now we've got into a trading range. So the question really is the bear market over or not? It seems to me that most people think it is. I'm not really so sure. I'm going to show you a chart later on. But right now we're trapped in this range between about 4,200 here and on the downside here about 3,800. And that even more recently, we've been trapped in a smaller range right in here. So while the market's going nowhere, it can be frustrating for both buyers and sellers. But as it works out right now, you just have to put up with it and trade as the indicators show. So hold on one second. So this is a 1-year chart of the S&P 500, and again you see the trading range there. There's a little bit more detail here. We had an island reversal back here when we topped out in August, and that created this last down leg into what so far is the bottom. That is an important area as far as I'm concerned, because it really needs to be overcome, all these gaps closed up and everything before the market can move higher. So that's another area we're watching besides the 4,200 area. This is the 4,300 right here as well. These little green numbers here, when the bear market was on, we would have these big rallies. Since it's not clear that we're in a bear market right now, I'm not necessarily marking those, but the bear markets do produce these big rallies, and of course they're designed to shake you out of your position rather than let you just freely keep a short in place. So just to kind of summarize this, we broke through that bear market trading range, bear market trend line, and now we're in the trading range. We're looking at resistance of 4,200, which has been tested at least 3 times now, if not more. And then above that is that I just showed you that island up to 4,300. And on the downside, we have the near-term trading range bottom at 4,050, and then the trading range for all of this year at about 3,800. So we'd really need to break out above, 4,300 or well below 3,700, 3,800. I'm sorry, 3,760 was actually the December low. So to have a momentum trade going. So we're not holding a core position right now because of the trading range, but we do have plenty of other indicators giving signals, and we do trade those as they occur. One of the things that we do look at is what I call modified Bollinger Bands. And the reason we call them modified is because when John Bollinger invented the Bollinger Band, he used the standard deviation of daily closing prices as the definition of volatility. But Black-Scholes and other mathematical oriented guys have a different definition. Black-Scholes uses the percentage of the standard deviation of daily percentage price changes. And since we're in the option business, our realized volatilities, which is based on this, and our implied volatilities have to agree with Black-Scholes, because most people are using Black-Scholes or something very close to it. So we watch for the market S&P to move outside of the plus and minus 4 standard deviation bands. And then when they move back inside, we have a signal. We had quite a few excellent signals, but also I thought too many false signals. So we put a tweak on it, what we call McMillan volatility bands, it requires a confirmation. But here's your current chart with the bands drawn on it. So the highest wavy line here, that's +4 standard deviations. The line just inside that is +3 standard deviations. And you can see that, for example, right here, we moved outside the 4 standard deviation and then inside. And that was a sell signal that took us all the way down here to a buy signal, which occurred in March. Now, we typically look for the market to trade to the opposite band. So this was occurring at the -4 standard deviation band. So we're looking for it to get to the +4, which is right here. It hasn't gotten there yet. So it got close, and we did roll up our positions and took some partial profits out of it. But technically, that buy signal is still in effect. You can see the other signals on the chart. Mostly are pretty good. The red letters are successful signals. There's a sell signal right there, 4,300. Got a nice buy signal near the July lows, also near the October lows. This buy signal right here was not so successful. So not every indicator works all the time, but this has been a good one over the years, and it's really one of our 2 mainstay indicators, which we've, literally made tens of thousands of dollars for our customers for buying newsletters at prices well below that. So just to summarize, this has been on a buy signal since March. Recently, we've seen realized volatility decrease as we've gone into this deeper and deeper into this trading range, and that has drawn the bands towards the center, but we still have not hit either the plus or -4 standard deviation band. Hitting the -4 standard deviation would stop us out of the position. We do offer a subscription service to this. We can apply this logic to anything, to a stock, a futures, an index, what have you. So we do that daily, and if you're interested, we send out an email daily telling you where new signals are occurring. All right, well, let's move on to the next indicator, which is put-call ratio. So we use the equity-only put-call ratio, which is all stock options trade. We use that to predict the broad market. Put-call ratios as an indicator were invented by Marty Zweig back in the 1950s when he was taking put and call dealer volume out of the newspapers and, well, really out of the ads that ran in Barron's on Sundays. And he realized that if there was a lot of put volume, pretty soon the market went up. And if there was a lot of call volume, pretty soon the market went down. Now, back then, there were no index options, so he's just talking about, stock options, and usually on the bigger stocks. So, so it's a contrary indicator, and defining what too much put buying is, too much call buying is, difficult. But I think we have done a pretty good job of doing that. By the way, I don't know if you realize, but this is the 50th year of listed option trading. So the CBOE is turning 50 years old this, well, they actually did on April 26th, but they're having their big party in Chicago tomorrow, actually. If you're there, I'll see you. Anyways, the standard put call ratio is the one that Marty designed originally, and it's pretty simple. Let's say it's IBM. We sum at the end of the day, we sum up the volume of all the puts that traded at IBM. Separately, we sum up the volume of all the calls, divide the two, and get the put call ratio. I'm not sure exactly the way Marty puts in the numerator of the fraction, but he did, and it's pretty much stayed that way. I mean, I have seen, occasionally somebody does a call put ratio, but it never really caught on. So when put buying is increasing, of course, the numerator of the fraction is increasing and the ratio is going up. The put call ratio is going up. But when are you likely to have heavy put buying? Well, that's when the stock is going down, right? So they move in opposite directions. Same thing as, you can determine by looking at calls. And so we keep a 21-day moving average. And what we'd really like to see is a chart that looks like this. So we post about 1,600 or more put call ratio charts on our website every day in a section called the strategy zone. And what you look for when you're looking at the charts, and those charts include both the stock price and the put call ratio chart. Let's say the stock is going down here and people are buying puts, so the put call ratio is going up. Eventually, the put call ratio makes a local maximum. That is a buy signal for the stock. Then the stock starts to move higher. People are buying calls. They force the ratio lower. They move over to the left. The ratio is going lower because people are buying calls. Eventually, the put call ratio makes a local minimum, and that's a sell signal for the stock. So that's the theory. If you're looking at a put call ratio chart and the stock is overlaid with it, and it doesn't show this inverse symmetry, then something is wrong, and I really wouldn't use the put call ratio on that particular stock, at least not at that time. So this is not a current chart, but on top is the S&P 500, and on the bottom is the equity-only put call ratio, which you recall I said that's what we use to predict the broad market. And the reason we do is that you can see the inverse symmetry that exists here most of the time, and so it's a pretty good indicator of what's going to happen in the market. So here's the current put call ratio up to date through last night, well, Friday night. And you can see the local maximums, local minimums. So most recently, we had a local minimum right here in late April, and that gave us a sell signal. So that's kind of right in here. I thought we were going to break more than that, but we haven't. Previous to that, we had a local maximum or a buy signal here. Sell signal was back here. So it's caught most of these short-term moves. And we use a computer analysis program to look at these. So even though it's a 21-day moving average, we can tell pretty quickly when that ratio is going to reverse direction, because the program understands what's coming off the ratio from 21 days previously and what's likely to come on now, since from day to day, the put call ratio is relatively similar. So this one is on a sell signal. You can see over the course of the last year has maybe been 10 or 12 signals. So it's not like we're getting them daily. It's more like, once a month or so. Now, as computers came into the business, we were able to calculate another put call ratio, which I think is more meaningful. And this is the weighted put call ratio, or dollar weighted put call ratio. And here, the way we do it is at the end of the day, we take the options price and we multiply it by the volume traded in that option that day. That gives us the dollar volume of that option. Now, in reality, you could do it tick by tick to get the exact dollar volume. It turns out this way is a lot cheaper data cost and doesn't really change the signals at all. We tried it the other way, so we've stuck with this way. It's just faster and cheaper. So at the end of the day, again, let's say in IBM, we sum up the dollar volumes of all those puts, sum up the dollar volumes of all the calls, and divide the two. And now this put call ratio is measuring the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion. So here's the current chart, and you can see it has more extremes. First of all, last October, it actually got way up to the highest level since March of 2020. So when the put call ratio is way up here, the market is showing a lot of pessimism. When the put call ratio gets way down here, the market is showing too much optimism. So you can see there was these sell signals, three major ones anyways, occurred all about this same level down around 80. 80 just means $80 are being spent on puts for every $100 being spent on calls, which is, these are stock options, so typically more calls traded than puts. Index options are not a part of this calculation. But then it rolled over, formed this local maximum buy signal right there, pretty much in line with where the other one was. And now it has come back down near its lows and again given us a sell signal. So both of these are in agreement. They're both on sell signals. This one is coming from a much lower spot on its chart, much more overbought level. But as I said, we're not going to estimate where they'll try to reverse. We'll just stay with it as it goes up here, and then eventually it will roll over, and we'll change course on these to a buy signal. So those sales signals came in on April 26, at least that last one did. So what do we buy when we're get these signals? Here we had a McMillan volatility band signal, or put call ratio signal. Well, I like to buy an option with a fairly high delta because I'm in the business here of predicting the underlying, and I'm not going to try to get too fancy and buy a way out of the money option and find out that I was right on the underlying but wrong because I bought an option that didn't respond. So if you buy an option with a fairly high delta, a call's delta ranges between 0 and 1, for example, and the higher the call, the delta of the call, the more it's going to behave like stock while you're in it. Now, the lower call deltas are deeply out of the money options, and probably not the ones you want to own. So typically we trade SPY options when we get these signals, and we trade them 1 or 2 strikes in the money, fairly short term. So that's going to give us a relatively high delta of 0.70 or so. If we're doing a longer term trade, maybe 2 or 3 months out, then I might go at the money, but even there you still have a delta of slightly larger than a half. And so again, the option is going to be pretty responsive if you're right about where the underlying is going. On TV, you'll see that a lot of times, in fact, almost every time, unfortunately, they're spreading. They're buying a call at a lower strike, and then they'll sell a call at a higher strike. And they do this under the ruse of putting up less money, but I'll show you in a second, you're really not helping yourself at all when you do that. So when you do that, when you sell that second call, you cut off your profit potential beyond the striking price of the call if you're in a bull spread. So is it worth to cut off your profit potential? Well, probably not. The only time it's really worth doing so is when the options are very expensive, and that can be proven mathematically. I'm not going to go into that now, but by and large, here the red line is what your profit graph looks like if you just bought a call. The black line is what it looks like if you did a bull spread. So what's the risk? The risk is 100% in both cases. You're risking 100% what your broker is asking you to put up to buy this position. So it's not less risky. Yeah, dollar-wise, fine, but you can always adjust for dollars. Instead of buying 4 bull spreads, just buy 3 calls or 2 calls or whatever it is, and then you don't cut off your upside. So to me, there's, using a bull spread should only be done rarely. And even if it is done, you want to mitigate the problems caused by selling that other call. So there's 2 ways to do that. One is to spread the 2 strikes in the spread farther apart. So right now, for example, in spider calls, we made a recommendation this morning on a bull spread, and we spread the 2 strikes 14 points apart. But if I was doing a put spread in SPY right now, I'd use a much higher number because the puts have a skew to them. They're more expensive out of the money than the calls are. Secondly, if you're in the position and you're fortunate enough that the underlying hits your short strike, that means you're making money. It's going in the direction you want it to be going. But you're almost out of room. You hit that short strike, now there's not a lot of profit left. So roll the position. So what do I mean by that? Suppose we had SPYs at 397. That was about a week ago or so. And you put on this spread. You bought a SPY 397 call and you sold a SPY 412 call. Then shortly thereafter, SPY trades up, which is good. You're in a bull spread. The underlying's going higher. It gets to 412. Well, at 412, you won't have maxed out. Your spread will not be worth 15 points, which is the difference. But it's going to be worth a good chunk of 15, and you don't really have much room left on the upside. So sell the spread you bought before, take your profit, and buy a new one. Move the strikes higher, 412 on the long side now, and 427 on the short side. So this is the way we treat all of our bull spread positions, and bear spread, same thing on the downside. Roll when you hit the short strike. Anyway, let's take a look at a couple of individual put call ratio charts. Now, when we're looking at individual stock and index futures put call ratio charts, I only trade the extreme local maximum and minimum. I don't trade the intermediate ones. So this on this chart right here, which is Honeywell, even though this is a local minimum, it might be a sell signal. I don't trade that because it's really not at the extreme. Same thing here with this supposed local maximum buy signal. So we look for only the extremes. You can see Honeywell has been a decent responder in the past. It had a buy signal there, then this one here. This one here is a good one. And now we've just gotten a new buy signal. The thing is underway, and we're in this position, but I still think you could probably still get in it. This put-call ratio has a lot of way to fall if it wanted to come all the way down. Similarly with a sell signal, this sell signal here was pretty good. And this one here was also good, but much more short-lived. So Honeywell is a good trader in terms of extreme put-call ratios. The NASDAQ, the company that runs NASDAQ, is recently given a buy signal as well. It's struggling a little bit more to, accelerate here, but it has a good chance of doing so. That arbitrage word in there is what was going on last year in the middle of the year in certain cases, and this is one of the stocks that was subject to arbitrage. I don't want to get into that now. That's for a longer webinar. Here's one we just recommended last week. This is Borg Warner. You can see it came down here to an extreme level and has formed a local maximum like 4 times. I'm sorry, local minimum 4 times. This first one definitely was not a good place to sell. But now these other ones have come with the stock in this area. So what we often do, if we see a support level like right here at this level, which I believe was 46, we wait to see if it can break. It did break last Friday, and so that gave us a sell signal confirmed by a breakdown, and we bought puts at that time. You can also use the same logic with futures options. So this is corn. On the bottom, the put-call ratio chart is the put-call ratio of corn options that trade on the CBOT, Chicago Board of Trade. The top is a continuous futures chart of corn. So you can see it's had some decent signals, and it rolled over here in early March, giving a buy signal. And the thing is, you may not have a futures trading account. Not everyone does. But there's often an ETF that trades. In this case, there's an ETF called corn, which tracks the price of corn. In fact, they actually trade the futures to create that ETF. And so that tracks the price of corn, and you can buy options on that. A more recent one is this one, sugar. Sugar's had a huge bull market in the last eight months or so. And now it's gotten to where the put-call ratio is extremely low. I drew a little red line here just so you could see how low it is. It's actually right down around 20, which means $20 are being spent on puts for every $100 being spent on calls. That's pretty extreme. It tried to roll over and give a sell signal there. That certainly was not a successful one. So here I put a question mark because to me, and to the computer program that we're using for this is not a sell signal yet, but it really doesn't have much choice but to start to rise here pretty soon. And when it does, that will be a sell signal. So we're watching this. Now there is an ETF for sugar, SGG, but the options are so illiquid, I don't really know if you can trade them. That's why I put question marks there. Okay, the next thing that we look at is market breadth, advances minus declines. You can keep a cumulative total of that, or you can keep an oscillator. So there's a couple of data sources too. You can use New York Stock Exchange data, or you can use what we call stocks only data, which means the advances and declines of all optionable stocks. There's actually more of those now than the New York Stock Exchange stocks. There are almost 6,000 stocks with listed options. So here's the oscillator chart going back really almost 10 years. And the green areas are oversold. You can see for most of the last 10 years, we've been in a bull market, so don't get oversold too often. But we did there in December of 2018. And of course, here at the pandemic lows in March of 2020. But now in the last year, when we're in the bear market, you can see how much more time you've been spending in the oversold area. And including last October, we got all the way down to extreme. But as I said earlier, oversold does not mean buy. You only buy when it stops being oversold. So that just happened right now on Friday. Thursday, we were down here in oversold territory. Friday, we moved back up out of it to actually to here. And so that's a buy signal as of Friday's close. Now, we require 2-day confirmation of these, though, because they are very whippy. And today, breadth was negative, so that's not so good. So we'll have to see when I run the numbers tonight whether that buy signal actually has held up. But this is it's a useful indicator, and it's a very short-term one. So we trade it gingerly, I'll say. That pretty much just summarizes what I just said there. Now, cumulative breadth is where we keep a running total of advances and declines, and it's typically used to find market tops. So it worked in June of 2020 to tell us there was no top. That it was telling us then that, you know, the breadth was really good and to go with it. But then by the time we got to January of 22, it was telling us that there was a divergence, breadth was falling off, and the market at that point had not yet, but it was a big warning sign. So that's right here. So the market was still rising here. This is the SPX. Was still rising, but you see cumulative breadth up here had already begun to decline. So that's a negative divergence. It's not necessarily a trading system or a signal, but it's a big, big warning sign, and indicates, in this case, that a bear market was certainly possible, or at least a serious decline. Where are we right now? Well, we're basically nowhere. The top chart is breadth. The bottom part is cumulative breadth on top, and the bottom part is the S&P. You can see they're just kind of running together at the same time. So it's not saying yay or nay on the rallies since last October. It's just sort of neutral. We also look at new highs and new lows. Nothing too fancy here, except that you can see on the bottom left of the chart, that's New York Stock Exchange data. We finally saw new lows overcome new highs, but it had been happening for a while in NASDAQ terms and in stocks only terms, stocks only, again, being the optional stocks. Now, even though we've rallied a little bit in the last week or since then, new lows are still edging above new highs, which is, I think, somewhat unhealthy, but, you know, again, not a crazy huge sell signal, but it is a minor sell signal, minor negative for the market. So that brings us to volatility, which I really want to discuss somewhat. And so there's a couple of things with VIX, just the chart of VIX. First of all, the trend of VIX is important. The market should be trending the opposite way from VIX. And then spike peaks on the VIX chart are buy signals. So a low VIX is overbought, but we'll talk about that more in a minute because low is a relative term when you're talking about VIX. This is just a long history all the way back when CBOE first invented VIX. It was in 1993, where this red line is right here. But they backdated it to 1986 so they could get the crash of 87 in there. VIX didn't exist at the crash of 87, but the CBOE has estimated that it would have traded at 150 had it existed at that time. But since then, we've had many other, and that was a big spike peak, and the market did go higher from there. And all these other spikes were, some of them famous, you know, of course, the credit crisis in 2008, coronavirus in 2020, some of them to a lesser extent, but still violent at the time, the flash crash, you know, subprime debt crisis in 07. Some of those other things, and then just some of these are just, you know, kind of a bearish panic move that made VIX flash higher. So here's the current VIX chart, and the spike peaks are noted on there. Now we have a trading system that we built around these, and the red letters are successful signals, the blue ones are not, and we don't trade overlapping signals. So once the signal's taken, it's good for 29 days. I'm sorry, 22 trading days. If another signal occurs within that time, we just note it like this. So that's why there's sometimes an orange letter next to a red letter. But in any case, we just had a new one on Friday. So we just got a new buy signal from this indicator because VIX jumped up to 21 and change on Thursday night, and then Friday reversed all the way back down here and closed at 17. So while that's a pretty low level on this chart, it makes me a little suspicious. We take all of these signals because if you're in the business of technical analysis and you start trying to guess which signals are going to be good ones and which ones are not, even though they have the same setup criteria, you're going to eventually make a big mistake. Anyway, so that's a buy signal from that in that regard. Also, the trend of VIX is positive because here's the 20-day moving average, and then here's VIX itself, of course, and here's the 200-day moving average way up here. So when both of these two are on the same side of the 200-day, that determines a trend. And in fact, that's been the case since inside this circle right here in March. And so the trend has been down in VIX, which means bullish for stocks. We also had an important one back in November, again, where they both fell below and gave us a buy signal. So that buy signal is still in effect, although a bit stale here a couple months later. So one other thing I did want to point out is that what is low VIX? So during 2021, VIX bottomed out at 15 several times and rallied from there. During the bear market, VIX got down to 19, but never any lower and always bounced from there. Now we're down to 17. Some people are saying that's too low, that's too risky, that you have to expect VIX is going to bounce from here, which would mean the market probably would go down. I'm not so sure. We look at the difference between realized and implied volatility. VIX is implied. VIX is trading near 17. Realized volatility has been as low as 10 or even lower recently. So, VIX can't go much lower, much higher when realized is that low. We'll talk about that shortly, but it's just, a bit worrisome. I do think it shows some worry in the market that VIX won't capitulate and go back to where it used to be in the bull market. It's still indication that there's a number of traders still expect we're in a bear market. So we can't trade VIX because it's a very complicated thing, but we can trade futures on VIX and options on those futures, which is what the VIX options are. Even though they supposedly say they're cash settled, they really trade off the futures. In any case, when the term structure of the futures slopes upwards like this, that's indicative of a bullish market. And when the term structure slopes downwards like this, that's indicative of a bearish market. So we had this very heavily in 2020. In March of 2020, the term structure sloped way down like that. So here, this is where we are right now. We're at least at 2 o'clock this afternoon. And VIX was at 17.19. And the front month futures are the May futures. So 17.19 subtracted from the price of the futures gives us a premium of 2.09. So if you can see here, the futures sloping upwards in price to about right here, and then they kind of level off after that. And all the futures trading at a big premium to VIX, those are all bullish things. It's when the premium goes negative and the term structure slopes downwards, that's when bad things start to happen. Also, the CBOE publishes 6 volatility indices. It used to be 5, but now it's 6 because they added the 1 day. And you can see you can quote these on your stock quote machine, just like IBM or anything else, using these symbols. And you can see that these slope uniformly upwards in price. Again, the term structure sloping upwards. Again, that's bullish for stocks. So the other thing we would have to worry about in the construct of the term structure is if May futures, currently trading at 1928, suddenly rose up and started to trade at a higher price than June futures, which are more than 2 points higher. So that's a big distance, 2 points. And that's not going to happen anytime soon. In fact, in this whole bear market, we really didn't have the super bearish indicators from VIX that had existed in many other more crash-like bear markets. It turns out a steady bear market doesn't produce those extremes in VIX. So just to kind of summarize, on the left are the bullish indicators that we talked about, the McMillan volatility band, the construct of volatility derivatives, we just showed that, the two buy signals from VIX, and breadth oscillators, which are trying to confirm a buy signal. On the neutral side, I'm putting in the chart of the S&P 500 because we're in that trading range. And on the bearish side, we still have the new highs running less than new lows and the equity only put call ratio. So the weight of the evidence there is slightly bullish, and we do trade these various signals individually. As I said, though, we don't have a core position at the current time. So let me just return to that offer. We're offering 4 things here. 6 months of the Option Strategist newsletter, which is our flagship newsletter. We just this week I wrote a fairly extensive article on the one-day VIX and trading the 0 data expiration options. So we have that plus recommendations in that newsletter. We have a 14 webinar home study course. Each webinar is an hour and a half to 2 hours long. It's fairly fresh. It was recorded late in 2021 and then throughout last year. A copy of the book Options as a Strategic Investment, and if you want, a consult via our money management programs that we have. Just to summarize quickly, our newsletter, the main one, Option Strategist, is in its 32nd year publication. These are our daily letters, much more detailed, much more geared to the active trader. We do have a couple of other newsletters which are a little less option oriented, perhaps. I mean, this is a put writer newsletter, but it's looking for deeply out of the money, kind of safe puts to write, and also a special situation newsletter. We have a YouTube channel. I invite you to stop by and become a subscriber. And then if you go to this website, you can download the PDF, which I'm going to get up there as soon as we're finished here. So one thing that I've kind of do with all these is I think the bear market that we're in still, I do think we're still in one, is very similar to this 73-74 bear market. That one started out with the Dow making an all-time high in January and immediately failed. So it was a false breakout. There was a big rally centered around the oil embargo. Then we went into a trading range for a long time, finally broke out the bottom when Nixon resigned and plummeted into an October low. So back then, the three I's were the market's big words: inflation, interest rates, and impeachment. Right now, it's inflation and interest rates. I guess the third one is debt ceiling. But, you know, this summer, if the debt ceiling becomes a real problem and we break through on the downside, could end up with a very similar chart. So where do I think we are? Well, about right there. And, you know, I could be wrong. I mean, you know, I'm not taking any real long-term positions based on this thought. But so far, we've had enough similarities between that bear market and this one to, you know, at least keep paying attention. Now, I mentioned the one-day VIX and the 0 days to expiration. So I did a quick study because everyone seems to be pretty lost with this one-day VIX. There's the CBOE put out the index about 2 weeks ago, gave us about 1 year of backdated history, and it's that orange line there. That's the VIX 1 day. The blue line is the true range expressed as a percentage of S&P. You can see they're pretty close together. I mean, I think that's a pretty tight fit, and it makes some sense because, as I said earlier, VIX itself is a 30 calendar day index, which relates more or less to a 20-day historical volatility index, and those two track each other pretty well. So here, you know, there's a few things you might want to just quickly observe. First of all, market makers have been sellers. The guys trying to buy these things in hope to hit an overnight home run have struggled. And so as a strategist, I don't know if I'd be selling straddles, but I certainly would be selling strangles. And, you know, some Some sellers are even selling iron condors, which is where you sell a strangle and then you, on top of that, you buy it farther out of the money strangle. That seems like a big waste of money to me, unless you're somehow getting a margin break on that. But in general, I would say do this and attempt to move in when VIX one day is very high and well above the percent true range. So as I said, we just wrote an article about that. If you want more in-depth reading, take us up on our offer. That's part of the Option Strategist newsletter, is part of that. And then just one last thing here. I mentioned that VIX tracks the 20-day historical, and many people have been very disappointed that VIX has not done better as far as making money by owning VIX calls in a bear market, for example. In these crashes that I've listed here, yes, you made a lot of money owning VIX calls, but in a bear market, a steady bear market, historical volatility rises a little, but it doesn't explode. So here's that bear market I showed you before, 73, 74. On top is the Dow, and the bottom is the 20-day historical volatility. Now, we didn't have VIX back then, but we can assume that VIX would track the 20-day historical fairly well. You can see that it never got above 35, and that was only really at the low of the whole bear market. So, you know, by and large, you had an entire 2-year bear market where historical volatility ranged, you know, roughly between 20 and 30, low 30s or what have you. This is this bear market. So we came all the way down last year. We fell 27%, and yet in this one now, the pink line is your 20-day historical, and it really didn't go up all that much. It didn't even get above 30 hardly at all. As a result, VIX, which tracks the 20-day historical, really didn't get much higher than that either. It got up in the mid-30s, and that's what people are complaining about. But in reality, there's nothing to complain about. VIX is measuring what it's supposed to be measuring, and you know, I think this is maybe why these zero-day expiration options are so popular. But you know, I don't know if you can hedge a bear market with one-day options. That'd be pretty tough. Anyway, that's really it. VIX won't explode unless there's a crash. I don't really know if we're going to have a crash. Not really. We might have a violent end to the bear market, but you know, that's not really necessarily a crash. Anyway, as I said, if you go to this website, you can take advantage of our offers. You can get the PDFs. If you're interested in our money management, you can go to this website here. And Jeff, I'm turning it back to you.
All right. Thanks, Larry. Appreciate that. Great job. Thank you.
Okay, you're welcome.
Okay. Very good. Let me go ahead and take the screen back. Thank you very much, Larry. Really appreciate that.
Okay, thanks for having me.
All right. Very cool. Okay. All right. Very cool. Let me go ahead and let's thank one of our sponsors, Stocks and Commodities Magazine. Sounds good. Stocks and Commodities Magazine has been publishing articles. Oh, wow. Now I just see me. Hold on a sec. Okay, that's better. 30,000 trading articles. They've been publishing since 1982. 1.3 million subscribers. We really appreciate them. They've been sponsoring the MetaStock event since we started them back, gosh, like 10, 12 years ago now. Anyway, we really do appreciate their support. They are throwing in, if you take advantage of any of the offers today, they're going to throw in a 5-month subscription to MetaStock. If you spend $300 or more on any MetaStock products, they're actually going to throw in 2 years. So there you go. Sergio says, great presentation. Yeah, we've had such a great roundup of people coming in today and speaking. Kelly, let's see. We do have a little bit of a time. And what we're going to do right now is give away a prize. I realized we have not given away any prizes today. And that's my fault.
Well,
in any case.
I'm ready to help you.
All right. Well, okay. So the first one we're going to give away, you see this book right here? Yeah, Around the Horn by Dr. Adrian Mance. I've got a physical copy that we're going to mail to somebody. And you're going to help me decide who that is. So let me tell you, let me give you a number or a range of numbers, and then you can give me the actual number. The range of numbers is I need anything between 1 and 94.25. $7866. Okay. And that would be James P. in the USA. So James P. with a Gmail account. If that sounds like you, you may be the proud new owner of this book. So, and I'll send you an email to let you know to confirm. Kelly, if I'm a viewer, let's say that I came across this on the YouTube channel today and I want to also be eligible to get prizes. How would I do that? Awesome. Yeah, you should do that. Thank you very much for the assist. I appreciate it. Michael says, I will happily accept one of your prizes. Michael, I hope you're random. I hope you're one of our winners. Maybe you will be. But we will be starting to do more drawings between the individual speakers and all that kind of stuff. So there you go. Since we do have a little bit of extra time and we've given away a little bit of a prize as well, let's just go ahead and thank CMT Association as well for sponsoring the event. We do really appreciate their sponsorship of the event as well, cmtassociation.org. You know, if you're interested in adding 3 letters behind your name, CMT, or maybe you just want to get some accreditation. If you are interested in being a money manager or you have funds under management already, actually it's surprising to me how much a CMT accreditation can help you. So go to cmtassociation.org or give them a call at 646-652-3300. And there you go. Let's see, Larry, how much needed for minimum management? I don't know the answer to that, Ken, but Larry's not here. But you can reach out to him at theoptionstrategist.com, and he could give you the minimum that they require for money management. Thank you for the question. All right, very cool. All right. And of course, we are MetaStock. We've talked about MetaStock all day. MetaStock, it's been 30 years running. Winner of the Stocks and Commodities Reader's Choice Award, 30 years straight. We've talked about how it can help you scan markets, test trading ideas, forecast probable price movements, get real-time alerts and signals. Prices on MetaStock cost $69 per month. What we're doing here, and yeah, I have a little bit of a hiccup. What we're doing today is if you're interested in doing MetaStock, we're going to do what we call an extended trial. If you pay for a month, we'll give you the second and third month for free. So you can try out the software that's literally been rated #1 30 years in a row by the readers, not the editors, but the readers of Stocks and Commodities. And since it's a buy one, get 2 free, you get 3 months to evaluate it for $69 here in the US. That's about $23 a month. So I'd encourage you to do it. There is a reason that MetaStock's been rated #1 for 30 years straight. And I wouldn't trade without it. So you can find out more information if you want. You can give us a call. Be happy to send you some, help you get set up, help you understand the different offers. Give us a call, 800-882-3040. You can also sign up for that at metastock.com/conf-promo. And if you have any questions, you're welcome to give us a call or a chat online with us too at metastock.com/sales-chat. So there we go. All right. Let's go ahead and talk about our next guest. We'll start them just 2 minutes early. So hopefully they're ready. Jake Bernstein is another great technician. Jake's, I've been, let's see, how do I want to say this? I've actually had a lot of interaction with Jake. I used to live in a very close to him up in Boulder Creek, and we used to go to this trading for options profits group that was a bit of a user group for MetaStock, a bit of an options trading group, a little bit of a user group for Option View as well. And they did a lot of really good classes, and Jake used to teach at them quite a bit. Jake's very good at futures trading. He's really good at methodologies. He used to be a psychologist, a psychiatrist, and he does such a good job. We love having him on here. And I think that's how I'm going to introduce you today, Jake. Jake, welcome to the room.
Thank you, Jeff. I really appreciate that introduction. And can you hear me?
Yeah, I can hear you. And I assume that Brian is going to, or you're the one that's going to be sharing your screen, not Brian.
I will share my screen, and Brian will give his talk sharing my screen as well.
Okay.
And
so there's that.
Let me show the screen. Hang on one second, Jeff.
You bet.
And do you see my screen?
I can see your screen. It says May 8th on there.
Okay.
I'm also very quickly reading all your Skype messages.
Okay. Tell me what you see now.
I see the presentation in the non-expanded format.
Okay, so let's do that right now. Here we go. And let me get my pointer. And we'll be ready to go. And can you see my pointer?
Yep, everything looks perfect.
Cool. So we're ready to go.
All right.
And excuse the voice or lack thereof. It's allergy season in California, which makes it a little bit difficult to talk. So today we're going to talk about why so many traders lose and how winning traders win. I want to thank Jeff and everybody at MetaStock. You guys have been great for so many years, supporting me in things that I do, and seeing you all over the world. I think the last time we actually saw each other was it in Singapore?
I actually think that it was in San Jose.
San Jose.
But it might have been Singapore too.
Well, either way. Good to see you again. Hope the family is well. So thank you very much for inviting me. And I'm joined today by Brian Latta, who's a great market technician and a great coach. We're going to talk to you about some very specific indicator that we developed. We have nothing to sell you. We're not going to ask you for money. There's nothing to subscribe to. We're doing it out of the goodness of our hearts because we believe in trader education, just as MetaStock does. So the presentation is going to be very specific. If you want the PowerPoint, Jeff, what would be the best way to do this? To ask for them to send an email or to give you the PowerPoint and you can give it to people if they want it?
That would be totally fine.
Okay.
And my email address is jeffrey.gibby@metastock.com.
Okay, gotcha.
I'll type that in for people too. Okay.
So we're going to start with the usual disclaimer, which of course means that you can lose money trading. It does happen, believe it or not. And a few other items. So who am I and why listen to me and why listen to Brian? I've been a trader since 1967, which is a few years. I think I can teach you something. Written over 43 books. I'm a real trader. My work is purely technical. I don't use fundamentals in any way, shape, or form. Everything I do is computer tested and back tested. I've taught thousands of traders all over the world. I've done 900 plus webinars and seminars, real-time trading. I'm a board member of the Foundation for the Study of Cycles, a nonprofit research group. Been on Wall Street Week, CNN, FNN, CNBC, you name it, I've been there. I'm not a broker or trading advisor, I'm just an educator. And I want to stress, everything I do is 100% objective, and everything that I do, you can do on MetaStock as well. It's very simple, it's very straightforward. I don't do analysis, I don't do fundamentals. It's purely technical, and that's why a platform like MetaStock is so great for doing what I do. And my clients, individual traders, top newsletter writers, hedge fund managers, and so forth. So I'm very, very much in tune with the professional community who buy research from me. And of course, I'm a real-time trader. I do trade, and I trade what I teach, and I teach what I trade. So let's go on with this. So let's talk about discipline. No presentation would be complete on technical analysis unless we also talk about the weak link in the chain. And the weak link in the chain is always the trader. I need to use my psychology background to some justification because I spent many years in college. And so this helps me justify why I went to school, even though I've been a trader for many, many years. So people say, Joe, no wonder you can't make money. You don't have discipline. You need to get yourself some discipline. So that leads to the question, where does discipline live? Where does discipline come from? How can we get it or improve it? What exactly is discipline? Does it come from a book? Does it come from psychotherapy? Are you going to call up a psychiatrist and say, hey, can you help me get discipline? No, it's not going to happen that way. Discipline comes from where? Does it come from magic mushrooms? Well, so many people are using magic mushrooms now for trauma. Well, you're not going to get discipline from magic mushrooms. So where's it going to come from? It's going to come from confidence. You need to be confident in what you're doing. How can you get confidence? Confidence comes from understanding what you're doing, and it comes from repeating, repetition, clear and specific rules. If you don't have clear and specific rules, you're always going to be doubting yourself. You're going to wonder why you're doing what you're doing, or if you're doing things the right way. That's going to cause you to have uncertainty and lack of confidence. Confidence comes from knowing what you're doing. Knowing what you're doing comes from having specific rules for what you're doing, which is very important, as you know. I'm sure you've heard this 1,000 times, but you're not going to get discipline unless you have confidence, and you're not going to get confidence unless you have specific rules. So what is the meaning of life? The meaning of life for a trader is understanding what you're doing, even if it's simple. So why are you here today? You're here today to learn some stuff from somebody who's supposed to know what he's talking about, and I do. And from Brian, who knows what he's talking about, since he's coached many people to successful trading. So the sad truth is this: none of the great methodologies that you've heard here in the last couple of days, and that you will hear, that you've been taught to by very professional traders, are going to do any good for you unless you have the discipline to follow them. If what you learned from people is not clear, by which I mean A, B, C, D, E, cookbook, then you're going to lose money. If you're going to lose money, you're going to lose confidence. If you're going to lose confidence, you're going to lose discipline. If you're going to lose discipline, you're going to lose more money, which will cause you to lose more confidence, and so on and so on and so on. And you're going to be involved in the trader's death spiral. You don't want that to happen. Everything has to be completely clear. So I'm a rules-based trader. I have specific rules, and I don't break those rules. If you have to analyze or interpret anything, you're going to lose money. I want you to think about this, because this here is the most important part of the presentation, believe it or not. Everything else is methodology. Do not interpret anything, because if you find yourself wondering about what to do, you're about to lose money. It means you haven't learned the game, or the game has no rules. Everything I do is based on a trading model called setup, trigger, and follow through. We will go through some of that with you today. So, Brian, why don't you tell them a little bit about yourself?
Thanks, Jake, on that. And of course, you can blow through this pretty quick, because my background at least is in trading, and everybody can read through that pretty quick, because really what you're here for today is to go ahead and learn something new for yourself. But I do consider myself a systems trader. Again, just like Jake says, 100% objective, rules-based, reasons to get in, reasons to get out at a loss, reasons for taking profit. And that's what I went to Jake for in 2014. Not only that, learned the backtesting process in order to create systems that can be backtested and forward traded. So for that, I have created my own systems following Jake's process and adapting it to myself. So that's where we are.
And I will say this, that in the years I've worked with many, many people in this business. Most people I have no interest in or respect for, because they're not very honest. When you take a person like Brian, people like MetaStock, good, honest people who will always tell you the truth, very important for me and very important for you as well. So it's my pleasure and my privilege to work with Brian. And we're going to show you what we've developed here. So I get a lot of emails from people. For example, you can read this while I talk. These are the kinds of emails I get from people who are very frustrated. They're losing money. They've been trying for years and years to make money. They just can't do it. And the reason they can't do it is because they don't have a strategy. Take a look at your strategy and see if it has the three most important elements. And they are: number one, setup. A setup is a pattern. Pattern. Head and shoulders is a pattern. Trend line is a pattern. Flags, pennants, breakouts, reversals, key reversals, they're all patterns. There are thousands of patterns in the markets. That's the good news. The bad news is they don't have predictive validity. They don't predict anything. So you need to make sure you're using a pattern that will predict something. Once you have a pattern, and I'm going to show some examples of patterns, and so will Brian, the pattern has to have a trigger, which I mean is very, very simple. If we know that something has happened 70% of the time, is it going to happen this time? Remember that 70%, even though that's a good number in trading, 70% accuracy, It doesn't mean 100%. Is there anything we can do to ask the question? We know what the pattern has done historically. Is it going to repeat this time? That's where artificial intelligence comes into play, or actual intelligence comes into play. And you look at a timing trigger and say, yes, every time we've seen this pattern and it has triggered, the probability has increased to 84%, example. Once you've got that trigger that says, go ahead and take this trade, you have follow through. That's part 3 of the process. Setup, trigger, follow through. Follow through says, here is where to take your profit and reduce your risk to 0. And here is where to keep the position and maximize the profit and increase the risk management, increase the profitability of the strategy so that you're getting the big moves. If you're not getting the big moves, you won't be successful. You'll be like most traders, making a few hundred, giving a few hundred back, making a few hundred, giving a few hundred back. It's not going to work for you. So what are we going to do? Well, I want you to think about this, and you can read this again while I'm talking. Many, many years ago, when I first started trading, we had certain gripes. We'd say, we can't make money because commissions are too high. We can't make money because our order fills are too slow. We can't have money because we don't have the right technology to find patterns. We can't make money because the big traders are always right. Over the last 15 years, all of those edges that professionals had have been taken away. We can now do everything that professional traders do. We have virtually 0 commissions in many markets. We have technology, we've got advanced computer systems, we've got great software, and still the average trader isn't making money. Why? Number 1, they don't have a strategy that's completely objective. They need to interpret things. Number 2, they don't have rules that make the strategy objective. Number 3, they're almost always going for the quick profit. People call me up and they say, Jake, I have a rule. As soon as I've made $500 for the day, I'm quitting. I think that's absurd. You want to make as much money as you possibly can. Don't set a limit on how much you can make. If anything, set a limit on how much you can lose. So the problem with most people is they're not going for the big move. 80% of your money, take it from me, I know what I'm talking about. I've traded for 51 years. If you're not getting the big moves, you will never be successful at this game. What's a big move? A big move would be 500% bigger than your largest trade. So if you're making $500 a day, you need to go for 5 times that for the big move, as an example. I will show you a couple of ways to go for the big move. So let's talk about the definition of trading. Now, people don't like it when I say this, but I'm going to say it anyway because I'm an old man, and old men can get away with a lot of stuff. Here's what I'm going to say. Trading is like gambling. The definition of trading is take risky action in the hope of a desired result, which is exactly what gambling is. Okay, so we're gamblers. If you're going to be a gambler, then gamble the right way. If you're going to do it correctly. That's why if you're a gambler and you're a good gambler, by which I mean you know the rules of the game, whether it's blackjack or poker, whatever, if you know those rules and the rules are effective, you apply them, do it correctly. Accept the fact that you're a gambler, you're a speculator, do it by the rules. So what are some of those rules? Well, Brian and I have some amazing and true facts we're going to share with you, no charge whatsoever, in the hope that these facts will help you vastly improve your results. We're going to give you some examples of what we mean by completely objective rules-based trading. And I want to say this one more time. I have seen literally tens of thousands of traders all over the world. If you add up the number of people who have come to my live trading sessions all over the world and on the internet, you're probably reaching thousands and hundreds and thousands of people. I have heard every sob story in the world, and they mostly boil down to the same thing. No strategy, no rules, interpretation, imagination, and so forth. If you don't have these, and I know I've been preaching to you and everybody else has preached to you, if you don't have them, you will never be successful. I tell people to take the 10 trade challenge. Find a strategy, make sure it's based on rules, make sure it has a reasonable track record historically, and then take the next 10 trades in a row generated by that strategy without changing anything you do. In other words, 100% by the rules, and you will see a difference not only in your confidence, but in your results. So let's go forward. So you can read these at your leisure if you want. Why do traders fail? I named some of those things, but here's the entire list of why traders fail. What really never ceases to amaze me is I get a call from someone who says they want to start trading. What should they do? I say, well, first you've got to get an education, and you've got to get a little bit of hands-on experience. They say, well, I want to day trade S&P. I say to myself, why would anybody want to start day trading, which is the hardest game in town, in the market that's the hardest to make money in? It's ridiculous. What you want to do is start with a market that's easy to make money in. Start with a market that's less volatile. Don't start with a market that's dominated by professional traders, and so forth. So when you have time, if you get the presentation, PowerPoint presentation, read these and see if you can find yourself anywhere on this list. Okay? One more thing. Traders say you have to learn from your losses. Well, that is true. You need to make sure that you don't repeat the same mistake twice. However, when it comes to trading, there's 1,000 things you can do wrong. There's only a handful of things that you can do right. So if you think that you're going to be successful because you know why you lost money the last time or the last 10 times, and you're not going to repeat those mistakes, you may repeat another mistake that you haven't thought of yet. You want to learn from your profits as well as your losses. So every time you make a good trade, look back and ask yourself the question, what did I do right? What led me to make this profit? What rules did I follow? Was I disciplined? How did I make money? And if you keep on doing that over and over again, you will realize that you want to learn from your profits, and you will learn more from profits than you will from losses. Let's continue. So, in my spare time, I wrote a few books. If you may have read some of these books, but I happen to have written the 5 best-selling books from McGraw-Hill and Simon & Schuster on day trading. But that was many years ago. I'm no longer interested in day trading. It's much too difficult, and you're competing with some of the best and fastest computers in the world. You ought to be more interested in short-term trading, 3 to 5 days, 3 to 10 days, because that's where I think the real money is going to be made by most people, but not in day trading. So I recommend you not read any of my day trading books, even though they're out there. And but believe it or not, they're still selling, because during the pandemic, people had nothing to do but stay home and figure out what to do with their time. And many of them turned to day trading, which is why these books are still selling. But as I said before, I don't recommend day trading for most people. So let's talk about the trading model. We're going to talk about some solutions. Setup is a pattern. Trigger is an action-based rule that says the setup will likely happen. I'm going to show you some examples, and so will Brian. And follow through consists of 3 things. Number 1, where are you wrong? Otherwise known as a stop loss. Number 2, where are you right? Your first profit target, at which point you reduce your risk effectively to 0 by putting in a stop at the price you paid. And number 3, maximizing the profit, keeping the position past the exit point if it's profitable. Some examples. Let me show you. Hang on a second, please. I'm going to run through these a little quickly. Okay. You want to use precisely defined price patterns, and I'm going to give you an example of some of those. Number 1, indicators, lagging indicators. Most people use moving average crossovers. For example, the 50-day moving average crossing above the 200, the golden cross. The 50-day moving below the 200, the death cross. If you put these typical moving average systems on a computer and a program like MetaStock, you will find that they are right 35 to 40% of the time. Well, if you're right, if you enjoy being wrong 60% of the time, and it doesn't kill your confidence, then that's right for you. I don't use lagging indicators. They're nothing but trouble. I'm interested in leading indicators. Are there indicators that will tell you what's going to happen or what's supposed to happen ahead of time? Example, seasonality, cycles, divergence. These are the best kind of indicators you can get, leading indicators. We're going to give you some examples of those, in particular, the one that we call expansion contraction, which has what Brian calls zero lag. These are indicators that turn when the market is changing direction and have zero lag time, which means they're not lagging behind the market. They're not lagging behind the market on a turn. So for example, with moving average systems, the typical moving average systems, they will let you know the market has turned long after it's turned, and that will cause you to zig when you should be zagging. I'm sure you've all experienced that. Example, leading indicator, cycles. Here is a long-term chart of the Japanese yen futures versus the US dollar. You will notice that on the chart, I put this cycle over here in green, and it just so happens that between the lows is approximately 7 to 8 years. You will notice that we know ahead of time, not perfectly, that the market's going to turn. So right now, the leading indicator of cycles says the Japanese yen will bottom sometime this year, could be bottoming right now. So within the context of what I do, this is a setup. It says, get ready for a low in the Japanese yen versus the US dollar futures. Go to step number 2, trigger. We need a timing trigger. The timing trigger, which is available right here on MetaStock as expansion contraction indicator, which Brian and I will teach you, or as the moving average channel, which is available as a MetaStock plugin, will let you know when that turn has happened. Another example, small trader sentiment. We ask the question, what is the small trader doing? Is the small trader bullish? Is the small trader bearish? Why do we have an interest in the small trader? We have an interest in the small trader because the small trader as a group is usually wrong at major turning points. So one of the things that we have done since 1985, I believe, is we've collected small trader opinions every single trading day. When the small trader opinion is 80% bearish, or down here 20% bullish, it correlates and leads to a low, precedes a low. When the small trader is very bullish, it precedes a high. So look what happened. This is the S&P showing very small, very low small trader sentiment right before this huge move up. Very low small trader sentiment before this big move up. Very low small trader sentiment here before this big move up. And before this move down, right over here, small trader sentiment is at a peak. And over here at a peak. And recently, toward the end of 2022, small trader sentiment is at its lowest level in many years, suggesting a rally, and that rally has started. It's a leading indicator. Not perfect, but 95% of the subscribers to this data that we publish every day are professional traders, hedge fund managers, some of the biggest banks and hedge funds in the world. Another example, small trader sentiment. Gold, right over here, showing a low in sentiment right over here, and then this big rally, a low in sentiment right over here, preceding this huge rally, a low in sentiment right over here, preceding this rally, and so forth. So small trader sentiment, a contrary opinion indicator, but very specific as a leading indicator. Let's go to the next one. Here we go. Gold, weekly chart. Very high small trader sentiment before this big decline. Very low small trader sentiment before this big rally. Here's another one. Crude oil. Look at the correlation. Small trader, very negative right over here. Precedes this huge move up in crude oil. Small trader very bullish. Oh yes, we think it's going to go up. They tell you ahead of time that they're going to be wrong. Market goes down. So that's just another indication. And of course, in the wheat market and so forth. So remember, we're not trying to be economists. We don't try to predict anything. We just try to understand the rules and follow those rules. So let's go forward again. Another strategy that works, seasonality. Seasonality, the tendency of prices to move in certain directions at certain time of the year. Pre-holiday trade. One of the best books that has ever been written about the stock market is by Art Merrill, The Behavior of Prices on Wall Street. Merrill said that if you buy stocks on the close of trading the day before a major holiday, let's put it another way. Example, in the United States, Thanksgiving Day is always on a Thursday. You buy on the close of trading Tuesday, you get out on the close of trading Wednesday, which is the day before the holiday. Very, very simple strategy. And here you go, is an example. This is the example most recently. This is another example most recently. Another example of a holiday trade recently. Another example of a holiday trade. And we have a track record. The pre-Christmas holiday trade, 69% accurate since 1950. And Merrill actually tracked these all the way back to the late 1800s. So this is what I mean when I talk about a setup and a pattern that has a leading quality, a leading component to it. We want leading indicators. In addition to that, we can go to seasonality and look at it in a graphic form. Example, if we took every year of the Dow Jones average from 1901 to 2022, imagine folks, 120 years of history, and showed it as one chart, one normalized chart, and isolated by percentage of time, up or down for each week, we would have a very solid statistic. This is the month of April. And according to the rules, 120 years, April was supposed to be an up month, which is it has been. It does not tell us much about the magnitude, but we know by studying history what the setups will be, bullish or bearish at certain times of the year. And we use that to our advantage by taking that setup and asking the question, is there a trigger for that setup this time around? We can get more specific. I can give you dates. I can tell you that since 1920, buying the Dow Jones end of day, October 26th, getting out end of day, January 10th, has been right 83% of the time. A fantastic statistic. But most people will say, it's not going to happen this year because we've got a bad president. It's not going to happen this year because of the Ukraine. It's not going to happen this year because of inflation. It's not going to happen this year because of bank failures. That's a fundamental. We don't use fundamentals. We simply ask the question, is there a trigger? Generally, we find that those trades that have been right 80% of the time or more have no need for a trigger because they're already so accurate. You say the time frame is too long. You say that you can't hold a stock from October 26th to January 10th, no problem. We can go to the website seasonaltrader.com and find shorter term trades. Example, buying S&P, end of day January 4th, getting out end of day January 18th with 71% accuracy. Or we have all the statistics at our disposal here, and we can find the most accurate trade. We can find the average profit, the average loss, the number of consecutive losses, the number of consecutive profits. We can look at the entire history of a trade. We can look at the track record of a trade. And so that's what I mean when I say complete objectivity. Let's go further with this. Here's another one, February 5th through February the 15th with 79% accuracy. And this covers the entire database. Now I want you to stop. Think about the difference between what you're doing and what we're doing here. Do you have the statistics? Do you have the rules? Do you have the procedures? Do you know the time of day and the date to buy, the date to sell? Do you know the entry signal, the exit signal, the strategy? If you don't know that, you're going to have a problem. You need to use clear signals. So I've explained in previous webinars at MetaStock the moving average channel, which is a very simple strategy, is available as a plug-in on MetaStock. We do use moving averages, but as you can see, these moving averages are not closing moving averages. It's 10 simple moving average of the high, an 8-period simple moving average of the low, and we have specific rules that are associated with this. In using this strategy for our trading for many years, we noticed an interesting relationship. When the channel, the distance between the high and the low moving averages, and please note, these are not closing moving averages, so what I said earlier about the lag time in traditional moving averages does not apply to this. We find that when the channel narrows, it predicts the behavior of the market. When the channel expands, it predicts the behavior of the market. Why? Because when ranges expand like this, it means traders are willing to chase prices. When trading channel gets narrow, it means the range is narrow between the high and the low, which means that traders are being cautious. They're not willing to pursue prices higher, so forth. So in noticing this expansion and contraction, Brian, who is a great coach and a great market student, decided he would try and program this idea for me, because part of the problem I was having was how narrow is narrow and how wide is wide. So Brian went to work and developed the expansion contraction indicator. So I've got the chart of expansion contraction on the screen here. I'm going to turn it over to Brian. And by the way, this was beautifully done on MetaStock based on Brian's rules, which were based on my rules. So Brian, I'm going to turn it over to you and have you explain to them what this chart is. But before I do that, I want you to notice we have both strategies here. The moving average channel, which uses the 10 high 8 low, and at the middle of the screen, this line, Williams accumulation distribution, and its moving average 57 right over here. We have specific rules associated with this methodology. But Brian is going to discuss the expansion contraction indicator, which I happen to love because it's green light, red light, and I understand that. Brian, take it away.
Thanks again, Jake, on that. So there are a couple of components to expansion contraction of lines, which are red and green inside the red and green shaded areas. So the short term or the minor swings are denoted by the red and the green line. Literally, if red is above green, we're short-term bearish. And if green is above red, we're short-term bullish. So basically a momentum indicator that's describing where price action moves through the moving average channel, and expanding short-term, long-term moves are the strongest part of moves up or down. And contracting moves, short-term, long-term, are starting to show consolidation or a possible correction or a possible reversal. So with these two components, long-term trends or major moves are a component with the short-term swings, or the minor moves and the major trends are all identified here with expansion, contraction in the lower study pane. So there are... Sure, go ahead, Jake.
Let me get this right. So the major move is indicated by the cone, what we call the cone, the big fat thing over here. The minor move within the major move is indicated by these two lines over here, right?
That's correct.
So would it be correct to say that right over here, when the cone switched from red to solid green, was the buy signal, and right over here, when it switched from green to red, was the sell signal? Would that be right?
That's correct. Clear entry rules with the indicators.
Go ahead, Brian.
Okay. Also with expansion contraction, you can see there are some horizontal lines, although they do expand and contract slightly, red and green lines within expansion contraction. I did add the basic 1 standard deviation and 2 standard deviations long term on that to describe as we get closer to zero and inside the normal market, inside the closest lines to zero, that market would just be not trending or consolidating, basically inside the normal market or expected move. And also then the larger line on the top there would also show us strength on that, and show the major moves have strength as their amplitude or the size of the cone expands wide. We would also get to that technical level of, say, overbought or oversold and expect to see a potential reversal. But basically of the 30 or 30 tradable characteristics on here, including divergence, which will help expansion contraction as a concurrent indicator. Also give us divergence, which is a leading indication on here, all wrapped up in one indicator. But I think we can probably move on to some of the examples because we definitely have a lot of examples to go through. Okay, so in this particular instrument, which is the 10-year notes, we just have a very clear, strong uptrend expanding over time. That's where the lines, obviously, with expansion contraction are expanding for the most part. We can find major moves with the cone or the shaded area in the background. And this can help us get the big moves with a clear indication that we should stay in the trade long-term due to the major move filter.
And one of the things I'd like to point out about this is this. You will notice in all of these charts, when the expansion contraction changes, it usually stays in that orientation for a long time, which gives you the big move. Furthermore, you can use the channel for support resistance. So for example, if you're like most traders, you didn't get in over here, you waited. Waited for what? Waited for an opportunity to buy support, which is defined as the bottom of the channel in an uptrend. So you can see the market gave you another opportunity to get in right over here, which is why the expansion contraction is such a solid indicator. One more thing that Brian was pointing out before is this: when the cone gets too wide, by which I mean it goes into the first or second standard deviation, it usually correlates with what people normally call overbought, like so. Or when the cone gets very narrow over here, that would usually correlate with oversold. But those are two elusive terms, which I suggest you not use because they're difficult to define. But the cone helps us define them very clearly. Here's another chart for you, Brian.
Right, and this one is really just showing the short-term swings on here, which we can see were bullish and then bearish and then bullish again and bearish again. So the expanding market did contract, continued to trend up, and as Jake mentioned, in this middle of September, in the middle, slightly right side of the screen there, we can see a bear correction, which gave us a move down to the lower channel and an obvious buy signal. So we definitely like to see short-term contraction and have the market correct back towards support and give us a buy trigger.
And here's the opposite situation, the sell trigger, where we stay in red for a long time. Go ahead, Brian, it's all yours.
That's true. It's stayed trending throughout this entire end of the chart from August 28th or 9th or so, as near as I can tell, and actually has given several additional moving average channel trades while we continued to trend lower on here. So, but I will make one comment on both the cone and the lines are inside the one standard deviation line or very close to zero. That's not trending or consolidating. So everything zeroes out pretty close to nothing. Similar condition to say a squeeze or consolidation or not trending.
And we have specific rules so that, for example, in a downtrend, you want to be selling the top of the channel, which is resistance. We have specific rules for where to take profit, where to get out of the loss, and so forth. And we have more current charts. So these are old charts. We wanted to show them to you, but we have some very current charts, which we will show you shortly. I'm going to go on to this one right over here, Brian. Go ahead.
Absolutely. This is just still showing both the short-term and the long-term expanding market. So we can see the strongest part of the moves where we had both green, short-term lighter green lines and a longer-term darker green line. We had short-term spurts of strong up in the long-term trend. Again, there's just to identify that the strongest part of a move up or down will be where we're short-term or minor expansion, and a long-term or major expansion, where short-term expanding and major expansions, strongest parts of the move.
And remember, it's very important. It's just red light, green light. It's incredibly simple. And it's a very forgiving method, by which I mean, even if you miss an opportunity to get long or short, it will usually give you more opportunities all the way down or all the way up, because these are very specific. And you also notice that I don't use candles in my work. I'm a minimalist. Candles contain too much information for me, and much of that information contained on candles is questionable in terms of its predictive validity. So I like to keep my charts simple and straightforward. It improves my discipline. It improves what I'm doing significantly. And I suggest you do the same too. I'm going to go back to another chart. Brian, why don't you take this one?
Right. Of course, this is just showing the long-term trends. Initially, on the far left of the chart, we were in an uptrend. That changed in approximately the 26th or so of August into a long-term downtrend. Also shown with Williams accumulation distribution that you've got, and then changed back into an uptrend in mid to late October. And again, this has just given us several trend trades plus short-term swing trades, as Jake was saying. A seller at or near resistance at the upper band and the large downtrend in the middle of the chart has now turned to buyer at or near support on the current swing up. So there are multiple trades in here on these clear indications.
Okay, so Brian, here's a summary of what you've been saying. It adapts quickly to any significant price change. It identifies strong and weak trends and swings and so forth. And so here is another one. Go ahead, Brian.
Right, and get this just basically expands on what we've been talking about and shows the expanding of the normal range and the strong trend factors. So there are a lot of, as I said, 30 tradable characteristics with this on that, and that's what we tried to identify here pretty quickly. And of course, unfortunately, in the short time we have here, we can't go through the details, but there are recordings of what we've done and how to use that on here. And it looks like Jake's got some examples on here now.
Yeah, here's an example again of what I like to do with the cone. And you can do this, like I said, on MetaStock. Here is a day trade using what's called my 15-minute breakout. That's described in my books. The 15-minute breakout takes the first 15 minutes of the day session S&P right over here, and it buys if you close any 15-minute segment above the high of the first 15 minutes. When that happens, I look at the cone and I ask the question, is the trend on the cone green or red? Is it in an uptrend or is it in a downtrend? Given the fact that at this time of the setup, the trigger, which is the expansion contraction, was bullish, that was a green light, no puns intended, for me to go ahead and be long this market and get out by the end of the day for a very beautiful day trade. And you'll notice again, the one enduring characteristic of the cone is it stays in that position for a long time, even though within the cone you may get these small oscillations back and forth, which are simply warning signs that the trend may be changing. The solid green is what I'm looking at, and that has been very solid bullish for the entire day, which is a very excellent indicator because you don't want an indicator to jack you around, so to speak, back and forth, back and forth, back and forth. Let's go to the next slide, which I think is another day trade example. So here's another day, the same strategy, the first 15 minutes, closing above the first 15 minutes, consulting the trigger, which is the cone. The cone is bullish. Let's go ahead and take this trade. Now here's part 3 that we didn't talk about very much. That is the profit target. The profit target on the 15-minute breakout is two profit targets. The first one is 50% of this range of the first 15 minutes. The second one is the full range. And you can see that over the next 45 minutes, right over here, we achieved the first target and the second target, and then we were out of the trade. The cone gave us the opportunity to buy the bottom of the channel repeatedly at support and get out at the top of the channel. And again, observe that for the entire day, the cone remained in solid green. These are two exceptional situations. They won't all be this pretty, but many of them will. Here's the opposite situation. The first 15 minutes of the day right over here, day session S&P, the sell right over here, because we closed below the first 15 minutes, verified by the cone turning bearish right over here. So that was the setup and the trigger right over here. And you can see again, it remained in bearish mode all day long as the cone remained red, solid. Let's go to the next slide. And we have some current charts to show you. Let me show you what I mean. Hang on 1 second. Here we go. We'll come back and revisit these. I want to run through these a little bit quickly to give Brian a chance to do some current charts, which were prepared for me so nicely by Jeff. Okay, so here is a current chart of the U.S. Treasury bonds, 30-year. And Brian, why don't you explain this chart if you don't mind?
This chart is quite simply bullish and has been since February 12th or 13th, and we're still a buyer at or near support. And I see at least 4 or 5 trades on here, including the original buy on the cone changing to green. So we've had multiple situations here to be able to buy at support and still in on the original trigger long.
So what does the expansion contraction tell you? It tells you the major trend. It tells you the minor trend. It tells you the change in trend as well. And here's the best news. You don't have to buy it from us. MetaStock makes it available to you. And you can, Brian, how can they get the MetaStock indicator for expansion contraction?
The website is expansioncontraction.com. Quite simply, there's nothing to buy there immediately, just free downloads. So the MetaStock download is there on expansioncontraction.com.
And Brian, here is the gold chart showing the recent move. And again, let me take this one and then I'll turn it over to you. What I would like you all to appreciate is the consistency of the methodology. Once it turns bullish, which is right over here, simply red light, green light, it has stayed bullish day after day after day, in spite of the news, in spite of all the speculation, in spite of the negative reports, in spite of the economy and all the rest of that nonsense. And it has given numerous opportunities to the bottom of the channel to establish your position. Initially, if you didn't do it here, or you can swing trade by buying the bottom of the channel, getting out of the top of the channel, very simply. And again, the consistency of the cone is a very beautiful thing. The moving average channel methodology turned bullish over here with 2 complete consecutive bars above the top of the channel and Williams above its moving average. So both of the strategies have been bullish for this entire gold move and remain bullish as of this chart. I think we have another one here, Brian. I'll let you have this one. Crude oil.
Light crude is currently bearish, right? We're a seller at or near resistance. And of course, we've just had the sell trade that came towards the last week of April, and certainly have seen that one drop quite a bit and start to contract a bit. So certainly Jake's trailing stop rules again and profit targets work really well with moving average channel rules, and Williams accumulation distribution and expansion contraction work really well together.
So Brian, you're doing so good, I'm going to let you have Apple as well.
That entire chart is bullish. Again, a buyer at or near support or on the initial trade setup. And Apple's given us several opportunities on the daily chart to be in and stay in long term.
And you probably have all heard people say about Apple, you want to own it, not to trade it. The bottom line is very simple, no puns intended. Apple is a long-term trending stock. And as you can see, if you just sat there and tried to figure out all the twists and turns, buy it here, sell it here, you would not be any better off than you were if you bought it and held it. And again, the cone helps us with that. I want to get back to what I said much earlier in the session. If you understand the methodology and the rules are clear, red light, green light, target, stop, follow up, moving average, methodology, profit maximizing strategy. If those rules are clear and you don't have to interpret anything, you can look at this chart and immediately know by looking at the cone that this is a bull market. Then in a bull market, you want to buy support if you're not already in it, and you want to get out of resistance or maximize the profit. So it's a very simple strategy. And that goes back to the rules that I said earlier in the presentation. Know what you're doing and do what you know. The rules are very simple, not perfect by a long shot because nothing we do is perfect, but certainly the ability to know what you're doing at every turn gives you the confidence that you have to make a disciplined trade. I think we have another chart. Oh no, we don't have another chart, but we do have this right over here. If you want to reach Brian, you can reach Brian right over here at his email. You can go to the website and get the downloads for the expansion contraction. You can reach Brian here, or you can reach me over here. Very, very simple. And if there are questions, Brian, do you have your chat open, or can someone relay questions to us? We'd be glad to take them.
I can, although I did want to make at least one more basic comment on what Jake said. Sorry?
Yeah, go ahead, Brian. Sorry about that.
Well, Jake suggests take 10 trades, follow the rules, don't break the rules, don't change the rules, take the 10 trade challenge. To that, I always like to add, go back over the last 10 trades if you have rules and manually backtest it. Fortunately, there's software to do automated backtesting and even better, but the process of manually backtesting your rules will leave you with some insights as you see how well your rules work in certain situations. But we definitely want to have you be rules-based, backtest, forward trade, and get that predictive validity in your favor.
Yeah, let me add a few things to that, Brian. That was very well said. Listen, I am not a big fan of quote-unquote paper trading, by which I mean hypothetical trading. Paper trading will not teach you anything except the basic rules of the methodology you're using. Paper trading is free of emotion. If you have emotions, you're going to make emotional decisions. Paper trading is like living with someone before you get married to them. You don't find out the bad stuff until you're married. You need to get in there and make a trade, make some trades, and really live it. Otherwise, you're not going to really experience what it's like to have the stress of a trade. That's number one. Number two, very important. Always make sure that you have the specific rules in mind written down so that you'll be able to know exactly what the rules are. If people ask me what my trading rules are, I can state them very specifically and categorically. If you can't do that for what you're doing, if you can't teach it to a 10-year-old, there's something wrong. It has to be understandable. But I'm going to leave you with this last thought. It is much easier to follow the rules than it is to break the rules. Once you've broken the rules, you have a world of damage to undo. Furthermore, breaking the rules and ending up with a profitable trade will give you bad learning. You will learn that sometimes you break the rules and you make money. That is very bad learning. Take it from an ex-psychologist. What you want to do is follow the rules. It's very simple. You've heard it 1,000 times from everybody else, including myself and Brian. But the bottom line is we try to have very simple rules, and that's all that's really necessary. I have known and traded with many great traders in my career, and I know what they do. Granted, some of them are intuitive. They're psychic. They know things. They have a feel for the market. I don't. I can talk to a person for 5 minutes and tell you whether they're going to be a successful trader or not. My intuition when it comes to people is really good in terms of knowing whether they're going to be successful traders or not, simply by asking them a few questions. But when it comes to using my intuition with the markets, my intuition absolutely sucks. It's the worst thing ever. So I can't go on the basis of my intuition or my feelings about a market. So if people say to me, Jake, what do you think the market's going to do? I go to my indicators. I show them my indicators. I show them my seasonals and say, this is what the market's going to do 75% of the time if we have a trigger. So my answer always has to be in terms of the rules. So Brian, anything you want to say before we go or take questions?
Yeah, I don't know if I've seen any questions, but perhaps Jeffrey can help us with that a little bit. But again, I do want to say, if you're going to be a systems trader, and that's what I learned from Jake, and how to create systems and how to backtest them, you definitely need to test your strategies. You need to trade them without breaking the rules, and you need to track everything you're doing. These are several of the things that most people miss and are critical in being consistently profitable over time.
Thank you, Brian. Thank you, Jeff and MetaStock, for the opportunity. We're still here if anyone has questions for us.
We do have a couple of questions. But Mary wanted to know, when you talked about the 10 high-low channel, she wanted to just confirm that it was a 10 high-low channel. Yes, so it's a 10 moving average of the high and an 8 of the low.
And these are simple moving averages. The blue line, 10 SMA of the high. This color line here, whatever the color is, greenish gold or whatever it is, an 8 simple moving average of the low.
Perfect. Thank you very much. SWED, and I can answer this a little bit when it comes to MetaStock, but SWED says, does your expansion contraction tool work on a Mac system? After I download it, it asks me to go to the App Store and choose an application. Which application should I choose? So, Brian, I'll let you talk about that, and I can talk about compatibility of MetaStock on a Mac too, if you'd like.
Thanks for that, Jeff. And I'm not sure how that will work on Mac computers, but if your trading platform works on your Mac computer, you should have the indicator to also work on that. For many of the platforms it's available that works on Mac, the indicator will work there.
Okay. And then for MetaStock specifically, we don't have a MetaStock native version. Well, I mean, we don't have a Macintosh native version, but if you do like, I think it's called Bootcamp or Parallels, you're able to install Windows and you can use it that way. We have a number of customers that use it on Mac that way. So if you downloaded the executable for MetaStock, it wouldn't work until you installed MetaStock as well. And on that trading book website that they gave, there is actually a link for a free trial to MetaStock. So I'm just going to check the YouTube to see if we have any questions there.
Sure.
One of the things that I did want to say for JBXC is that it does work on MetaStock 18. So if you have an earlier version of MetaStock, we can give you a discount on an upgrade. But it looks really, really good in the new charting engine. And I did want to say thank you to Jake to making it available to MetaStock customers as well.
Yeah,
go ahead.
And thanks to Brian as well, because Brian did a lot of work on this.
Sid wants to know, can you use this with Forex and indices as well?
Absolutely. I'm a Forex trader. I have 2 systems on Forex and 2 systems for stock options. Works wonderful.
Absolutely works for day trading, works for investing, intermediate term, long term, short term as well. Make sure that whatever you're using it on, there's sufficient trading volume. So if you look at a stock and you see just a bunch of dots, it means the ranges are very small. If the ranges are very small, most trading strategies, including this one, will not give you clean, effective, accurate signals. My application of expansion contraction is especially useful on weekly charts as triggers and with seasonality that I use at my website, seasonaltrader.com. So as you can see, we have nothing to sell you. We have just information to give you, and certainly hope that you will take that information and use it successfully, because we've been doing this for a long time and we know what the hell we're doing.
T. Petty earlier said, thank you for having the great Jake Bernstein here today. And to that I responded, I'd like to thank Jake Bernstein for coming today. We'll have him anytime he wants to come. So thank you for being here. We really appreciate that.
Thank you for having me, and thank you for having Brian and me as well. We appreciate it, and anything we can do, let us know.
Great job today, guys. Thank you for everything. I think that's where we'll end it. I do want to talk about, so for the JBXC, that's something that Jake provides for free. And you can get that up on our website, or what was the other, expansioncontraction.com as well. As long as you have MetaStock 18, it's an absolutely free download. Go and get it. So there you go.
Brian, thank you so much for joining me, Brian. I really appreciate it.
Me too. Thank you for joining, Jake, Brian.
Thanks, Jeff.
All right, thanks, guys.
Bye-bye, guys.
Okay, we'll go ahead and kind of do this. And we'll just kind of clean up a little bit here. So then we'll do this. All right. What a great group of speakers we've had today. All right. Then we'll make me the presenter, share my screen. In addition to the free JBXC, which you can get on the website or expansioncontraction.com, we did design a MetaStock add-on for Jake that is called Setup and Timing Triggers. And I just want to talk a little bit about this. In it, Jake has 33 of his commitment of trader systems, and then some technical systems as well, 6 technical systems. And basically, here's a list of them for the technical systems. You've got the 15-minute opening range bar. You've got the 5-bar moving average channel pattern, the MAC with ADMA, the momentum moving average, the power momentum, and the stochastic pop. The thing I like about the setup and timing trigger is that it basically is some really, really good systems that we designed with Jake. We're on the version 2 of it that do explorations, expert advisor system. They do have system tests available, and they follow his technical systems. They follow the setup, trigger, follow through methodology.
Do you hear us?
I can hear you. Thank you. We'll be right with you. But it's good to see that the audio is working. Okay. All right. Very cool. So those are available. Here at the conference, it's normally $4.99. Here at the conference, it's $3.99. We are going to offer the 30-day money-back guarantee on it as well. Comes with a comprehensive user's manual, a very, very cool add-on. And if you need it, you're going to get a free trial to MetaStock with it. So you can give us a call to order that. You can give us a call at 800-882-3040. You can go to metastock.com/conf promo. And you can also visit us online at metastock.com/saleschat. So there you go. Okay. I do want to say thank you again to AAII for sponsoring today's event. AAII is a hugely good reputed organization. They've been sponsoring the event since this event. I hope they're enjoying that. But they've actually been a nonprofit. They've been helping traders since for 40 years now. They've helped 2 million traders. They do courses on technical analysis. They do newsletters. And if you want to find out more about the AAII, the American Association of Individuals, you go to AAII.com. So thank you again for the support, AAII. And let's go ahead and we'll do a prize drawing very, very quickly, and then we're going to turn it over to another great presenter. So Kelly Clement, are you here? All right. We're going to give away the prize right now. Guess what it's going to be? Well, I'll just tell you what it's going to be. With this one, what we're going to give away is the award-winning MetaStock program. So you might have heard about MetaStock. If you haven't, it's been rated #1 in its price category for 30 years in a row. It's been by the readers of Stocks and Commodities magazine. In addition to the MetaStock, we're going to give you basically a 3-month subscription to MetaStock. We're also going to give you a 3-month subscription to data. So we talked a little bit about the Zenith data, but it's basically an institutional quality data feed. It's a competitor to Bloomberg, basically. We're going to provide 3 months of data with that. In addition to that, we're going to provide a service called learnmetastock.com. With learnmetastock.com, you get basically hundreds of lessons about how to use MetaStock, different trading methodologies, just all kinds of really, really good training, and 3 webinars a week that it's done by Kevin Nelson. So you're going to get that. You're going to get MetaStock. We'll actually also sit down if you want. We can do a one-on-one with one of our support reps where we sit down, kind of answer any questions you've got about MetaStock, give you a little bit of a tour of the program. We call that our white glove installation service. That's going to be included as well. So Kelly, here's where I need your help. What I need you to do is give me a number. And then that number can be anything. Let me see. Actually, I've kind of messed up my spreadsheet here. Let me go back to the right spot. That number can be anywhere between 1 and 9,425. What number would you like to make the winner? Okay. Okay, the winner of that prize is Ashok R. I'm sure that's the correct pronunciation. We're going to do our best not to dox you right here, Ashok, but you're in the USA, you have a Gmail account, and I'll be reaching out with you to claim your prize. So congratulations on that. Thank you for registering for the event, and we'll make sure you get that prize. If you're watching this on YouTube and you haven't registered yet, make sure you're registered so you can get on the giveaway list. We have prizes that we're going to be giving away throughout the conference, and you can do that at the link that Kelly's going to put in YouTube right now, metastock.com/traders-conference. So with that being said, let's go ahead and migrate over to our next presenter. Our next presenter is a CMT, a chartered market technician. You might have heard of the CMT Association before, but her name is Martha Stokes. So we've been working with her for a number of years, and she does a really, really good job. We love having her in here. I love kind of her view on the market. We bring her in as often as she'll come. We love having her in. I think she's a great technician. And she's also, on a side note, a great cook. So with that being said, Martha, let's go ahead and kind of bring you in. We'll make sure we can hear you, and we'll get the slides turned over to you as well. So Martha.
Hi,
hello.
how are you doing?
Perfect, and I can hear you. You sound good. Let me go ahead and make you the presenter. Yep.
Can you move him off the screen?
I can move myself off the screen. There you go.
There you go. Thank you.
You bet. All right. So my camera's a little messed up, but I'm going to assume that we can see you, just not me. Kelly, correct me if I'm wrong, but I can also see your screen and I can hear you very well. Oh no, you're not broadcasting your camera. Okay. Let's try that again. Okay. Can you see it?
All right.
Oh yeah, there you are.
Go?
Perfect. Yeah, it's all yours. Take us home.
Thank you. I have my technician helping me here because I'm so busy. I need extra hands. Yeah. Okay. Are we ready?
Yes, we are. It's all yours.
All righty. We're going to talk about front-running HFTs with 3 easy strategies for beginners and advanced traders. And this is a lot of fun because HFTs are a huge part of the market, and I'll explain why. I am an educator. I don't recommend stocks. I'm not a guru. I teach, and I teach in my retirement. I retired, and then I just had my partner beg me to teach, and I said, I don't want to. And then he talked me into it, and it has been an ongoing thing. We've been in the teaching end of things. I was a buy-side technical analyst, and so now I am retired, and it's been 25 years, and I love teaching, so it's a lot of fun for me to be here. Also, Kevin Harrington goes around trying to find the best of the best in different industries and different types of companies, and he went through all of the different training that is available, and he chose TechniTrader to be the best, and he is recommending us now, and that is a big, big thing for us. We also have a free bonus at the end of our presentation, so hang in there because you will want to have get that code so you can get that free training. So what is high-frequency trading for those of you who don't know? High-frequency trading firms are not day traders or floor traders, nor are they actual human beings placing orders. HFTs are a computer-generated order processing system that uses algorithms to search for order flow that can be exploited to the advantage of the HFT company. There is no trader pushing the buy or the sell order. It is a computer. And yes, they are using AI and integrated artificial intelligence as well. A computer triggers thousands of orders on the millisecond scale. These are small lots. Most of the orders flood the exchange queues as the markets open. So this is an activity that happens at the market open, and this is what causes most, if not all, of the gaps that you see today. And some of the gaps can be gigantic. And you want to be in before the gap, not after the gap. So that's what we're talking about today. So let's talk about the difference between the professional side and you, the retail side. There are two sides, just one big herd of people all in buying and all selling. It's many different groups, and I'll talk about that later. This is a millisecond chart. That is the candle for that millisecond chart. There is no way you can read that. So you have to use your excellent MetaStock charting software program, and you will be able to find footprints of the professionals before the big moves up. So there's a distinct difference, and the volume is super high. Dark pools do not create high volume patterns. That's very important to remember. Who are the HFTs? High frequency trading is used by giant hedge funds, who are also called market makers because they have been approved by the SEC to make the market when it is stressed. That means when people are panicking and selling, they have already sold short before the market opens, and they buy to cover. But they wait until the price falls to a certain level so they can make a profit. They don't push price down. Price falls all on its own when the market is stressed. proprietary trading firms. There are more and more companies that are buy-side institutions or sell-side institutions, I'll get into that a little later, who hire proprietary trading firms to do a lot of their trading. That's become very popular. Or you these trader firms coming some they make it come.
It appears that we're having a bit of lag with Martha, and we may be losing her. But let's see. Let's give it a second and see if we can't get a better connection with her.
They can see everything. All the weekend side has to do it. And it is.
Hey, Martha.
Everybody, yes.
We missed you for a minute. Like, you dropped off your connection completely.
Oh, really?
And so I started playing our uh-oh video. Let me go ahead and make you the presenter again. And we'll have you pick up just maybe a slide or two earlier.
Okay. It says please come show my screen. Okay, can you see me now?
We can see you, yes.
Okay, you want me to back up a little?
And I think what I'm going to do is, just because I think it might be a bandwidth issue, I'm going to recommend that we turn off your webcam.
Oh, okay. All right. How do we do that?
I can do it.
Right.
All right. Now we just need you to share your screen with us.
Okay.
I'm seeing her screen already, Jeff.
Oh, all right. In that case, I can't see your screen, but as long as Kelly can, then it means it's on my side. So I'll have you. I'll let you keep going.
Just to make sure, I'm seeing cluster orders, whipsaw trade.
Yeah, cluster orders. We're on that.
Perfect.
It says show screen. Do you want me to? It says pause showing. So showing the screen. Okay.
Yeah. Okay. Very good. Then it's a problem on my end, which sometimes happens. I'll refresh my connection, but you can go. Okay. Everybody else should.
I'm just going to read, so it's be a little boring for some of you, but that's okay. Cluster orders or whipsaw trades. A lot of you have been in a whipsaw trade, and this is why it happens. Retail trading systems are not as sophisticated as HFT algorithms and millisecond trading. Often retail trading systems that attempt to mimic quant systems, which is hopeless, use popular indicators such as MACD, RSI, ADX, Elliott Wave, Bollinger Band, and other retail indicators, which are all price and time. This creates cluster order forms flow because all of the retail brokers are required by law to light the order before they send it off to other companies to fill the orders or fill the order themselves. High-frequency trading firms use these indicator formulas to find anomalies in order flow before the market opens. When cluster orders are identified by the QA formula, it triggers automated electronic orders that cause whipsaw action in retail trades because they're trading against you. This is one of the primary reasons why many retail traders have chronic losses that erode their capital base and, worse, their confidence in their ability to trade. So the normal order flow should be all over the place. It should be at markets, limit orders, other orders that are controlled, PWAPs, VWAPs, so that it should be all irregular. There'll be irregular patterns to it. Order flows that are clustered are retail side because everybody is trading exactly the same way, and so it clusters the orders and the HFTs can see it. Dark pools control their orders in two ways. One, they have a low price, a low range where they enter the stock, and a high range where they stop buying. If it drops below, they'll buy and move it in. If it goes above, they will stop buying. It's called a time weighted at average price. And they use it over an incremental period of time. They automate it within this price range. And dark pools are dark. They are not lit. So nobody can see what's going on in the dark pools because that is what the buy-side institutions need in order to protect themselves from front running. And since they control over $100 trillion of assets worldwide in 401ks and other important areas of pension plans and mutual funds, they get what they need. They do not want to have somebody front running them and pushing the price up. They have a designated price range. Okay, that's what you need to learn because you can see it with the MetaStock indicators that Technotrader wrote for MetaStock only. They're exclusive to MetaStock. Formulas created by quants are highly secretive proprietary programs that each HFT company holds exclusively. So if somebody says they have an HFT program that you can use, they are lying, and you need to run as fast as you can to the exit door. These are closely guarded intellectual property they do not share with anyone. Formulas are based on a complex set of criteria designed to find specific patterns and between financial markets. Algorithms are set to trigger in specific events, news, technical patterns, cluster order, detection, arbitrage, and other large lot liquidity draw. So you have a lot of activity going on and a lot of things that they're searching for. And a lot of times when you have a losing trade that should not have gone against you, the reason is because you got into this flow and didn't even know what was happening because you can't see it. Even if you're a day trader on level 2 screen, you cannot see the dark pools. All retail side HFT front run strategies need to be designed around these specific criteria and to understand what's going on. A lot of you think the market is very simple. Oh, if I buy something and somebody sells something, somebody has to lose money. No, you don't. There are 4 different kinds of orders, and all 4 could be making money for people at the same time. Just because somebody buys and somebody sells doesn't mean somebody's taking a loss. That's a myth that I wish I could get rid of because it's so annoying. Retail traders' advantage. You do have a decided advantage. Algorithms orders create patterns. These patterns become candlestick patterns and trends. These are specific to certain market participant groups. Institutional algorithms are computer-generated accumulation or distribution. Their patterns are predictable as they repeat at specific event-driven intervals. So the buy-side institutions are triggering at a certain time, at a certain price, within a certain range. Boom, boom, boom. If you have the right indicators, you can find them. As an example, price range is a trigger. Repetitive price action shows you to prepare ahead of time for sudden HFT gaps or huge runs because we have HFT gaps and runs in the morning, and that's really nice. This gives you the edge you need to be able to enter prior to HFT action. HFTs regularly chase giant institutional dark pool buying and selling after the dark pools have accumulated. They are able to delay their orders until after the market closes. No one can see what's going on there. And the reason is they are protecting the middle of a dark pools of class of America. They are they protect that well. They do not want to have to stock for $20 that is worth $10 at that time. This is another millisecond chart. You can see there's no way that you can read this, and you would need a multi-million-dollar computer to read it for you. Market structure, trade order flow. Order flow is based on price, time, quantity, also known as the size of the lot order. It's coming from the and the price on stock. Pools use time at average price. Traders use penny strike orders as they are tracking the dark pool liquidity draw, retail and events. So professionals are there's nothing. I've been on trading floors, many trading. There's nothing more exciting when they strike their penny. So what does their price do? If they're striking the penny, are their candles going to be long? No, they're going to be small. Small funds use volume weighted at price. Still haven't figured this out, and about half of the smaller funds managers who were actively trading went out of business last year, because volume weighted at price means that as volume grows, then it triggers the order to buy or sell short. And they get into more trouble with this because they haven't figured it out. And the SEC is starting to crack down on the smaller funds because they're losing so much of their clients' money. Retail traders use limit orders. Well, that lets your broker sit around for a few seconds, wait for price to move, and then fill your order. You think you're getting free stuff? How would brokers stay in business if they didn't make money off of you? It's the amount of money that they make off of you that's important. And it's also critically important that you learn to make money in the market rather than lose money, because when you lose money, it hurts the market. And as a professional, I don't like that. I want you to be profitable, because if you are profitable, then the market is more profitable. You won't be blaming the market for your losses. You will be making a lot of money, and that is a good thing. Small lot investors use at market orders a lot of the time, and that's a big mistake too. There is the special order type that Howard developed, and he talked to a market maker before we used it years ago. And the market maker was so impressed with his new type of order that any of you can use when you become a Technitrader student, that he asked permission to use it on his floor. And Howard was, of course, very pleased with that. Howard was my partner. And so it is today still on the professional side. So when you become a Technitrader student, you learn the order types that professionals use. Order type does matter, and traders should strive to use orders similar to dark pools, which control the entry. You have to control the entry price. If you leave it up to your broker or the payment for order flow for a market maker like Citadel, a lot of brokers will send it over to Citadel now and have it filled there. You're putting all your money at risk. You have no control over what your fill is. You can't do that. High frequency trading is easy to see in your charts. Determining what they are using in their formulas is also in the chart patterns. Here are some of the common formula-driven trigger signals. Buy-side institution liquidity draw. As they accumulate huge quantities, and I'm talking 5 million, 10 million shares of stock over time, hidden on dark pool venues. Retail news that the algorithm learns will create a surge of retail trading reaction. So they're test driving everything. Oh, what is this news that retail investors and traders will react to positively or negatively? All right, let's front run them. And they front run you all the time. Earnings reports and pre-news for release of data is also a big one. Company news that will create a predetermined retail crowd reaction. Corporate buybacks that create temporary artificial momentum energy that the algorithms detect as liquidity draw. So buybacks, and you want to be able to learn to also use buybacks as a trading strategy. International political news or economic news that generates reactions overseas ahead of the US market open is critical. Arbitrage between various financial markets that can be exploited instantly by the high-frequency trading companies. Abnormalities on order flow and supply and demand, and they can create it themselves. So anytime they see any abnormalities, they are in there. So these high-frequency traders, and there's quite a few of them, are out there, and they're companies with massive multi-million to billion-dollar computers running the show. The 6 primary strategies that HFTs use are rebates from exchanges for providing liquidity during stressed market conditions. They get rebates from the exchanges for providing liquidity. Tracking dark pool accumulation or rotation activity. Rotation is when the buy-side institutions are slowly selling off some of the shares of a stock so that they can buy another stock that is more in tune with how they can keep their return on investment for their mutual fund, ETF, index fund, or pension fund. Monitoring for stocks with significant changes in movement and or volume before the market or after the market closes. They're monitoring stocks with significant changes or a void of buyers or a void of sellers. Statistical arbitrage, trading between various markets on the millisecond. There's lots of financial markets, and HFTs can be trading anywhere. Forex, commodities, currencies, cryptos, you name it, they're on it. Technical trading using technical patterns as entries and to flood queues with small orders to move price before the market opens. So they're technical traders too, and the computer can understand technical analysis. Market making during stress markets, moving down rapidly due to retail group and small fund groups panic selling. When you panic and start selling, somebody has to buy to cover. The market guarantees that for every buyer, there will be a seller. For every seller, there will be a buyer. And this is how they do it. They make the market, and they make a lot of money. Dark pools are an acronym for alternative trading venues, which are off the exchanges. You cannot see their activity. So we have the public exchanges, and then we have the dark pools. And currently there are about 50 of them, 50 exchanges. There are 50 alternative trading venues. There are 13 US exchanges right now and many international exchanges. These hidden venues are where 80% of all the transactions occur, and most of them are very large lots. I'm talking, I look every day from my buy-side area, and I see 1 million shares, 5 million shares, 10 million shares, 20 million shares. They're trading large lots. These hidden orders use special routing and are not required to post to the market maker limit books during the day. So if you're a day trader, you can't see 80% of the activity that's going on. And on a millisecond scale, that can really hurt your trading profits. Dark pools are delayed orders. The average fill time for a giant lot of millions of shares is about 10 minutes. Hello? Have you lost me? The average fill time for a giant lot order is about 10 minutes. HFTs are constantly trying to find these huge lots to trade against, but they can't. HFTs chase the dark pools after the orders have been filled. Small funds and retail chase the HFTs. So we have an HFT huge gap down on retail news. So we had some selling by the pro traders at the end of the day, getting ready because they knew that the HFTs would gap it down. Only HFTs create these huge volume surges with the huge gap downs. So you know, and this is one of the indicators we wrote for MetaStock exclusively, that is this HFT gap down, huge, and then smaller funds stock thereafter. Gap down is so quite accumulation starts again because that fundamentals of this company. Massive anomalies in price action. The huge run occurs in less than 1 minute at the open of the market. So they do their orders in a minute after the market. Therefore, nearly impossible for most retail traders to get in stock before any points. If they do get in, lose money as a stock versus as activities and professional into the retail line. This is a primary cause of the whipsaw action. Recommended stocks, chat room stock picks. This big, huge gap, a run up, and then immediately starts selling down, sells down the road. Shift sentiment. There's a sentiment that shows an indicator, and then you have quite accumulation on right here, and then it gaps with a super high volume. As HFTs was stock down, gap that stock down, it showed a because Dark said, "Oh, that's the price." Pools buy bargain price stocks. They do not buy stocks. Cheap stocks are companies that are going out of business. The financial market is evolving at an unprecedented pace. The pandemic caused major changes to the internal market structure for the professional side of the market. It is so massive, it has been hard to keep up with. Most retail traders are unaware of the massive changes that occurred in the past 4 years. Retail traders are mostly using outdated strategies and obsolete systems. With over 80% of all orders now fully automated on the professional side, it is imperative that the retail trader understands the magnitude of the market structure changes. Automated means something different to each market group. It's not the same. So if we call market makers automated or dark pools automated, it's different than what you think of for each one. The type of order, the time or the segments of time, the routing they use, the execution, and the intent of the trade are also key factors. Not every, I just pull my hair out. Oh, the market is working with greed, or the market is working with fear. You're kidding me, really? Every retail financial news website is just disgusting because they go, oh, investors are buying, oh, and buying because they're afraid. Oh, they're buying. No, there's not just two. There's many groups. So let's go over that. I want to go over this because a lot of times, and then I get people asking me questions and they get very confused. So the Dow was written in the late 1800s by Charles Dow. He also created the Dow, which became the Dow Industrial Average. A Dow Jones Industrial Average was his partner. And there's three levels of market participant groups. There's the informed buyers. Those were, in his day, the banks, the extraordinarily wealthy people, all the greats of that era, and corporations, and they accounted for 50% of the market. Then you had your average investors who were middle-class Americans, and they accounted for 40%. And then you had your uninformed, poorer investors who came in at the top. So the informed buyers came in low, and then as price moved up, average investors kept buying and buying, and then uninformed investors. So it was a very basic, this is where we get Wall Street versus Main Street, as if that's all there is to the market. This is the market today. We have a lot of different groups, okay? So we have the buy-side institutions and that are also known as the dark pools. And they constitute a huge part of the market because they are investing $100 trillion worldwide. They are in control of the 401ks, they're in control of the mutual funds, they're in control of all of the new ETFs and all the derivatives and everything else. And they're the savviest of all, and they have the most complex systems. They buy very carefully. You also have wealthy private investors. Most of these are people who were like Bill Gates or any of the great public company CEOs. And they are very wise because they're business people, and the stock market is the business of businesses. So we really know that they know what they're doing. Jeff Bezos, any of the great CEOs, they know what they're doing, and they will buy low. Okay. Then we have professional traders on the sell side. The sell side institutions are the big banks. The buy side institutions, the giants, are somewhere between 25 and 35 giant corporations, most of which you have never heard of. The sell side institutions are the 6 top money central banks and Goldman Sachs and Morgan Stanley and a few other large financial services companies. And that's it. So the buy side dominates now. It used to be that the banks dominated. And that's what's been in the news lately is, oh, the banks are going out of business. Makes me pull my hair out. The banks are no longer the most important market participant. The buy side institutions have all the money. They have so much money, they could pay off the national debt of the United States and not blink an eye. Okay? The banks are going under because of cryptocurrencies, and we're changing to a digital economy, which is underway already. We are in the digital economy. We have digitized assets. We have non-fungible tokens. We have all kinds of things coming up that you will get to trade once we on the buy side have given all of our take on the rules and regulations to the SEC. The SEC asks us, what do you think of this? How does this work? We test drive all this stuff, and eventually you will be able to trade these on the stock market. So the sell side institutions are the big banks. They make most of their money when the market is going down. They have huge contingent of professional traders on the sell side, floor traders, massive amounts. They have the best floor traders in the world, and they pay them premium. And yes, a lot of them do make $1 million a year. Professional traders on the buy side work for the buy side institutions or the derivative developers or the mutual fund companies or the ETF companies. There are also hundreds of thousands of professional traders that are independent, that work for themselves. They come from the sell side and the buy side, and they sell for themselves. So these professional traders are where you want to be. You need to find out what their footprint looks like and follow them. Corporations do massive buybacks in between 2017 and 2019. Huge number of corporations. Easy. You know how to so investing. They're in the private market companies posturing IPO. There that come out in relation to the future very happen. You haven't trading has been around two 2000. And 2, and it will be here. Avoid. Voids is always that there are no players. These are actually trading is very important. They're trading up in here. Then you have sovereign funds, foreign funds, nonprofit funds. They're investing long-term. Small asset managers and small funds managers, small hedge funds, AAII, and investment groups, they get in about here because they wait for the recommended stocks. So all this money has been lost to you because you wait all this time. You should be MetaStock charting software because it'll show you when to get in with the buy side and also when to exploit the high frequency traders, make a lot more money, but you wait. lot investors get in about here by themselves. Retail traders are really late in the runs because they are waiting on chat rooms or recommendations and that type of thing, rather than learning to study the charts that MetaStock provides and gives you all this excellent information. Memes groups, retail trading chat groups, they're all in the same bracket. Memes trade during the lunch hour, so somewhere between 11 and 1 my time. The memes will appear, but they're not showing up so much. The SEC, I don't think we're going to worry about them much. And it's true, they lost so much money last year, they're not around. Then we have the outlaw investors, who are people who have very little money to invest or trade. They want to get into the market. They get in at the top, just start to go down. And this is the downside market participant cycle. Buy-side institutions, as they do, buy-side institutions create the bottoms. Buy-side institutions slowly start to get out way before the top. Wealthy private will also get out at the top. Corporations will get out at the top. Professional independent traders and professional traders on the buy side will see that there is a lack of buyers. The buyers are evaporating. So they posture for wait. And then they cover. And that's high frequency trading for also in this group. Foreign funds will until about, and they will start selling. Smooth investment groups will hold and hold. They'll get out. Memes groups will try to. After it is starting them, they're selling small lots, but the buyers are buying the bottom. In a bottoming market since, by the way. I know that's hard. We have, if you studied the charts right and what was going on, you would see that HFTs. There is on stock or options trading. You take every seminar and read all of the information available for free on the internet. But you will never be as successful as you deserve to be until you understand the catalysts behind the pattern I define trade stock. MetaStock is an amazing charting software program, and you guys are not using it to its max. You should be using it more. To front run HFTs, the first step is to recognize able to front. These are more open. HFTs to their and time HFTs at more. I go to the everything that going on the mind is acting and going on. The cat. Stop. That their orders that million orders every single amazing debate profit from all computer generated. That is computer generated. Different HFTs. Pro traders set up smaller candles. The indicators that we have for that MetaStock. Pro traders are mass setups that prompt to fill queues with orders ahead of open. So they get and they wait and they have a little surge. All of a sudden we'll have a big, huge gap. That's not a very big one, but that's the one I could find. HFTs are allowed to create liquidity and are paid rebates from exchanges for that liquidity. So they're liquidity, but they're making money. HFTs order to flat open. You're trading, put in 60,000 orders a minute. Pro traders how to make HFTs trigger. So if you follow the and their setups and you identify it with the indicators that we teach, you will have it. The end of day, first of day. This is a very popular trading mechanism for a lot of the professionals that you have probably never heard about. The second strategy is to study the intraday charts at the end of the day before the market closes. There is a professional open auction that occurs within the last 3 to 5 minutes of the trading day. You are not allowed to participate in an auction. You must be a professional to do so. Pro traders setups at this time can expose where they are buying or selling short for the next day transaction. They end up, or they close first of the day, so they are a 2-day action and they avoid all of the other problems with day trading. This is their version of day trading nowadays, folks. Be proficient at intraday chart analysis and the intraday close to use strategy. This is an advanced level professional strategy. You use this if you're a beginner, but if you're an advanced to professional, then you're learning how to use this. You would be using the indicators that we designed for MetaStock to find lot activity for traders. Front run HFT, number 3. The third strategy is to be aware of the dark pool buys. One, they're pretty obvious. A buy zone is a specific range of price dark pool TWAP orders and pause. As the giant buy-side institutions are using sophisticated, complex quantitative analysis determining the range of price to pay for a stock, a buy zone develops. So it is a buy zone, often HFT gaps and be huge. This is a low-risk entry HFT front run for beginners, traders. So if you're a novice trader, the first one I would is the buy zone, and this is a buy zone. They stop buying out of the zone, and they have a specific price range. It's usually about 10%, but it can be higher or narrower. And then HFTs will gap. This is not a big gap, but we're seeing a lot of big gaps on Friday. Summary. This webinar is just a snippet of the training TechnoTrader courses teach. Our education is unlike any other. We are credentialed professionals, which, if you do your homework, you will find is very rare in the stock trading education business. What you already know is a beginning. Everything you've learned is worthwhile. You just have gigantic holes in your education. Are you ready to take the stress and frustration out of trading while increasing your profitability? All of you need to raise your expectations. You have such low expectations, and you also have to consider how much are you worth an hour? If you went to work for somebody or are working for somebody or have worked for somebody or some corporation, how much are you worth an hour? 20 bucks an hour, 50 bucks an hour, 100 bucks an hour? Professionals consider themselves to be worth at least $500 an hour for their trading. You are not considering your hourly wage. You are not considering the time that you put in. So if you make $200 in a day and you spent over 8 hours, you haven't made any money. You need to raise your expectations. You have such a low expectation. Trading like a professional, front-running HFTs, finding dark pool buy zones are all taught in great detail in our training courses. Take your trading to the next level. Be more like a professional, because when you respect the market, when you make good money, the professionals will respect you. They have no respect for hobby traders and that sort of thing. People who are trading and they lose money all the time. IRS calls them hobby traders. So I would like you to visit our website. We have free mini courses. The mini courses there's some for beginners, there's some for intermediates and novices, and there's some for advanced and elite traders and professionals. These courses give you a preview of what it's like to take one of our courses. It's laid out exactly like our courses, but they are a mini course. They're not the longer courses that we have for you if you wish to become a Tech and Trader student. These are all free. All you have to do is register, and you can watch as many of them or as few of them as you like, and you will learn a lot about how I teach and what we teach and why we teach. I want the stock market to be strong. I want the stock market to have a long bull market. I want to get rid of all of this indecisive candlestick patterns and all these other problems that are occurring. And by the way, you should be using candlesticks. They're easier to read. You want to have strong, consistent profitability. If you have strong, consistent profitability, the market will be stronger. The economy will be much stronger. We are moving into the digital economy at a rapid pace, and there is no way to stop it. The consumer economy for the US is over. Our population is stagnant and will start to decline. Very soon we'll have more people over the age of 40 than under 40. That means everything shifts, and it's shifting to the financial, the AI, and all the other things that are coming very rapidly. The financial markets already have it in place. They're already using this and already integrated it. So you need to catch up, and you need to learn all of the things you need to know so you can get from this, because this is huge. The middle class of America needs to have the stock market or other financial markets to boost their income so that they can stay in the middle class. Otherwise, you are going to be left behind because the robots are coming. There are 9.4 million job openings, only 3.4 million people available to fill those jobs. Do you think the corporations are going to sit around and twiddle their thumbs and go, oh dear, what do we do? What do we do? Pay higher rates? No. We have a problem. And that is, we don't have enough people to fill all the jobs. So hire robots. The more robots the higher, the fewer jobs. You need to teach your children. You need to prepare them for the future. You can't sit and think, okay, well, we're a consumer-based economy. Vietnam is a consumer-based economy. India is a consumer-based economy. The US is a digital-based economy, and everything changes, everything. So our webinar special is available through May 15th, 2023. And it's about dark pools. And that is your link to get there. It is a $99 course. I'm giving it to everyone who wants to watch it for free. So you all win the prize today. You have free access for 1 week, so you can go back and review it as many times as you want. All you have to do is register and apply the coupon at code checkout, and you get it for free. And you can watch it over and over, however many times. If you have any questions, I do have a discussion group for people that you can join, and you can ask questions, and I'll answer your questions there. So you have lots of opportunity to learn a lot more than I was able to do in this 1 hour. I thank you all for coming and listening through everything. Jeff, is there any questions?
Yes, we do. Let's see. Why are we told that the market is trading with low volume? Olga wants to know from GoToWebinar.
Low volume happens during the day. Low volume is low liquidity because the dark pools are trading off the exchanges. The exchanges have low liquidity during the day. So there is low volume during the day for retail traders, smaller funds, anybody trading on the retail side. In the retail public exchanges, they're going to encounter low liquidity. And this is very dangerous, especially for you day traders. You may want to do swing trading or shift to something else that is more lucrative, because day trading is getting harder and harder. The SEC is starting to crack down on a lot of companies that are trying to promote day trading. So be very careful, because they're saying, hey, you're just robbing these people blind, and they can't trade like that anymore. You have to modify your trading to fit the current market structure. And I showed you the market structure and how many different market participant groups we have. And you need to piggyback on the pro traders or the dark pools and then ride the runs. There's momentum runs, there's gaps, there's a lot of momentum runs that you can ride up to. This was just about HFTs and HFT gaps, but you also can trade the momentum runs out of a bottom, momentum runs out of a platform. A platform is a very consistent sideways pattern that is also dark pool controlled. The dark pools control their price entry, the low price, the high price, and so it's shown very obviously on the charts. That's one thing that you'll see in the dark pool buy zones, is you're going to see some of those charts that show that from MetaStock. So you should really take the time to watch that. That's why I'm offering it, so because it kind of goes hand in hand. HFTs, dark pools, they're all working in sync. So yeah, so I know everybody wants to day trade. I have no idea why. It's so much work. It's so hard, and it's so little money. Raise your expectations. You can make a lot more money. A lot more money. 6, 7 digits. Yes. I have students doing it. Next question.
Rich wants to know, does volume profile help in identifying these moves?
Volume is one of the indicators. We have 5 different indicators that we have exclusively for MetaStock. I worked with MetaStock and a professional, and I showed them what I wanted as far as what I wanted to have done. I had studied all of the Robert Colby massive 250 different indicators during the time when I was working on my thesis for the Chartered Market Technician Association, and I studied 250 different indicators, and I realized that certain things were essential. One was the tick. The tick is something that's really important. So we have these indicators that we've written that show where the dark pools are, because the dark pools will just sit there. It's huge. The SEC says it takes during the day, but ECNs and public exchanges, they just take in all. So volume for all, spreading it out shares, so their volume is a different pattern than what you think. Another one?
Let's see. I just got the link typed out. I had typed the initial link in incorrectly for the free course, and so make sure you click on the second link, the one that I corrected. But that looks like the end of the questions, Martha. Let me check YouTube. Yeah, I don't have any questions over there. So.
Alrighty, I'm done a little bit early. So thank you very much for coming. Hope you learned a lot, and visit our website and sign up for.
Yeah, free course. Everybody wins. Hey, you get a course. You get a course. Everybody gets a course.
Everybody gets a course.
All right. Thank you so much, Martha. I really appreciate you coming in and spending some time with us.
Great. Thank you for having me.
All right. Very cool. We're going to take over a little bit here. And let's make myself the presenter. We'll go ahead and show my screen. Aside from a little bit of technical issues, I think today went really well. So I really appreciate all of you guys for watching, coming, visiting it. I really appreciate all of our great speakers. We had some great speakers today, and everybody did a great job. So let's real quickly thank our sponsors, Stocks and Commodities Magazine, AAII.com. You can find out some more information right there. And of course, the CMT Association, all great sponsors of the MetaStock conferences. We appreciate the work that they do. Great work. Thanks, Martha, for giving a free course. So there you go. Do want to talk a little bit about MetaStock. MetaStock's been rated the #1 software in its price category. Helps you scan the market, test trading ideas, forecast probable price movements, helps you get real-time alerts, commentary, and signals. You can sign up for an extended trial of buy 1, get 2 months free of MetaStock, or any of the offers that we talked about today at metastock.com/conf-promo. If you have questions and you want to talk to one of our reps, you can go to metastock.com/sales-chat. Sorry, it's been a bit of a day. It's been a long day. I hope you enjoyed it, though. And then you can give us a call at 800-888-8255. 882-3040. So thank you for coming today. I appreciate it. And we'll see you again tomorrow.
Hi, Kelly Clement here from MetaStock. I hope you enjoyed today's video, and I hope you found it instructive and informative. If you did, what I'd like to invite you to do is go ahead and like and subscribe. Like the video, subscribe to the channel. It helps us a great deal, and it helps us bring you more awesome content like today's video. So go ahead and like and subscribe, and keep on watching.